Hello, my dear students. Welcome back to the CA Inter Auditing Marathon Part 2. So, in the Part 1, we have covered all the key chapters, all the important chapters, much of the conceptual understanding we have already done. So, now we will be proceeding further with the other chapters which are yet to be revised. So, I will start this Part 2 of the marathon by starting with the chapter Risk Assessment and Internal Control. So, we'll be revising now first the chapter called Risk Assessment and Internal Control. So once we are done with that risk assessment and internal control, then we will think about the other chapters. So let us now jump into the concepts and technicalities involved in this particular chapter. So the title of the chapter itself says this chapter contains two parts. One part is related to risk assessment and the another part is related to internal controls. And even this particular chapter has also been taken from the standards, and the source from which this chapter risk assessment and internal control was taken is SA 315. So SA 315 is the relevant standard in which from which actually the concepts in this chapter are taken from. So first we will start with the concepts relating to risk assessment. So once we are done with the revision of risk assessment related topics, then we will talk about internal control related matters. Now, risk assessment, nothing but the assessment or analysis of risk in the audit. Before we can proceed further, first we need to understand what is the meaning of the term audit risk. So as we all are aware, because of inherent limitations of the audit, no matter how effectively you do the audit, there is always a chance of auditor's opinion going wrong. That risk of auditor's opinion going wrong, only we call it as audit risk. However, the term audit risk has been technically defined something like this. So audit risk means risk of expressing an inappropriate opinion. Audit risk means what? Risk of expressing an inappropriate opinion when the financial statements are materially misstated. When the financial statements are materially misstated. So the risk that auditor might give a wrong opinion, might give a inappropriate opinion when in fact financial statements are containing a material misstatement. If I put it in simple terms, if the financial statements contain a material misstatement, the appropriate opinion should be modified opinion. This we all know. So if the financial statements are materially misstated, appropriate opinion shall be modified opinion. That could be either qualified, adverse or disclaimer. But I am saying auditor is giving inappropriate opinion. That means which opinion he would have given? Unmodified opinion he would have given. So financial statements are containing a material misstatement. You should have given a modified opinion. But instead of that, if the auditor is giving unmodified opinion, that scenario we call it as audit risk. So in definition says the risk of expressing inappropriate opinion when the financial statements are materially misstated. That means when the financial statements are materially misstated, auditor is supposed to give modified opinion, but he is giving inappropriate opinion, which is he is giving unmodified opinion. So when modified opinion is appropriate, but if the auditor is giving unmodified opinion, that scenario we call it as audit risk. Whereas the other way around, if the financial statements are not containing material misstatement, auditor should have given unmodified opinion. But auditor is giving inappropriate opinion, that is he is giving modified opinion. Will this also come under audit risk? The answer is no. The second scenario will not come under audit risk. If the auditor is giving modified opinion when unmodified opinion is appropriate, that scenario will not come under audit risk. Whereas if the auditor is giving unmodified opinion when modified opinion is appropriate, that only will come under audit risk. So that's what even literally if you read the definition, see they are not just saying audit risk means risk of expressing inappropriate opinion. They did not end the definition with that. They are extending what they are saying, risk of expressing inappropriate opinion when the financial statements are materially misstated. That means financial statements contain a material misstatement and you are giving inappropriate opinion, that only will be coming under audit risk. Clear everybody? So audit risk does not include this particular scenario where auditor is giving modified opinion where unmodified opinion is appropriate. That will not come under audit risk. Even if you look from the legal perspective also, auditor will not face any challenges in this. Like for example, you found one misstatement. That misstatement is very, very small. but you using your professional judgment, you have decided this misstatement is material. So you exaggerated the nature of extent of the misstatement. So while you are conducting audit of Reliance Industries Limited, assume you found a misstatement of 1 crore rupees. Now this 1 crore rupees of misstatement is not at all material when you look from the company as a whole. But you as an auditor, you are very risk averse person. Even this 1 crore also you are looking it from the telescopic lens, and you are saying that even this 1 crore also I will consider it as material. So now you behaved in a risk aversive manner. You played a safe game there. You are not negligent there. So even if 1 crore turns out to be a bigger fraud in the future, you will not be punished. Why you will not be punished? You will say well in advance, boss, I have already given a modified opinion. So that's why even if you go from the definition perspective also, second scenario will not come under audit risk. Even if you look from the practical perspective also, auditor will not face any consequences in that case. And one more thing, this audit risk does not include business risk faced by the auditor. Business risk will not get included under audit risk. Sir, what are examples of business risk? Sir, losing of clients, losing of reputation, client not paying you the audit fees. So these kind of business risk will not get included in the term audit risk. Audit risk is purely the risk which auditor face from legal perspective will only come under audit risk. Business risk like loss of clients, loss of reputation, loss of remuneration, these will not come under audit risk. Clear? Now let us try to understand what are the components of audit risk. So broadly, audit risk is made up of two components. So the two components are going to be, number one is risk of material misstatement and the other one is detection risk. Now what is this risk of material misstatement? Simply the chance of happening of misstatement. The chance of happening of misstatement, the possibility of happening of misstatement even prior to audit. Even before audit has been started, that risk is always there. Like for example, you are conducting audit of the entity. In that entity, you are not able to find any internal controls. Don't you think if the internal controls are not there, there is a risk of material misstatement in the financial statements? Yes, that only we call it as risk of material misstatement. The possibility of happening of misstatement in the financial statements prior to audit. And if I say one step ahead, this risk of material misstatement will be there. Sorry, this risk of material misstatement will be there irrespective of audit. Whether audit happens or doesn't happen, that doesn't matter. Risk of material misstatement will always be there. Auditor will not be responsible for creation of the risk of material misstatement. It is purely management's risk. Auditor is not responsible for creation of risk of material misstatement. What auditor will do, sir, then regarding risk of material misstatement? He can only identify it. Auditor will not create any kind of risk of material misstatement. Auditor can only identify it, that too by performing risk assessment procedures. See the connectivity here. So audit risk, one of the component is risk of material misstatement, the chance of happening of misstatement in the financial statements. Auditor is not responsible for creation. This risk will be there even prior to audit. This risk is independent of the audit. Auditor can't do anything about it except identification. That identification also will happen only by performing risk assessment procedures. Clear? Now this risk of material misstatement is further made up of two more components. This risk of material misstatement is further made up of two more components. So what are that two more components? One is inherent risk and the other one is control risk. Risk of material misstatement is further made up of two components. One is what? Inherent risk, and the other one is what? Control risk. Now what is this inherent risk and what is this control risk? Very simple. Let me try to illustrate with the help of example. Assume this is an organization. Using my creativity here, please don't pull my leg here, just try to follow. So assume this is an entire organization protected by three internal control systems. So this organization is protected by three internal control systems. Now in this organization, two misstatements happened. This is misstatement 1. Another misstatement, this is misstatement 2. So now what difference you are able to make out between misstatement 1 and misstatement 2? So if you look it from the creative perspective like mine, you might come to a conclusion that, sir, misstatement 1 happened because there is a absence of internal control. If you observe here, there is a gap. That is an absence of internal control. So I will say misstatement 1 happened because there is no internal control to prevent the misstatement from happening. I will say misstatement has happened even after having an internal control system. Here there is an internal control system which is implemented to prevent a fraud or error from happening. But even after implementation of internal controls also, still misstatement 2 has happened. So now I will say that misstatement 1 has happened because of inherent risk. It has happened because of inherent risk. Sorry. Then what could be the meaning of inherent risk? Inherent risk means simply absence of internal control. What do you mean by inherent risk? Absence of internal control system. That means the client did not implement some internal controls in certain areas, because of which there is a possibility of happening of misstatement. Obviously, if there is no internal control system in place, there will definitely be a chance of happening of misstatement. So that absence of internal control, that scenario I call it as inherent risk. Whereas misstatement 2 is because of control risk, which means that failure of internal control system, which means the organization has designed internal control, has implemented internal control, but that internal control is suffering from some weaknesses, that is suffering from some inefficiencies, because of which it failed to prevent, detect or correct a misstatement from happening. So that failure of internal control, I call it as what? Control risk. So risk of material misstatement is made up of two components. One is inherent risk, other one is control risk. Inherent risk means absence of internal control system. Control risk is failure of the internal control system. Clear? So this is what regarding one component. Now let us come to the other component, detection risk. Now what is this detection risk, sir? Detection risk means the audit procedures which are performed by auditor may not be able to detect a material misstatement which has already happened in the financial statements. There is a misstatement which has taken place in the financial statements. Generally, auditor will perform audit procedures to identify the misstatements only. Detection risk is the risk that the audit procedures which are performed by the auditor may not be able to detect a material misstatement which is already there in the financial statements. You performed audit procedures, but those audit procedures failed miserably to detect a misstatement which is already there in the financial statements. So this I call it as detection risk. If you ask me, detection risk will only be in the control of auditor. This is completely in the control of auditor's risk. Whereas risk of material misstatement is management created risk, auditor can only identify, but detection risk is something which auditor can control. If he perform good audit procedures, if he complies with all the standards, then he can reduce the detection risk. If he does the audit negligently, then he will increase his detection risk. So like this, between the two components of risk of material misstatement and detection risk, which one will be in the control of the auditor? Detection risk will always be in the control of the auditor. And one more last point, there is an interrelationship between the components. Between risk of material misstatement and detection risk, interrelationship is there. What kind of relationship? There exists a inverse relationship between risk of material misstatement and detection risk. So if the auditor identifies more risk of material misstatement, he will try to perform more audit procedures and he will try to reduce or keep the detection risk at a low level. So there will be always an inverse relationship between risk of material misstatement and detection risk. Clear? So this is what will be the question number 1 from this chapter. Define the term audit risk, state its components and interrelationships. So that's what we are successfully done. Next concept, explain the risk assessment procedures in light of SA 315. Also explain what is included in the risk assessment procedures. Now let us try to understand this concept. They are asking us to explain in detail about risk assessment procedures. As we already know, in the risk assessment procedures, we try to obtain an understanding of entity, environment and its internal control. For what purpose, sir? To identify risk of material misstatement. To identify what? Risk of material misstatement. And the standard says this risk of material misstatement should be identified at 2 levels. At the risk of material misstatement at the financial statement level, risk of material misstatement at the assertion level. Now let us try to elaborate this. Sir, what do you mean by risk of material misstatement at the financial statement level? See, at the financial statement level, risk of material misstatement means that risk which is having a potential to affect entire financial statements. On the other hand, risk of material misstatement at assertion level means that risk which has potential to cause a misstatement in just 1 or 2 items of the financial statements. Simple example, if you came to know that the person whoever is preparing financial statements doesn't have knowledge about applicable financial reporting framework, he doesn't know Schedule 3 and accounting standards. Is that a risk of material misstatement? Yes. If the person who is preparing the financial statements doesn't have the knowledge to prepare the financial statements, will only one item of the financial statement will be affected or entire financial statements will be affected? there is a chance of entire financial statements getting affected. So that kind of risk we call it as financial statement level risk. On the other hand, at the warehouse where the inventory is kept, in that warehouse, the CCTV camera is not working effectively. Because of that, only one or two items will be affected, or entire financial statements will be affected. Just one or two items will be affected. Only inventory related area will be affected. So now that risk I call it as risk of material misstatement at assertion level. So the auditor should obtain an understanding of entity, environment and its internal control. That too, to identify the risk of material misstatement. That risk should be identified at two levels, at the financial statement level and also at the assertion level. Once we identify the risk of material misstatement, the next step is we need to assess that risk of material misstatement. What we need to do? We need to assess that risk of material misstatement. Assessing means what? Analyzing. We need to analyze what risk we have identified, what is significant, what is not significant, for which we need to pay attention, to which we need not pay attention. That assessment you have to do. So first we should identify, after that we need to assess that risk of material misstatement. Sir, why we need to identify and assess the risk of material misstatement, sir? To reduce our audit risk, to reduce or keep our audit risk at a low level. To keep our audit risk at a very low level. So why we need to identify risk of material misstatement and assess it? So that on the basis of risk of material misstatement, we will plan our nature, timing and extent of the further audit procedures, so that we will try to keep our entire audit risk at a low level. So this is what the SA 315's objective is. Identify risk of material misstatement, assess the risk of material misstatement, so that you can reduce your overall audit risk through understanding of entity, environment and its internal control system. So now few statements are there which are very important from the examination perspective. Like let me explain. Do you think risk assessment procedures alone will give you all the evidence required for expressing opinion? Do you think just by performing risk assessment procedures, will you get all the evidence required for expression of opinion? The answer is no. Frankly speaking, risk assessment procedures will not give you sufficient and appropriate audit evidence to express the opinion. Risk assessment procedures will only help you to identify what is a risky area, what is not a risky area. That's all. Risk assessment procedures will not help you out to obtain all the evidence required for expressing opinion. They will just let you know what is a risky area, what is not a risky area. Similarly, even if you observe compliance procedures also, will they give all the evidence required for expressing opinion? No, they also will not give all the evidence. They will just let you know which controls are effective, which controls are not effective. Finally, we will get all the evidence required for expression of opinion only by performing substantive audit procedures. So risk assessment procedures are not going to give you sufficient appropriate audit evidence on their own. Even compliance procedures also will not do it. We get all the evidence required for expressing opinion only by performing substantive audit procedures. And one more statement important for true or false statements: the assessment of risk is a matter of professional judgment rather than capable of precise measurement. Very important. They can play with you in the examination in the form of a true or false statements. So first, what is the meaning of this sentence? This sentence means that whatever risk we are assessing, that is purely estimation out of our professional judgment. We can't exactly precisely calculate the risk. We can't exactly measure the risk. Risk is not a matter capable of precise measurement. We can't exactly measure the risk. We can only estimate it by way of our professional judgment. So this is what the meaning of the sentence: the assessment of risk is a matter of professional judgment rather than a matter capable of precise measurement. Now in the exam, they might ask you a true or false statement. The assessment of risk is a matter capable of precise measurement rather than a matter of professional judgment. Do you agree with that? No, we should not agree with that. So it is a matter capable of professional judgment rather than a matter capable of precise measurement. Now, what is included in the risk assessment procedures? Nothing but what methods we can follow for risk assessment procedures. As we all know, 7 methods are there for performing any audit procedure, as we have seen in the chapter audit documentation and evidence. So the 7 methods are going to be inspection, inquiry, observation, external confirmation, recalculation, reperformance, analytical procedures. Now out of these 7 methods, which methods will be useful for performing risk assessment procedure? So we can, out of these 7 methods, only 4 methods will be included in risk assessment procedures, which is inspection. We can do inspection. What inspection you will do, sir? I can inspect the documents of the company like MOA, AOA, incorporation documents I will read. Even I can read their internal control manuals. I can read their standard operating procedures. So inspection I can do to get to know about my entity, environment and its internal control. I can do inquiry. Sir, with whom you will do and with whom you will go and do the inquiry? There is no doubt I will go to the management and do the inquiry. But do you think management are the only people from whom we can inquire? The answer is no. Apart from management, the auditor can inquire various others within the entity to understand about entity, environment and its internal control. The list has been given here. The auditor can inquire with those charged with governance. He can inquire with internal audit personnel, nothing but if internal audit team is there, with them he can inquire. Auditor can inquire with employees of the company. He can inquire the in-house legal counsel. He can inquire the marketing or sales team, and even he can inquire the risk management function like that. And even you can inquire with IT people also. Like this, auditor can inquire with different people, not just with the management. So I can do inspection, I can do inquiry, even you can do observation. Observation in the sense plant visit. You will observe the client's premises, you will observe the production, you will observe the manufacturing, you will observe the accounting process, you will observe how the activities are getting carried out. So like this, even observation also we can use it. Can you use external confirmation? No, we can't use external confirmation. Can you do recalculation? By doing some calculations will you be able to find out? No, we can't do recalculation. Reperformance, will you start the business once again from the scratch to know about it? No. Then we can even do analytical procedures also. As we all know, we try to study relationship between financial and non-financial information. By studying that relationship also, we can find out risk of material misstatement in the organization. So out of 7 methods, 4 methods are useful here for performing risk assessment procedures. Like inquiries we can do. Along with that, we can perform analytical procedures also. In addition to that, even we can perform observation and inspection. Clear? Next one. Next thing, important statement. Understanding an entity is a continuous process. Yes, understanding about the client's entity is not just a one-time activity. It is not like at the beginning we will try to get an understanding and we will stick to it no matter whatever happens. No. At the beginning, we will try to understand about the entity, but during the course of audit, we should remain alert whether any extra information is available regarding client's business. And if at all, during the course of audit, if I came to know about any extra business, extra information regarding client's entity environment, I should update my knowledge about the client's understanding of the business and change my risk of material misstatement. It is not like at the beginning I have obtained the understanding, I will stick to it no matter whatever happens. You cannot say that. At the beginning we will definitely understand, but throughout the course of audit we will gather, update and analyze the information whatever we had obtained. So that's what they say. Obtaining an understanding of the entity and its environment, including entity's internal control, is a continuous process, is a dynamic process of gathering, updating, analyzing information throughout the audit. And if you obtain understanding of the entity, it will help the auditor in various ways. Like that will help you to assess risk of material misstatement. By studying about the client's organization, you will get to know which area is risky, which area is less risky. That will even help you to determine materiality. What is material, what is not material, that you can determine. You can come to a conclusion whatever accounting policies that your client has followed, are they appropriate? And also, if you study the client's organization, you will come to know which areas require special consideration, which areas does not require special consideration. And finally, you can find out whether you have obtained sufficient and appropriate audit evidence only by understanding about the entity. So if someone asks you why you need to obtain an understanding of the entity, I need to obtain the understanding about the entity because of this various advantages. What are they? It will help me to find out risk of material misstatement. I can decide what is material, what is not material. I can come to know whatever accounting policies which my client is following, whether they are appropriate or not. I will come to know which area requires special consideration, which area doesn't require special consideration. Even I can evaluate whatever evidence that I have gathered, is that sufficient and appropriate. Clear? So these are all the major concepts regarding risk assessment. So one part of the chapter we are done. Now we will come to the key concepts from the term internal control. So first of all the related topics of the internal control, I will try to complete in one go. So first, internal control. What is the meaning of internal control? So the meaning of control is very simple. Any policy or procedure which is designed, which is implemented, which is maintained by the management or those charged with the governance of the organization to achieve the management's objectives. So how the term internal controls can be defined? Internal controls can be defined as it refers to any policy or procedure which is designed, implemented or maintained by the management or those charged with governance of the organization to achieve their objectives. Those policies and procedures we simply call them as internal control system. Like various examples we have already seen. So allowing only authorized person to enter inside the company, internal control. Entering OTP before doing any banking transaction, internal control. So like that, any policy or procedure which is designed, implemented, maintained by the management or those charged with governance to achieve their objectives, that policy or procedure we call it as internal control. And when we talk about specific terms, the any internal control will try to fulfill at least one of the four objectives. You take any internal control will try to fulfill at least one of the four objectives. So what are the four specific objectives of internal control? Number one, most of the internal controls will work with the objective of safeguarding the assets. Which will work with the objective of what? Safeguarding assets, protecting the assets of the entity. And some internal controls will work for increasing reliability of financial information. Some internal controls will be working with the objective of making financial information more reliable. Some internal controls will work with the objective of increasing efficiency and effectiveness of operations. Some internal controls will work with the objective of what? Increasing efficiency and effectiveness of operations. And some internal control will work with the objective of ensuring compliance with laws and regulations. So if you take any internal control, they will try to fulfill at least one of these four objectives. What are they? Safeguarding the assets. They try to protect the assets. Or some controls will be trying to achieve the objective of increasing the reliability of financial information. They make the financial information more trustable. Some internal controls will work with the objective of increasing efficiency and effectiveness of operations. And some internal controls will work with the objective of ensuring compliance with laws and regulations. Clear? So these are all the objectives which internal control will try to comply with. So this is what regarding meaning and objectives. Now one big question, sir, if the organization is having a perfect system of internal control, can you give me a guarantee that no error or fraud will happen in the organization? If the organization has implemented sound internal control system, excellent system of internal control, lot of effort has gone into it, can anybody give me a guarantee that just because there is a perfect internal control system in the organization, no error, no misstatement, no fraud will happen? Can anybody give me that guarantee? No, that guarantee can't be given. So the point which I want to make here is, no matter how effectively you implement internal controls can only give you reasonable assurance. Internal controls can only give you reasonable assurance regarding achievement of objectives. Internal controls can't give you absolute assurance that no fraud or error will happen. They can't give guarantee. Like the way we have discussed for audit. Even while discussing inherent limitations, we have seen that auditor can only provide reasonable assurance. Auditor cannot provide absolute assurance. Similarly, internal controls also can provide only reasonable assurance regarding achievement of their objectives. Internal controls can't provide absolute assurance, or internal controls cannot provide guarantee. Why so? Once again, the same reason, like the way auditing is suffering from some inherent limitations, even internal controls are also suffering from some inherent limitations. Those limitations which are of such a nature that they are unavoidable. The internal controls are also suffering from some limitations which are unavoidable in nature. So that's why no matter how effectively you implement internal controls, they will not be able to give you reasonable assurance. So they will not be able to give you absolute assurance. Sir, what are that inherent limitations? So number one, human judgment in decision making. By the end of the day, your internal controls will be decided by the human beings. And we humans are wired in such a way that we tend to make some mistakes. Sometimes while designing the internal control, the person whoever has designed the internal control, he or she might have made an error in the design of the internal control, which could make the internal control fail altogether. And one more reason, if you ask me, a human can design internal control only for the ways in which he can imagine a fraud will happen. Like management has obtained a fraud can happen in 10 ways. So they have implemented internal control to protect this 10 ways of committing of the fraud. But the person who wants to commit a fraud, he might come up with a 11th way of committing the fraud. This could always happen. So like this, no matter how effectively you implement internal controls, since by the end of the day humans are making decisions, there could be a scope for human error in designing internal control, which can make the control fail altogether. Next one, lack of understanding of the purpose. Those people who are required to implement internal controls, they might not understand the basic purpose of the internal control only. Those people who are required to ensure that the internal control is functioning effectively, they might not understand basically what is the purpose of internal control. Might be they did not attend the training properly, might be they did not get the instructions properly. So if the person who is required to implement or maintain internal control, if they themselves are not able to understand the purpose of the internal control, can it lead to effective functioning? No. So sometimes internal control fail because those people who are required to implement internal controls may not understand the basic purpose of the internal control. Third inherent limitation is one more thing: cost exceeding benefits. Cost exceeding benefits. See, implementation of internal control is not a simple affair. It involves a lot of cost. A lot of cost goes into implementation of internal control. You have to recruit the people, you have to buy the systems, you have to maintain the infrastructure. Sometimes what will happen is the cost of implementing the control will be much higher than benefit which you are deriving from internal control. Like management has implemented simple internal control of appointing security guards. It has appointed 2 security guards per month, 15,000 rupees salary. So per month you have to pay 30,000 salary. Per year, if you calculate, to implement a simple internal control of security guards, the company has to incur 3,60,000 rupees of cost. Now, after 1 year has passed, the management made an analysis how much we are able to save from this internal control. Now, they made an analysis. In the last year, there were no security guards. So, some thefts have happened. So, because of that theft, some 50,000 rupees because of that theft, 50,000 loss has happened to the company. Now the company, to protect the theft of 50,000, they have to incur a cost of 3,60,000. So here cost is very much higher than benefit which you are receiving from the internal control. This might also lead to ineffective implementation of internal control system. And one more thing, collusion among the individuals. Those people who are required to implement internal control, they might collude with each other in order to commit the fraud. Like for example, management with a very good intention, they have segregated the duties. They told cashier will only receive collections and make payments. Accountant will pass the accounting entry. Excellent intention, good internal control system. But what has happened is now cashier and accountant both came to a mutual conclusion that we both will, cashier told, I will take the money from the cash box. Accountant told, I will pass a fake entry. So in order to hide that theft of cash, we both will share the proceeds. So like this, collusion can happen at any point of time, which can make the control fail altogether. And sometimes those people who have implemented the controls, they themselves might override the controls also. Those people who are implemented internal controls, those people themselves might override controls also. Like for example, management. So management are the people who design the controls, and sometimes management, for their own benefits, they themselves will override the controls. Like for example, if you look at the so-called biggest scams which have happened, PNB scam, their board of directors themselves have violated the internal control system. So management who have designed the internal controls, they themselves might override the controls for their own personal benefits. And also in case of small organizations, in case of small entities, the impact of this inherent limitations is even higher. Why? Because in small entities, you will not find so many employees, so segregation of duties cannot be done there. In big organizations, thousands of employees will be there. When you have more number of employees, segregation of duties will be possible. But if you have a look at the small entities, their number of employees itself will be very limited. So if the number of employees itself are limited, it will not give enough of scope for segregation of duties. And also in small entities, the owner manager himself will have control over entire entity. The owner manager himself will have control over entire entity, so he will not show any interest in appointing new people for implementation of controls. So because of these reasons, in small entities, the chances of internal control failing are even higher. Clear? So these are the 5 inherent limitations: human decisions in human judgment in decision making, lack of understanding of the purpose, cost exceeding the benefits, collusion among the people, and limitations in case of small entities, because of which internal controls can only give you the reasonable assurance, they cannot give you absolute assurance. Clear everyone? Now let us talk about the next concept. So before that, let me ask you one simple question. See, as we all know, in the organizations, there will be hundreds of controls. So many number of controls will be there. Hundreds, thousands of controls will be there in the big organization. So assume if you are conducting audit of a so-called listed company having thousands of crores of turnover. So now in that company, if you are doing audit, you might be able to find some 150 controls working in that organization. Do you think all the controls will be relevant for the auditor? Do you think whatever controls which are there in your client's organization, will each and every control will be relevant for the auditor? The answer is no. So all the controls which are there in the client's organization might not be relevant for auditor. So whether a control will be relevant to the auditor. See, control relevant to audit means what? Should the auditor be concerned about that internal control or not? So not all controls are relevant. Auditor need not be concerned about each and every control in the organization. It will be enough if he is concerned about those controls which are relevant to audit. Sir, but how to decide which control is relevant, which control is not relevant? That depends on professional judgment, and that depends on some factors. A few factors are listed down here. As you could see here, the following are the factors which could affect whether in deciding whether a control is relevant or not. So what are that factors? It depends on materiality. It depends on significance of the related risk. What is the impact of the risk which that control is protecting? It depends on size of the entity. It depends on nature of entity's business, what kind of business your client is into. It depends on diversity and complexity of the client's operations. That means in how many number of businesses your client is actively engaged into. Sometimes it depends on applicable laws and regulations. It also depends on circumstances of each case and also nature and complexity of the systems. So like this, auditor will try to keep in mind all these factors, then he will decide whether a given internal control will be relevant to him or not. Now, after considering all these factors, if the auditor decided that an internal control is there which is not at all relevant for audit, what you should do? Nothing you are supposed to do, simply ignore it. So after considering all the factors, if you have decided that some control is not at all relevant for you, no need to worry about it. No need to waste all your time and energy there. You can simply ignore that internal control. Clear? And there are some specific reporting requirements on the auditor also, especially regarding internal controls under 143 subsection 3 clause I, which says an auditor is required to verify client's internal financial controls and express an opinion whether they are operating effectively or not. Clear? So this is what regarding controls relevant to the audit. Now the next most important topic from this particular chapter, what are the various methods for evaluation of internal control? So next topic is what are the various methods for evaluation of internal control. If you want to analyze the internal controls in the client's organization, what methods are available for you? So specifically speaking, 4 methods are available. Number 1 is narrative record. Number 2, checklist. Number 3, internal control questionnaire, and number 4, flowchart. So let us try to revise what happens in each of this method. First, we will start with narrative record. Narrative record is a complete and exhaustive description of internal control as found in the operation. Nothing but in the narrative record, what will happen is, as an auditor, first I will go and observe the internal control, what stages are involved, how many people are involved, how the goods and services are moving between the departments. So I will go and study about that. I will try to observe and get an understanding of internal control. After that, whatever understanding that I have developed, that I will try to develop a exhaustive description. Completely in a paragraphical manner, I will try to describe how the internal control is functioning. This is what narrative record is. Then talking about flowchart. In the flowchart also, what I will do is, first I will go and observe the internal control, but I will not waste my time on developing a comprehensive record. I will try to do pictorial representation or diagrammatic presentation of internal control as I have found in operation. So in the narrative record, first I will observe, I will understand. Whatever understanding I have developed, that I try to exhaustively describe. In a very comprehensive manner, I will try to describe it. Whereas in the case of flowchart, I will try to verify the control system, and after obtaining an understanding of the control, I will try to present it in a diagrammatical format. Now, between narrative record and flowchart, which one is very much time consuming? Narrative record is very much time consuming. Which one will give you briefest or concise view of presenting internal control? Flowchart. Flowchart is most concise and briefest way of presenting internal control system. And which will give better overview of the entire internal control. Better overview, even they say it will give bird's eye view of entire internal control system will be given by flowchart. It gives a better overview of internal control system. In which kind of mechanism errors can be easily spotted? In the flowchart only. Errors can be easily spotted in the case of flowchart. So narrative record is very time consuming. That will be suitable only for small entities where there is no formal control system. So there only we will use this narrative record in small entities. For big entities it is not suitable. So this is what regarding narrative record and flowchart. Now let us come to the most commonly used techniques, internal control questionnaire and checklist. Now in both these techniques, in both the methods, there will be series of questions. There will be what? Series of questions. Regarding what, sir? Series of questions will be there regarding elements of internal control system. There will be series of questions regarding elements of internal control system, and the questions will be drafted in such a manner that answer will be either yes, no or not applicable. In both the cases, they are going to contain series of questions regarding elements of internal control, and the questions will be in such a manner that answer will be yes, no or not applicable. In both the cases, the question will be prepared by auditor. I am talking about preparation. Prepared by whom? Who will prepare the series of questions? Prepared by auditor. Like if I show you one example of the questions here. So like here we have one best example. So if I want to know in the purchases area whether controls are working effectively or not, first what I will do is I will draft the questions in such a manner that answer will be yes, no or not applicable, and those questions will be related to internal controls. Example, if you see, are tenders called before placing orders? Before any purchase order could be placed, is there a system of calling orders? Are the tenders have been called? Quotations have been called, invited for. Next one. Are the purchases made on the basis of written order? Before a purchase can be made, is a written purchase order has been given? Is a purchase order form standardized? Purchase order you should follow one standard format. You should not prepare every time in a new format. Are purchase order forms pre-numbered, or all the purchase forms are containing a serial number? That too a pre-numbering should be there. And also, are the inventory control accounts maintained by persons who have nothing to do with custody of the work, receipt of inventory or inspection of inventory? Nothing but our inventory records are maintained by those people who doesn't have any control over inventory. Nothing but simply segregation of duties. So like this, in whatever area I want to evaluate controls, their auditor will prepare series of questions regarding the elements of internal control system. And how the questions will be drafted? In such a manner that answer will be yes, no or not applicable. So then what is the difference between the two, sir? In both the cases you have told similarities only. And the difference here now is, in the case of checklist, these questions will be answered by auditor's staff. In the case of checklist, these questions will be answered by auditor's staff, whereas in the case of internal control questionnaire, these questions will be answered by management's staff. That is, client's management or client's staff will answer the questions. That is the only point of difference. Like if I prepared all these questions, called my article assistant and gave a printout of these questions and told him, dear article assistant, go to the purchase area, get back to me with the answers. Here, whom I am expecting them to answer? My own auditing staff. So that will be a case of checklist. On the other hand, I have prepared these questions, taken a printout, gone to the management, gave it to them. Sir, please give me the answers to these questions. Now, whom I am expecting to fill back the answers? The client's management or staff. So that I call it as internal control questionnaire. So depending on who is going to answer the questions, we will decide whether it will take up the form of checklist or it will take up the form of internal control questionnaire. Clear? So these are the four most popularly widely used methods for understanding or evaluation of internal control system. Now, one more small important concept. Sir, if you evaluate internal control system, what benefits will be there? Why we need to understand internal controls, sir? Or how the auditor will be benefited by understanding about client's internal control system? Like a few benefits are given here. Number one, by understanding internal controls or by evaluating internal controls, as an auditor, you will come to know whether the client is having adequate internal control system. Why? Because as we all are aware, depending on effectiveness of internal control, we will try to determine nature, timing and extent of substantive audit procedures. So that's why evaluation of internal control, one of the direct benefit is, as an auditor, you will come to know whether your client is having adequate internal control system. And also you will come to know whether there is an effective internal audit department in the organization, whether the internal audit team in the company is working effectively or not, you will come to know. And you will come to know whether entities assets are properly protected, safeguarded. And you will also come to know whether management is properly discharging their functions of recording transactions in a proper manner. And you will make an assessment, whatever records which you are getting from the management, how reliable they are. And even on the basis of that understanding of internal controls, you can determine extent and depth of audit procedures you need to carry out. Simply, if I have to put it, nature, timing and extent of audit procedures. And you can also form a conclusion regarding which audit technique will be suitable for which area. Like if the risk is very, very high, there I want most effective audit evidence, I will go for reperformance. If the risk is very, very low, I want that audit method which can be completed in less time, I can go for inquiry. So like that, which audit technique will be suitable for which item of financial statements, that also can be decided on the basis of understanding of internal control. And also you will come to know in which areas the controls are weak, and if at all, if you find any weaknesses, you can give suggestions to the management so that they can make that changes to the control system, and from that they can betterly run their activities in the organization. So by evaluation of internal controls, all these things will be possible. All these advantages will be there. Now talking about few more concepts, this question number 9 also we can understand what is the purpose of test of controls and what will be included in the test of controls. We all know test of controls is nothing but other name for compliance procedures. And you tell me, what is the purpose of compliance procedures? The purpose of compliance procedures is to know whether the internal controls are designed and operated in such a manner that they are able to prevent, detect or correct the misstatements in a timely manner. That's all. That is what the main purpose of test of controls. No, why do we perform compliance procedures? To know that whether the internal controls which my client has designed, whether the internal controls which my client has implemented, all those internal controls are working effectively. Working effectively means what? Working effectively means those internal controls should be able to prevent or detect a fraud or error from happening. And whether these internal controls are working throughout the financial year or not. These internal controls are effective, but they should not be effective just at only one point of time. They should function effectively throughout the financial year at not just one point of time. And talking about what is included in internal control system, once again here, out of the 7 methods for performing audit procedures, what methods can be suitable for performing test of controls, which will be included? As we all know, 7 methods are inquiry, once again I am listing it out, inspection, observation, external confirmation, recalculation, reperformance, analytical procedures. We need to find out of these 7 methods which one will be suitable. Number 1, inquiry can we do? Yes, we can do inquiry, and by doing that inquiry, we will get to know whether controls are working effectively or not. Can we do inspection? Yes, we will read the documents relating to internal controls, like internal control manuals, standard operating procedures will be there. You can read that to know whether controls are working effectively or not. Can you observe? Yes, I can do observation also. Can you do external confirmation? No, internal controls is an internal matter. You can't rely on external confirmation there. Recalculation, by doing some calculation, will you find out controls are working effectively? No. Can you do reperformance? Yes, I can do it here. By performing an activity which is performed by internal control already. An activity is getting performed by internal control. Auditor will do it once again manually to determine whether the control is working effectively or not. Yes, auditor can use the method of reperformance also, but analytical procedure is not suitable. By studying relationship, we can't evaluate controls are effective or not. So out of the 7 methods which we have for performing audit procedures, 4 are suitable for performing test of controls: inquiry, inspection, observation and reperformance. Clear? So this is what regarding test of controls. Now let us talk about few more important concepts from this particular chapter. Components of internal control. The next thing which we need to concentrate is what? Components of internal control. So any internal control to function effectively, it must have 5 components. So what are that 5 components? Number 1 is control environment. So let me take you to that question. What are the 5 components of internal control system? Yes, here. So there are 5 components of internal control system, which are going to be: number 1, control environment; number 2, entities risk assessment process; number 3, information system including related business process; number 4, control activities; and number 5, monitoring of controls. So I will quickly revise what is included in each of this component. So how many components will be there for internal controls? 5 components. What are they? Control environment, entities risk assessment process, information system including related business process, control activities, and monitoring. Now what happens in each of this activity? Talking about control environment means the first step in implementation of internal control is creating a good culture of honesty and ethical behavior in the organization. If you are implementing internal control in the organization, and if you want internal control to function effectively, the first important component is you should have a good culture of honesty and ethical behavior in the organization. If you don't have a good culture in the organization, no matter how effectively you design and implement internal control, those internal controls will not give you expected results. So if you want to make sure that control should function effectively, the first step in the internal control system is creating a good control environment, creating a culture of honesty and ethical behavior in the organization. And who is responsible for creation of honesty and ethical behavior? Management. And how they will implement it? By communicating good ethical values. At the time of recruiting the people, they should show competence to commitment. That means they should always recruit only those people who are committed to improve the organization. Management should have good philosophy. They should have good approach for taking risk. They should follow good attitude towards financial reporting. And those charged with governance should involve more. So like this, by taking all the steps, the management can create a good control environment. So once good control environment is created, the next component is entities risk assessment process, which means, see, internal controls organization will implement to prevent mistake from happening. But before a control can be implemented, first management should know in which areas of the organization they are having risk. Like the way auditor will perform risk assessment procedure to identify risk, no? Similarly, management also will try to understand about their entity and environment in a detailed manner to find out which area is a risky in organization, which area is not risky in the organization. So management should study about their organization and find out in what areas there is a chance of happening of misstatement. This we call it as risk assessment process. After that, information system including related business process, which means this third step involves procurement of all the resources required. As I have mentioned earlier, if you want to implement internal control, you need a lot of resources, physical resources, labor resources, capital resources. You require a lot of resources. So in the third step, the management will try to procure all the resources, whatever they want for implementing internal control. Next one, control activities, nothing but here we need to actually implement the controls. Just having a control in our mind alone will not be enough. We need to actually implement the same. So control activities is the stage where policies will be actually implemented in the organization. And just implementing the controls alone will not be enough. Those controls are required to be monitored also. What we need to do to that controls? We need to monitor whatever controls that we have implemented, whether that controls are working effectively or not. Those monitoring activity, that review process also should happen effectively. So like this, there are 5 components of internal control system: control environment, entities risk assessment, information system including business process, control activities, and even monitoring of controls. Clear? So these are the 5 components of internal control system. Now I will revise one more last topic from this particular chapter, which is the difference between internal financial controls and there is a concept called internal financial controls over financial reporting. Very important question. It is one of the past examination question also. Listen carefully. So there are 2 aspects, two concepts are there. One is internal financial control. IFC means internal financial control. And the other one is internal financial controls over financial reporting. Now first we need to understand what is internal financial control, what is internal financial controls over financial reporting. See, the term internal financial controls is nothing but internal controls only. The term internal financial controls is nothing but the term internal controls only. Like if you take internal controls, the internal controls is the term defined in SA 315. How it was defined? Internal control refers to any policy or procedure which fulfills 4 objectives. The same definition was given in the Companies Act also, but the term used there is internal financial control. Definition for both is same. Any policy or procedure implemented by management or those charged with governance to safeguard the assets, to prevent frauds and errors, to increase the reliability of financial reporting, to ensure compliance with laws and regulations, and also to ensure efficient and effective conduct of business. In both the cases, definition is same. But internal controls is a term used in the standards. Internal financial controls is a term used in the Companies Act. But concept wise, definition wise, both are same. So internal financial controls and internal controls both are actually same. So internal financial controls are nothing but internal controls, and internal financial controls might be related to so many objectives. Some internal financial controls may be related to safeguarding of the assets. Some may be related to prevention of frauds and errors. Some may be related to increasing the reliability of financial reporting. Some may be related to compliance with the laws and regulations. So like this, internal financial controls will have various objectives. They tend to fulfill multiple objectives. But out of that, those internal financial controls which are exclusively related to reliability of financial reporting, they will be called as internal financial controls over financial reporting. They will be called as what? Internal financial controls over financial reporting. Once again, listen carefully. Internal financial controls will have various objectives. They might be related to safeguarding of the assets. They might be related to prevention of frauds and errors. They might be related to reliability of financial reporting. They might be related to compliance with the laws and regulations. Nothing but same like internal controls only. But out of all those internal financial controls, whatever controls are there which are related to reliability of financial reporting, they will fall under internal financial controls over financial reporting. Let me give you one example. Having a CCTV camera. Is it an internal financial control? Yes, it is safeguarding the assets. But it is not an internal financial control over financial reporting. Why? Because it is not directly related to financial statements preparation. Let me give you one more example. Appointment of security guards. So security guards, is it an internal financial control? Yes. Why? Because it is safeguarding asset. Is it an internal financial control over financial reporting also? No. Why? Because it is not directly related to financial reporting. Next one, segregation of duties. Like accountants' responsibilities are separate, cashier's responsibilities are separate. Is it an internal financial control? Yes. It will be an internal financial control over financial reporting also. Why? Because by segregating the duties, accounting entries become more reliable, more trustable. So internal financial controls over financial reporting is a subset of internal financial controls. Internal financial controls over financial reporting is a subset of internal financial controls. So if I have to present it in much more simpler terms, assume internal financial controls means an entire set of controls. This is an entire universe of internal financial controls. In that, internal financial controls over financial reporting is one of the small subset. This entire bigger set is internal financial controls. Now in that, one of the small subset is internal financial controls over financial reporting. Apart from this, internal financial controls over financial reporting, internal financial controls include various other controls also, which will be safeguarding the assets, which might be related to prevention of frauds and errors, which might be related to compliance with the laws and regulations, which might be related to efficient and effective conduct of the business. Like that, one of the subset is internal financial controls over financial reporting. Understood everybody? Hope I made this point clear. Very important. I have a gut feeling that this might be tested in the examination. Clear? So internal controls versus internal financial controls. Sorry. Internal financial controls versus internal financial controls over financial reporting. Hope everybody is clear with this two terms. Internal financial controls contains multiple objectives. Out of that, one of the objective is increasing the reliability of financial reporting, and these will come under internal financial controls over financial reporting. So internal financial controls is a very broad term which includes a variety of the controls. In that, one of the subset is what? Internal financial controls over financial reporting. Clear? So I have given this as a question at the end of the chapter so that you can refer it here. Clear? Next one. And one more thing, sir, why you explain this internal financial controls versus internal financial controls over financial reporting? Why this understanding is very important? Why? Because at some point of time we have seen that under 143 subsection 3 clause I, auditor is required to report on internal financial controls. But I will change my statement here. Under 143 subsection 3 clause I, the auditor is not required to report on all internal financial controls. The auditor will be required to report only on internal financial controls over financial reporting only. So please make this point clear, conceptually very important. Under 143 subsection 3 clause I, auditor is required to report? No, he will not required to report under all the internal financial controls. He will be required to report only those internal financial controls which are related to financial reporting under 143 subsection 3 clause I. Clear? Next. One more question, guys. With one more question, we will complete the revision of this chapter. Then we will start with the remaining chapters. So that one more question is also nothing but what are the functions of internal auditor? If in the client's organization, there is a department of internal audit, what will be the functions of that internal auditor? What internal auditor is supposed to do? So like external auditor, internal auditor will not have only checking of financial information. He will have various other activities which are forming part of his scope. Like number one, he need to evaluate internal controls. As an internal auditor, you will be given with the responsibility of evaluation of internal controls. You have to find out whether internal controls are working effectively or not. Not just finding out the weaknesses, you need to report it to the management. Not just reporting it to the management, even you should give recommendations for improving the internal control system, which external auditor will never do. But being an internal auditor, as we all know, the objective of the internal auditor is not just to express an opinion. The objective of the internal auditor is to add value to the organization. So internal auditor will verify controls, find out the weaknesses, report it to the management, and even he should give recommendations for improvement also. So in that manner, internal audit function will try to provide assurance to the management regarding internal control system. Apart from that, internal auditor, like external auditor, he will also try to verify financial information. Nothing but whether the financial statements are giving true and fair view, whether the books of accounts are correct or not. Like that, whatever external auditor is verifying, that examination of financial information, that will even form part of scope of internal auditor also, verification of financial information. And even auditor will verify operating activities, not just financial activities. Internal auditor will even verify other operating activities also, like manufacturing activities, marketing activities. That non-financial activities also will be verified by internal auditor. And even internal auditor will try to make sure that all the laws and regulations are complied with. So these are all various functions which could be included in the internal auditor scope broadly for evaluation of internal control, checking of financial information, checking of operating activities, and finally checking the compliances with laws and regulations. Clear? So this is what the chapter risk assessment and internal control. We are successfully done with that. So now we are going to take up the revision of 4 such chapters which are actually very small in size but compulsory question from all these 4 chapters which we are going to revise now. And the 4 chapters which we are about to revise now, there are chances that from those 4 chapters put together in the examination there could be a weightage of 14 to 16 marks. So what are that 4 chapters which are actually very small in size and at the same time very much important from the examination perspective, that to a compulsory question from all these 4 chapters. So the first chapter is fraud and responsibilities of auditor. So we'll be revising first fraud and responsibilities of auditor. Then we will revise audit in an automated environment. This we will take it up further. And after that, audit sampling. And once we are done with this audit sampling, then we will take up analytical procedures. So these are the 4 chapters which I was saying, very small in size, easy content, limited number of questions, but that to a compulsory question. So without any delay further, I will take you through the contents of the chapter fraud and the responsibilities of auditor. So first, let us try to define the term fraud, how the term fraud has been defined. So the term fraud has been defined something like this. It is an intentional act by one or more individuals among management, those charged with governance, employees or third parties. So fraud is an intentional act which is committed by either one employee or more than one employee more than one individual or more than one individual, and those individuals who are committing this intentional act, they could be from the management, they could be from the those charged with governance, they could be from regular employees, and even they could be from third parties. And this intentional act involves the use of deception. This intentional act involves the use of what? Deception. Deception means what? Cheating the organization. And why they are doing this deception is to obtain an unjust or illegal advantage. Unjust or illegal advantage. So this is how the term fraud has been defined: an intentional act by one or more individuals among the management, those charged with governance, employees or third parties, involving the use of deception. It involves cheating the organization. For what purpose this deception is carried out? To obtain an unjust or illegal advantage, to get some advantage which they are not entitled to, which they are not legally eligible for. So such an act we call it as fraud. And as we all know, a misstatement in the financial statements can happen from either fraud or error. And the differentiating factor between these two forms of misstatements is underlying intention behind it. So fraud is something which is always done intentionally, whereas error is something which will be done unintentionally. So like this, fraud is an intentional act. Now, talking about kinds of fraud, a fraud in the financial statements can be committed in two ways. Number one is fraudulent financial reporting, and the other one is misappropriation of assets. Fraud can be broadly divided into two categories. One is fraudulent financial reporting and the other one is misappropriation of assets. The name itself says fraudulent financial reporting. It refers to such a kind of fraud where the information conveyed in the financial statements is wrong. Management is trying to convey wrong financial statements, wrong financial information they are trying to project through the financial statements. That kind of fraud we call it as fraudulent financial reporting. Very simple to understand. Financial reporting means the process of preparation and presentation of financial statements. Fraudulent financial reporting means the management is trying to prepare and present the financial statements in such a manner that they are fraudulent. Nothing but conveying wrong information through the financial statements. Does conveying wrong information through the financial statements also will come under fraud? Yes. Why? Because there are so many users who are going to base the decision on the basis of financial statements. If the management is trying to convey wrong information through the financial statements, they are going to affect all the stakeholders' decisions. So that's why showing wrong picture through the financial statements is also a kind of fraud, which we call it as fraudulent financial reporting. There is other name for fraudulent financial reporting. We can also call it as manipulation of accounts. The name itself says. So what is the other name for fraudulent financial reporting? Manipulation of accounts. This refers to such a kind of fraud where accounts are getting manipulated, where books of accounts and financial statements are getting manipulated. Now talking about misappropriation of assets, it includes those kind of frauds which involves theft or damage to the entity's assets. Misappropriation of assets means what? It refers to such a kind of fraud where there is a theft or damage to the entity's assets. When I say theft or damage to the entity's assets, assets could include current assets, assets could include fixed assets, assets could even include intangible assets or intellectual properties also. If by way of any fraud, if entities' assets are getting stolen, if entities' assets are getting damaged, if entities' assets are getting misused, that we call it as misappropriation of assets. So like this, the fraud can be divided into two categories. One is fraudulent financial reporting and the other one is misappropriation of assets. Another name for fraudulent financial reporting, manipulation of accounts also we do call it. And the term fraud is a very broad term. It includes everything which is committed intentionally to cheat the organization. But do you think auditors should be concerned about each and every fraud happening in the organization? The answer is no. The auditor need not get worried about each and every small fraud happening in the organization. The auditor should be concerned about only those frauds which causes a material misstatement in the financial statements. Auditor need not get concerned about each and every minute fraud which is happening in the organization. It will be enough for the auditor if he is concerning himself about those frauds which have a potential to cause a material misstatement in the financial statements. Now talking about responsibility related matters. Who is responsible for prevention and detection of frauds? Who is responsible? Now this responsibility we can divide into two categories: primary responsibility and secondary responsibility. See, the primary responsibility for prevention of frauds and detection of fraud both rest with the primary responsibility is always with management and those charged with governance, who is primarily responsible to ensure that there are no frauds happening, and if at all frauds have happened, to detect that frauds, it is whose primary responsibility? It is the primary responsibility of management and those charged with governance. So management and those charged with governance are primarily responsible to ensure that frauds does not happen and also to detect the frauds. Whereas to what is auditor's responsibility, I will say auditor's responsibility is something secondary, which means, as we all know, auditor's primary responsibility, never we read that auditor is responsible for finding out frauds, auditor's objective is to find out frauds. Did we say this anywhere? No. So auditor's primary responsibility is to obtain reasonable assurance and to express an opinion on the financial statements. That is what the main objective of the auditor. We never said that auditor's primary responsibility is to find out frauds and errors. But everywhere we are saying that the primary responsibility of the auditor is to obtain reasonable assurance and express an opinion on financial statements. So auditor's primary responsibility is to express an opinion. And also the risk of not detecting a misstatement from fraud is higher than risk of one not detecting from error. So these kind of tricky sentences they might ask you in the examination. So for true or false statements, these kind of things are very important. So let me show you a few statements which are very, very important here. So as you could see here, the risk of not detecting a material misstatement resulting from fraud is higher than risk of not detecting one resulting from error. Very simply, if I have to put this statement, what they are trying to say is fraud is difficult to detect than error. We all are aware of it, but they try to complicate the sentence. So what they're saying, indirectly they're saying the risk of not detecting, that means the chances of missing out a fraud is higher than chances of missing out an error, obviously. So if I put it in simple terms, fraud is difficult to detect than error. But see the way they are framing the sentence. Now in exam, they will try to ask multiple kind of true or false statements. Let me ask you one question. Please listen carefully and answer whether that statement is true or false. The risk of not detecting a material misstatement resulting from error is lower than the risk of not detecting one resulting from fraud. Do you agree with that? Obviously. So just I have made changes at both the places. I brought this error forward and I changed this higher to lower. So even if they say the risk of not detecting a misstatement resulting from fraud is higher than risk of one not detecting from error, or if I alternatively put it, the risk of not detecting a material misstatement resulting from error is lower than the risk of one not detecting from fraud, both are conveying same meaning, no? So you have to be very cautious about these complex sentences. They have a high chances of getting listed in the form of true or false statements. And in the fraud also, the risk of not detecting the management fraud is higher than risk of not detecting an employee fraud. If the employee has committed a fraud, more or less it can be easily found out. But if the top level management themselves are involved in the fraud, it becomes extremely difficult for the auditor. So fraud is difficult to detect than error. In the fraud also, management fraud is difficult to detect than employee fraud. Then, and also whether auditor will be able to detect a fraud or not, it depends on so many factors. It depends on factors like skillfulness of the perpetrator, nothing but skillfulness of the person whoever is committing the fraud. If the person whoever is committing the fraud, if he is very skillful, the fraud becomes very difficult to detect. If the person whoever is committing the fraud, if he is less skillful, the fraud will be a bit easy to detect. And it also depends on other factors like frequency and extent of manipulation, how frequently the fraud is committed. More the frequency, higher will be the chances of detecting it. Degree of collusion involved, so many number of people, if they get involved, more chances for not detecting a fraud. And also relative size of individual amounts getting manipulated, in what amounts the frauds are getting committed. All of a sudden a very big amount of fraud was committed, easy to detect. Why? Because materiality, it will be very material, it will get auditors attention. If the fraud is happening in small items, difficult to detect. And also it depends on the seniority of those individuals who are involved. So like this, whether an auditor will be able to detect a fraud or not, that depends on these many factors: skillfulness of the perpetrator, frequency with which the fraud is committed, and what level of collusion is involved, what is the size of the amounts getting manipulated, and also seniority of the persons who are involved in this fraud. And finally, coming to the conclusion, whether auditor will be held responsible for non-detection of fraud. We can't directly make a comment. So what we should say here is auditor will be held responsible or not. That will depend on whether auditor acted or behaved properly or not. Which means if I put it in simple terms, the responsibility for not detecting a fraud will be there on the auditor only if he has not exercised reasonable care and skill during the audit. When the responsibility will be there on the auditor for not detecting a fraud only when he has not exercised reasonable care and skill, which means if the auditor has behaved negligently, then only auditor will be held responsible. Sir, who has to prove, sir, whether auditor acted negligently or auditor behaved sincerely? Who has to prove this? No one else will come and prove that for you. As an auditor, you yourself have to prove this. Sir, how will I prove this, sir? Will I go and swear? Will I go and make a promise there, sir? Mummy promise I did the work sincerely? No. You have to prove it with the help of documentation. So with the help of documentation, if the auditor was able to prove that he has done the work sincerely, but still he was not able to find out the fraud because of inherent limitations, then he will be spared. If he was not able to prove this with the help of audit documentation, then he has to face the consequences. Clear? So this is what the entire responsibility related matters are. Understood, everybody? Now talking about few more concepts regarding this fraud. You take any fraud, either fraudulent financial reporting or management committed or misappropriation of assets. For any fraud to happen, there must be three things present. So that is what the question is here. Explain the instances which induce management or employees to commit a fraud. What causes the management or employees to commit a fraud? So for any, I will say for any fraud to happen, three things must be present. Number one is pressure or incentive. Number two is opportunity. Perceived opportunity should be there. Number three, rationalization or attitude of individuals. So if any fraud has to happen, either that could be fraudulent financial reporting or misappropriation of assets. Either that could be fraud committed by management or that could be fraud committed by employees. For any fraud to happen, these three things must be present. What are they? Number one is pressure to commit a fraud. Number two, opportunity to commit a fraud. And number three, rationalization. See, always a fraud starts with pressure. Like if the management is trying to convey wrong picture to the financial statements, why they will do it? Might be they are going through pressures from outside or inside the entity. And just having a pressure alone will not be enough. That pressure should be supported by opportunity also. No matter how much pressure you have, if there are strong internal control system, if there is not even a single opportunity for committing a fraud, fraud will not happen. So having pressure alone will not be enough. That pressure should be supported by opportunity also. And not just a pressure and opportunity, you should have such a attitude among the people who are ready to rationalize, justify their wrongdoing. Such a bad attitude is also required. People should have bad attitude to rationalize. Rationalize means what? To justify their acts. So if the persons are having bad attitudes to justify their wrongdoings, then only fraud will happen. So for any fraud to happen, these three things must be present. Pressure to commit fraud, opportunity to commit a fraud, and rationalization, attitude to justify their wrongdoings should be there. Next. So talking about the next few more, now we will discuss about few questions regarding exclusively fraudulent financial reporting. So now why fraudulent financial reporting will be committed? Why the need arises for the management to show the wrong picture through the financial statements? As we all are aware, fraudulent financial reporting means conveying wrong information through the financial statements. Because of what reasons or what causes the management to show wrong picture to the financial statements? Very simple. They have given here four reasons. One of the main reason why management will try to show wrong picture to the financial statements is to avoid the taxes. Every company wants to make big amounts of money, but actual pain comes when they have to make the payment of taxes. So most of the companies will do fraudulent financial reporting to avoid the payment of the taxes. Or some companies want to declare a dividend even though there are insufficient profits. There are insufficient profits, but still management wants to declare dividend. Now what they might do is they will inflate the profits and declare the dividends. So that could be one reason. And in some cases, to withhold the declaration of dividend when there is a adequate profit. Sometimes there will be enough of profit, but management doesn't want to declare the dividend. So in that cases, what they will do is they will understate the profits and withhold the declaration of dividend. And whenever managerial remuneration is linked with the profits of the company, like today it is quite common, CEO drawing his salary as a percentage of profits. So if the managerial remuneration is linked with the profits of the company, the management, for the purpose of getting higher remuneration, they will try to inflate the profits. So these are the four main reasons why management will commit fraudulent financial reporting. What are the four main reasons, guys? To avoid the incidence of taxation, for declaring dividend when there are insufficient profits, for withholding declaration of dividend when there are sufficient profits, and for receiving higher remuneration when managerial remuneration is linked with the profits of the company. Next, so we have understood why it will be committed. Now let us try to understand what are the ways for committing it, how it can be committed. So ways for committing fraudulent financial reporting, nothing but how fraudulent financial reporting will be committed. See, simply if you want to show wrong picture through the financial statements, like if you want to show higher profits, how you can inflate the profits? How we can simply inflate the profits is either we can increase revenue or we can decrease expenses. This is how we can inflate profits of the company. On the other hand, if you want to decrease the profits, how we can decrease the profits? Either reduce the incomes or increase the expenses. And simply by playing with the value of the inventory also, we can achieve whatever profits we want to do. So one major way for committing fraudulent financial reporting is inflating or suppressing, over reporting or under reporting. What you can inflate or suppress? You can inflate or suppress purchases and other expenses. We can play with sales and other items of income, and even the management can play with closing inventory value, closing stock value also. Why? Because closing stock value is going to have a direct impact on profits of the entity. And also sometimes management, in order to show wrong picture, they will not adjust outstanding liabilities. That means they will not create a provision for the outstanding expenses. Sometimes they will not do proper adjustments for the prepaid expenses. They will recognize future years expenses also in the current years in order to understate the profits. So this is also one way. Or intentional misapplication of accounting principles. They try to intentionally misapply accounting principles. Like what? Charging capital items to revenue or revenue items to capital. So like this, they can play with accounting principles, or sometimes they can do misrepresentation or intentional omissions. Omissions they will do. They will altogether don't record the entries in the books of accounts only. So these are the various ways for committing fraudulent financial reporting. Now, what specific techniques management will adopt for overriding the controls to commit the fraudulent financial reporting? So previous question was, what are the ways for committing fraudulent financial reporting? Now they are specifically talking about what techniques management will follow to overcome the controls in the organization for committing fraudulent financial reporting. Nothing but how management will try to achieve that objective of fraudulent financial reporting. Very simple. They will try to give a few scenarios here, like they can record fictitious journal entries. Nothing but they can record fake journal entries. Like if they want to increase expenses, how the management can increase expenses? By recording fake entries. If the management want to increase sales, how they can do it? By recording sale entries, fictitious, fake sale entries, dummy sale entries. Or inappropriately adjusting assumptions. Or what management can do is they can play with assumptions. Wherever 50% provision is required, they will create 100% provision. Or in some cases, higher amount of provision will be required, but they will create lesser amount of provision. So they can play with the provisions. And also they can omit, advance or delay the recognition in the financial statements. They can even, what they can do, they will omit, they will not altogether record the entries in the books of accounts. They will advance the recognition. That means prepaid expenses also they will recognize in the current year. Or they will delay the recognition. Delaying recognition means they will not create provision for outstanding expenses. Similarly, concealing or not disclosing facts. See, not just conveying wrong information, even if you hide the correct information, that is also a fraudulent financial reporting only. Not just presenting wrong information, even if you try to hide the genuine or correct information, that is also fraudulent financial reporting. Or sometimes company might engage in complex transactions, very complex transactions, which are very difficult to understand. Sometimes company will engage in very much complex transactions which are very difficult for a common man to understand. That is also one of the technique for committing fraudulent financial reporting. And finally, they can do alteration, that is changing of the terms and conditions relating to unusual transactions. So these are all the various techniques by which management can override the controls to commit fraudulent financial reporting. So 3 questions we have seen regarding fraudulent financial reporting: why they will be committed, what are the ways for committing it, and what are the techniques for committing it. Now coming to next kind of fraud, which is misappropriation of assets. So they are asking us to write about misappropriation of assets in a detailed manner. As we all are aware, misappropriation of assets means it involves that kind of fraud where there is a theft of entities' assets, damage to the entity's assets, stealing of the entity's assets is happening. And whenever I say entities assets, I am not just referring to fixed assets, it could even include current assets also. So any asset, even stationery is also an asset. So theft of entities assets, damage to the entities assets, that kind of fraud I call it as misappropriation of assets. And misappropriation of assets can be committed in variety of ways. In various ways misappropriation of assets can be committed. What are they? Number one, embezzling the receipts. Embezzling receipts means what? Not accounting for the receipts. Like a cashier has made 100 cash sales, but he recorded only 50 cash sales. 50 cash sales related money he has kept in his pocket. So embezzling the receipts, not recording the receipts fully, that is one way for committing misappropriation of assets. Or even stealing physical assets or intellectual property. Or there might be a theft of physical assets, like stationery is stolen, fixed assets are stolen, or electronic equipments are stolen. Or even intellectual property also can be stolen. What do you mean by intellectual property? Intangible assets. Like a software company working on development of new program, and one of the software engineer there, one of the employee there, he shared that program, the code of the program with the competitor. That is also theft of asset only. Or a pharmaceutical company doing a research on development of a new drug, the scientist working there has went and disclosed that formula for the medicine with the competitor before they can acquire patent. Once again, misappropriation of assets. So stealing of physical assets or even stealing of intellectual property also, intangible assets also can happen. Or causing an entity to pay for goods and services not received. Or even some employees, sometimes they might submit fake bills, fake invoices, and cause the company to pay for the goods and services which are not received. And finally, if the entity is using an assets for personal purposes, entities assets are getting used for personal purposes. Company has given some asset to the board of director, like a car, to use it for official purposes, but he is using that car to go on a family vacation every weekend. So this is using an entity's assets for personal purposes. This is also misappropriation of assets. So in these various ways, misappropriation of assets can be accomplished. Then even this statement is very important. In one of the examination, they have given this as a true or false statements. So what question they have tested is, so first let us try to understand general statement here. Misappropriation of assets is often accompanied, is often joined with false or misleading records or documents in order to conceal the fact that assets are missing or have been pledged without proper authorization, which means sometimes misappropriation of assets will happen, but that will be supported by misleading records also. Changes in the entries in the books of accounts also will be made to hide the fact that either assets are misappropriated or they have been pledged without proper authorization. Now in one of the examination, they have tested this question, and in the question true or false statements, they just replaced one word here. Without has been replaced with the term with. Without has been replaced with the term with, and entire sentence has been given as it is. So will the given statement be true or false? The given statement will be false. Why? Because it is required to hide when assets are pledged without proper authorization. If the assets are pledged with the proper authorization, how that will come under misappropriation of assets? So you have to be very cautious, guys, when reading the true or false statements. Never ever answer MCQs or true or false statements without giving a reading minimum twice. Minimum twice you have to read the question, then only you have to answer it. Now talking about next few things, defalcation of cash. One of the main asset which is prone to misappropriation is cash. And what are the various ways for misappropriation of cash? Very simple. There are two broad ways for misappropriation of cash. If you want to misappropriate the cash, there are only two broad ways available. One is either you have to inflate the payments, either you have to increase the cash payments, or the other thing is you have to suppress the cash receipts. Any one of this thing you have to do. Either you show higher payments or you suppress the receipts. These are only the two broad ways for committing misappropriation of cash. Now they have told approaches how we can inflate the payments, how we can suppress the receipts. So for inflating cash payments, there are various ways, like by submitting fake bills, fictitious vouchers, or sometimes a bill will be genuine, but in that amounts will be inflated. Bill will be genuine bill only, but in that amount will be inflated. Or sometimes wage rolls will be manipulated, wage sheets will be manipulated to include the names of dummy workers. or sometimes doing a larger total of petty cash expenditure when they are getting transferred to the main cash expenditure. So these are the various ways for inflating cash payments, and even there are giving us various ways for suppressing cash receipts. And one important thing here to understand is one main technique for suppressing the cash receipts is teaming and leading. So what is this teaming and leading error? Sorry, teaming and leading kind of misstatement, fraud. So in teaming and leading, what will happen is, assume that there is one company, it is having some debtors, regular debtors are there. So one fine day, a debtor Mr. A paid some 1 lakh rupees to the cashier. Mr. A debtor has paid 1 lakh rupees to the cashier, but the cashier misappropriated it. He did not record it in the books of accounts. Now A's account will still show outstanding amount of 1 lakh rupees. Now if this entry was not passed, this account will show overdue after a certain period of time. And when an account shows overdue for a longer period of time, it will get the management's attention. A paid the money, but the cashier misappropriated. He did not record it. So A's account will show overdue. If it remains overdue for more number of days, it will generally go to management's attention. The moment it goes to management's attention, what management will do? Management will communicate with the debtor directly. Boss, your account is outstanding. Why you did not pay the money? Now what the debtor will say? No sir, I have already paid the money. Now who will get caught? Cashier will get caught. Now what cashier will do is, in order to avoid this account as getting overdue, in order to avoid this account going to the attention of management, subsequently he received the money from customer B, but instead of recording it in the B's account, he recorded it in the A's account. Now A's account will not show overdue, it will not go to management's attention. But you will get doubt now, sir, B's account will show overdue after certain period of time. Now what he will do is, he will get amount from another customer, 1 lakh rupees, that he will not record it in the C's account, that he will record it in the B's account. Now once again same question, sir, this account will show overdue for a more period of time. No sir, but by the time what he will do is, some other amount received from another customer, he will adjust it here. So like this, the cashier will keep on doing the manipulations so that this will not come to management's notice, and one fine day will come where even a cashier himself will be confused what is the exact amount to be received from each of the debtor. So this is what we call it as teaming and leading, where amount received from one customer will be misappropriated, and to prevent this detection, amount received from another customer will be recorded in the first customer's accounts. So like this, it will keep on get happening. So this is one technique for suppressing the cash receipts. Not just that, we have various other techniques also. Adjusting unauthorized or fictitious rebates. That means without any authorization, you are offering discounts and rebates to the customers. Or writing off as debts in bad, which has in respect of which amount has already been received. That means cashier has already received money from the debtor, but he is still going and writing off that debt as bad. Or not accounting for cash sales fully, or hiding the cash sales simply. Not accounting for miscellaneous receipts, or writing down the value of assets in entirety, selling them and realizing the money out of it. So these are the various ways for suppression of the cash receipts. Now talking about few more important concepts from this particular chapter. The next important concept which we will take up is fraud risk factors. So now what are these fraud risk factors? So fraud risk factors means these are SA 240 actually. SA 240 is a relevant standard which is talking about fraud and responsibilities of auditor. See, SA 240 has tried to help out the auditor by giving examples of some events or conditions which indicate an opportunity to commit a fraud, which indicate an pressure to commit a fraud, or which indicate an attitude to commit a fraud. What SA 240 is trying to do? SA 240 is trying to help out the auditor. How it is trying to help out the auditor? By giving some examples of events or conditions which if auditor has come across, he will get a hint, that is an indication that there is a possibility for, there is an indication that there is a pressure for committing fraud, or opportunity for committing fraud, or there is a attitude for committing a fraud. So examples of such events or conditions which indicate to the auditor pressure, opportunity or attitude to commit the fraud, that events or conditions have been given specific name under SA 240. They are called as fraud risk factors. They are called as what? Fraud risk factors. Like if you read the definition here, fraud risk factors may be defined as events or conditions that indicate, that give a hint to the auditor that there could be an incentive or pressure to commit a fraud, that there is an opportunity to commit a fraud, that there is an attitude to commit a fraud. This hint will be given to the auditor. Those events or conditions has been given specific name. What do we call that? Fraud risk factors, we do call it. What do we call it? Fraud risk factors, we do call it. But one important observation here, just because you come across fraud risk factor, just because you came across, see, we will have two questions talking about this fraud risk factors. Like you could see here, question number 11, if you observe. So in this completely, some examples of events or conditions are given which indicate fraudulent financial reporting, which say that there is a possibility of fraud happening. So like this, so many examples of fraud risk factors are given in the standard. That doesn't mean the moment you come across fraud risk factors, you will immediately jump to the conclusion that there is compulsorily a fraud in the company. No, you should not do it. Just because you come across a fraud risk factors, that doesn't indicate that compulsorily fraud has happened. No, that is completely wrong. Fraud risk factors will just give a hint to the auditor that there is a possibility of fraud. By this, auditor should become cautious, do further audit procedures and find out whether there is really a fraud or not. Just because auditor come across fraud risk factor, that doesn't indicate that compulsorily there is a fraud. That is just a indication, so that auditor will become alert and he will try to do further investigation and find out whether fraud has actually happened or not. And one more thing, what this standard has done is, this standard has identified fraud risk factors for misappropriation of assets separately. It has given fraud risk factors for fraudulent financial reporting separately. So what the standard has done, what SA 240 has done, it has identified fraud risk factors for fraudulent financial reporting separately, for misappropriation of assets separately. And under each category of fraud also, fraud risk factors are further divided into three categories which indicate an pressure for committing fraud, which indicate an opportunity for committing a fraud, which indicate an attitude for committing a fraud. And even under misappropriation of assets also, fraud risk factors are divided into three categories which indicate pressure for committing misappropriation, which indicate an opportunity for committing misappropriation, which indicate an attitude for committing misappropriation. So like this, fraud risk factors are divided into two categories, and under each of the category, the fraud risk factors are further divided into three categories which indicate pressure, which indicate opportunity, which indicate an attitude. So like this, if you have a comprehensive look, total under 6 categories they have provided fraud risk factors. Now, we will have two questions. One question will be talking about examples of the fraud risk factors for fraudulent financial reporting divided under three categories, like which indicate incentive or pressure, which indicate an opportunity, and which indicate an attitude for committing fraudulent financial reporting. Similarly, one more question will be there. The factors which indicate, one more question here. The factors which indicate misappropriation of assets, and here also further this fraud risk factors for misappropriation of assets divided into three categories which indicate pressure, which indicate opportunity, and which indicate an attitude. So for example, say if I take you through some just 2-3 points. So what are the factors which indicate there is a pressure for committing fraudulent financial reporting? Like the client might be going through high degree of competition with a declining margins. This could create a pressure on the management to show wrong picture to the financial statements. Or companies dealing in such products which are highly vulnerable, which are highly sensitive to changes in the technology, like mobile phone industry. Or there is a decline in the customer demand. This also creates a pressure. So these are some examples which indicate that there is a pressure on the management to commit fraudulent financial reporting. And what causes opportunities? Like if the client is having related party transactions, there is a related party transaction, that itself is an opportunity to show a wrong picture through financial statements. A strong financial presence, your client is having a very dominating financial position, that is also an opportunity. Like similarly, if you see some examples which indicate attitudes, known history of violations, the management is of having very good track record of committing violations in the past. Or management is showing excessive interest only in maintaining their share price, they are least bothered whether they are showing correct information or not. So like this, if you come across these factors, you should get a doubt that there is a possibility of fraudulent financial reporting happening. Similarly, they have given some examples for misappropriation of assets also that you can manage. See, these concepts are not suitable for revision. Why? Because these are just example related topics. So just you can give a quick glance and you can manage it. These topics are not actually suitable for doing revision. Now, next few more points we need to understand here. So I will try to explain one more question here. Explain the scope of auditor's inquiry on fraud matters as required to be reported in the CARO 2020. Important question. So now what is this question is, as we all are aware, regarding fraud, auditor is required to report in CARO. We have clause number 11 in CARO, which expects the auditor to report certain matters regarding fraud. So under clause 11 of the CARO 2020, they say auditor need to report on 3 points. Whether there is any fraud noticed or reported during the year. If yes, what is the amount and what is the nature of the fraud and amount involved, auditor is required to report it. Number 2, second point which needs to be reported. This is first point, and second point, whether any of the auditors submitted form 84. Number 3, whether there are any whistleblower complaints. So I hope you all remember, under CARO 2020, under clause number 11, these 3 points are required to be reported. What are they? If there is any fraud noticed or reported, nature and amount involved in the fraud, whether any of the auditors submitted form 84, whether any whistleblower complaints are there. Now the question is, how the auditor will get this information? When they say scope of auditor's inquiry, which means that you are required to report on this. But if you have to report on these matters, first you should know about these matters, no? So as an auditor with whom you will inquire to get information regarding these matters so that you can fulfill the reporting requirements. Very simple. To fulfill first reporting requirement, I want to know whether any fraud is noticed or reported. Sir, how the auditor will come to know whether any fraud is noticed or reported? Very simple. The standard will ask, this SA 240 is asking you to simply inquire. Sir, with whom I will inquire, sir, to know whether fraud is noticed or reported? Simply, they will ask you to go and inquire with the management. Just go and inquire with the management. Sir, did you notice or report any fraud during the year? Or even what auditor can do is he can go through the reports of the internal auditor, check the reports of internal auditor once to find out whether any fraud is reported. Or you can also discuss the matter with other employees, including officers of the company. You can even inquire with other officers of the company, employees of the company. So very simple. As an auditor, you have to find out what is the nature and amount involved in the fraud. You have to report this under CARO, but if you want to know this information, you have to inquire. 3 people they are asking you to inquire. Inquire with the management, inquire with the internal auditors, inquire with the other employees. That's all. Second point, you need to check whether any of the auditor filed form 84. But big doubt is how auditor will come to know whether 84 is filed or not. Very simple. You have to check all the filings made with the ROC. Go to the MCA portal, and in that you can check what and all filings has been made by the company or made against the company. All that information will be there in the ROC MCA portal. So as an auditor, you have to check the MCA portal related details, what and all forms are submitted with the ROC. From that you can find out whether any of the form 84 is submitted during the year. Similarly, whistleblower complaints, if any, received during the year. Third point, you need to comment on whether there are any whistleblower complaints received. Sir, how auditor will come to know whether whistleblower complaints are received or not? Once again, simple thing, the standard will ask you to go and inquire from the management. That's all. So if you do this, you will get to know the information about the 3 things, then you can fulfill your reporting requirements. Understood? And one more thing, there are some slight differences between reporting requirements under 143 subsection 12 and CARO 2020. There are some key differences, very important for case scenario based MCQs. Listen carefully. And in fact, I have seen a case scenario based question concerning this matter in MTPs or RTPs. So listen carefully. See, under 143 subsection 12, they say that 143 subsection 12 is nothing but if the amount involved in the fraud is 1 crore or more, report to the central government. That we have seen, no? So that section. See, under 143 subsection 12, they use a phrase that if the auditor has reason to believe, he has to report it under 143 subsection 12. Under 143 subsection 12, they specifically say that if the auditor is having reason to believe, if he just suspect the fraud, even suspected frauds also will be reported under 143 subsection 12. But under CARO 2020, they will say only noticed or reported frauds are required to be reported. Only noticed or reported, not suspected frauds. But under 143 subsection 12, even suspected frauds also will be reported. Where under 143 subsection 12. But under CARO 2020, suspected frauds are not required to be reported. Only noticed or reported frauds are required to be reported. Understood, everybody? So that is the first point of difference. Only noticed frauds are required to be reported, not the suspected frauds. Where in Caro only noticed frauds. Suspected frauds may be reported under 143 subsection 12. And one more thing, only frauds which are committed by the company or on the company by its officers or employees are only covered. Which frauds are only required to be reported under Caro 2020? Only those frauds which are committed by officers or employees. They are only required to be reported under Caro 2020. Sometimes they might ask you a question, fraud committed by third parties are there. Sometimes third parties might commit a fraud in the company. Are that frauds required to be reported under Caro 2020? The answer is no. Why? Because they have specifically told that fraud committed by the company or on the company by its officers or employees are only covered. Beyond that, the fraud committed by the third parties are not required to be reported under Caro 2020. Clear what I am trying to say? So they might test you it in the form of MCQs, guys. Please be cautious. So they might test you, they might ask you in the question MCQs. So which of the following frauds are to be covered by the auditor in Caro 2020? Option A, fraud committed by officers or employees. Option B, fraud committed by third parties. Option C, both A and B. Option D, A or B. Option will be option A only, officers or employees. Third party committed frauds are not required to be reported under Caro 2020. And one more point of difference here. See, in 143 subsection 12 and under 143 subsection 12, the moment the amount involved in the fraud is 1 crore or more, compulsorily reporting to central government will happen. That could be material, that could not be material. Like in the Reliance Industries Limited, if 1 crore rupees of fraud was identified, as we all know, 1 crore is not at all material when you look from the entire company's perspective. But still, 1 crore fraud is required to be reported to central government under form number ADT4 under 143 subsection 12. But in Caro 2020, you are supposed to report only material frauds. You can consider the principles of materiality while reporting under Caro 2020. Whereas under 143 subsection 12, materiality concept doesn't apply. The moment fraud is 1 crore or more, whether it is material or immaterial, all the frauds you have to report to central government. But under Caro 2020, it will be enough if you report only material frauds. Immaterial frauds you need not report. So that is what they say here. While reporting under this clause, with regard to the nature and amount involved in the frauds noticed or reported, the auditor may even consider principles of materiality, which means auditor need to report only material frauds. He need not report immaterial frauds. Under where? Under Caro. But under 143 subsection 12, every fraud is required to be reported. Now one more last concept I will revise here. One more key concept. Self-revealing error. So what is the meaning of this self-revealing error? Self-revealing error means those errors which reveal by themselves. So revealing means what? Identified. Self-revealing means what? They are identified by themselves. So those errors which will identify by themselves, that we call it as self-revealing errors. So that's what they try to say here. These are such errors, the existence of which becomes apparent, the existence of which becomes clearly visible in the process of compilation, in the process of preparation of the financial statements. That errors we call it as self-revealing errors. Examples also they have given. Like for example, if you have written a journal entry, but while posting it to the ledger, you posted only one side of the entry, purchase account debit to creditor. But you posted that only in the purchase ledger, you did not post it in the creditor's ledger. This is a self-revealing error. Why? Because here trial balance will be thrown out of agreement. Trial balance will not match. So if the trial balance is not matching, it is clearly, it is identifying by itself, by double entry system of accounting, it automatically reveals that something is wrong in this financial statements. Something is wrong in this books of accounts. You need not put any extra effort for that. So those kind of errors, we call them as self-revealing errors. So the meaning has been given here along with some examples like omission to post a part of the journal entry to the ledger, or wrong totaling of the purchase register. If you do totaling, casting errors, if you do wrong totaling, if you do, then also trial balance will not match. or a failure to record in the cash book amounts paid into or withdrawn from the bank. Contra entries, if you fail to record it, automatically BRS you will prepare, there the errors will get automatically found out. Or a mistake in recording the amount received from X in the account of Y. You received the money from X, but you recorded it in the Y's account. Now how come this becomes self-revealing? This becomes self-revealing not by double entry system of accounting, but this becomes self-revealing because of companies' practice followed. So generally companies will have a practice of getting the statements of accounts. For example, if you received the money from customer X, but by mistake it was recorded in the Y. Now X account will show overdue, no? So companies will have a habit that if an account remains overdue for certain number of days, management will ask a confirmation statement. When they approach the debtor, when the debtor gives the account statement, in that it will be clearly mentioned he has already made a payment. Then the management will automatically realize that okay, this person has already made us a payment, but instead of recording it in his account, we recorded in somebody else's account. So as a part of company's policies, this error gets automatically identified. So these are a few examples where the error becomes identified by itself. Those errors we call it as self-revealing errors. They have given here examples. Along with that, they have told how it will be coming to the notice of the auditor automatically. Clear? See, in one of the past examination, they have tested a question something like this. So what in fact they have given a question is, a mistake in recording amount received from customer X was recorded in the account of Mr. Y. They created scenario something like this. So and so customer paid the money to the company, but instead of recording, that amount was recorded in another customer's account. And this error was automatically identified while sending a account statement. The phrase which they used is what? This error was automatically identified by sending a statement of account. Identify the type of error in this. Identify the type of error in this. Also give other examples for this kind of error. See how trickily they have asked a question. They have taken one example, gave a hint that it becomes automatically identified. They are asking you what is that kind of error. We all know that is a self-revealing error. And they are asking, give other examples for this kind of error. See, in the entire question, without taking the name self-revealing error, they are successful in asking the question what is self-revealing error and give the examples of self-revealing error. See how much level of conceptual clarity is required for you. So in the recent exams only they have asked this question. Check the previous examination questions, you will find it. So same, this kind of question only. Amount received from one customer was recorded in another customer's account. This error was automatically identified. Identify what type of error is this and also give other examples for this kind of error. So without taking the name of self-revealing error, they are very much successful in asking what is self-revealing error and give examples of the self-revealing error. So that's why I always say conceptual clarity should be your top priority. Then only you will be able to understand what the given question is and which answer will be appropriate. So with this, we are done successfully with fraud and the responsibilities of auditor. Clear everybody? Next. Now we will take up the next chapter for revision, which is going to be audit in an automated environment. Very small chapter, very limited number of questions, but a compulsory question in the examination. So the chapter which we are going to take up is what? Audit in an automated environment. So let us try to quickly revise this chapter, will not take much of a time. So first we will start with what is the meaning of automated environment. What exactly do you mean by automated environment? So the term automated environment is defined something like this. It refers to such a business environment where operations, activities, accounting, and even decision making is done with the help of computers and computer applications, that we call it as automated environment. So what is the meaning of the term automated environment? It refers to such a business environment where production, operation, processes, accounting, and even decision making is also carried out with the help of computers and computer softwares or applications. Such a business environment, we call it as automated environment. There are other names for this automated environment. We even call it as information technology, or we even call it as information technology systems. So as we all are aware, today the technology has its presence in each and every sector, each and every kind of business. Take this online education. So I am sitting at my place and I am able to reach all over India, the students who are sitting all over India. So technology, all this was possible with the help of technology only. And today some business models are existing only because there is a technology. E-commerce platforms you take, Flipkart, Amazon, these businesses are there only because there is technology. Or you take this food delivery applications like Zomato, Swiggy, etc. All these kind of businesses are there only if there is technology. If there is no such thing called technology, internet, etc., these business models doesn't exist at all. And in the recent times, accounting has also undergone a rapid changes with the introduction of technology. As we all are aware, today manual accounts are not maintained. Today all the accounts are maintained electronically using some robust accounting softwares. Like we have the most widely used accounting software in our country, Tally, which is the basic level of accounting software you can say, which can accommodate medium-sized businesses. Up to medium-sized businesses, Tally will be able to accommodate it. So Tally is the best software which is getting currently used in the market. And in the Tally, the accounting process becomes so simple that just you are supposed to pass an accounting entry. With a lot of effort, you might have read, you might have prepared for the accounting concepts, how to pass journal entry, how to post ledgers, how to prepare trial balance, how to prepare financial statements. All this you would have learned it, but practically you are not going to do all these activities. So then who will do all this, sir? Software will do it automatically. In the Tally, if you pass accounting entry, just you have to do passing of journal entry. If you know how to pass journal entry, trial balance posting, ledger posting, trial balance preparation, and preparation of financial statements, that too as per schedule 3 format and with the balance sheet matching, will be given by the Tally. So such an advanced accounting softwares are available today. See, when accounting has undergone those many changes because of automated environment, and since auditing is nothing but verification of accounting operations only, in auditing also the complications have increased. In auditing also, technology has taken its presence a lot. And this particular chapter is talking about that only, audit in an automated environment, how we will do the audit in such a business environment where computers are getting used. So let us go through the concepts of this chapter now. Let me open the material. Yeah. So first define the term automated environment. We have already seen it. So now the next question comes, why the businesses are adopting to this technology? Why rapidly these systems are getting adopted by the industry? See, obviously, by the end of the day, if a business is doing something, unless it finds some benefit in it, no business will do anything. So similarly, if the companies today are adopting to this technology, if they are using automated environment, definitely there are some features, you can call them advantages or benefits are there, because of which companies are rapidly adopting to this automated environment. So what are that advantages? What are that features of automated environment? So let us have a look at it. So it enables faster business operations. Quite obvious, systems will do the work in a less amount of time. Faster transactions or processes will happen. Accuracy in data processing, even in that processing also accuracy will be increased, like computations, mathematical calculations. Say we will not check the result given by calculator once again. Why? Because accuracy will be there in processing and computations. And ability to process large volumes of data. Systems can handle huge amount of data. We humans have limited processing power, but systems, if you have enough of infrastructure, they can handle huge volumes of data. And integration between business operations, because of technology, one activity can be connected with another activity. Integration between different departments will be there. Like for example, production department will be linked with the selling department. Selling department will be linked with the accounts department. Similarly, this security software, like if biometric scanning, that biometric scanning which the company will install to authorize only to allow only authorized people to enter inside the company, that security software can be linked with the accounting software. That security software can be linked with the attendance software. Attendance software will be linked with the payroll software. Payroll software will be linked with the banking software. So this level of interconnectivity between the operations will be possible only with the help of systems. And also security, better security and controls will become more better, controls will become more secured because of technology, less prone to human errors. Systems will be systems will be less prone to human errors. We have all the human emotions. After doing certain amount of work, we feel lazy, we feel boredom. All these emotions will not be there for the system. And even it will provide latest up to date information just with a click of a mouse. So with a click of a mouse, you can get up to date latest information. So these all features or advantages are making the companies to rapidly adopt to this automated environment. Then do you think IT is relevant in the audit? As an auditor, should we be concerned about IT? Definitely yes. So today it is very important for the auditors to understand about information technology, to get familiar with using information technology. Why? Because if you still say I will follow my traditional methods, I will do manual activities, you are irrelevant in the industry. So being an auditor, it is not something which is gray area for us. Today we as auditors, we are also required to be concerned about IT. So IT is becoming more and more relevant today. Why? So first thing they say, there are so many activities which are automated. So many activities are getting what? Automated. What do you mean by getting automated? Without any manual involvement, so many accounting functions are happening within the software. With zero manual involvement, so many business functions are happening within the system. So what kind of activities are getting automated, sir? What kind of business functions are happening within the systems, sir, without any manual involvement? Let us see it. Computations and calculations. Today, calculations, computations are everything done with the system. Like bank interest calculation. A person will not sit and calculate the interest on all the accounts. Core banking solution, the software will do it itself. So computations and calculations are getting carried out automatically within the systems. Accounting entries are also getting posted automatically. Not just computations and calculations. Today the softwares have developed to such an extent that even accounting entries are also getting posted automatically by the systems itself. Business policies and procedures like internal controls, etc., they are also getting implemented through the system. So earlier there used to be traditional method of approving the transaction by signing the voucher. But today the accounting software are coming with the features that approval also will happen within the software only. If the manager has to approve the entry, he has to log into the system, click the approve button. So like this, business policies and procedures are also getting automated, and even reports, whatever we are getting used in the business, from where that reports are getting generated, softwares are generating all that reports for you. And even user access and security are controlled by systems. Who should get access to which department, who should open which file, who should access which folder, these are also getting integrated with what? Systems only. So many business activities are getting automated without any manual involvement. So many activities are happening within the software itself. A few examples are given here, like calculations and computations. Accounting entries are posted automatically. Business policies and procedures are getting implemented automatically within the system. Reports which are used by the business are getting generated in the system. User access and security is also controlled by systems only. And few more reasons why IT is becoming more and more relevant today. One is SA 315. As we all know, SA 315 requires the auditor to obtain an understanding of entity, environment and its internal control. No, there if you give a deeper understanding of SA 315, understanding environment includes understanding business environment, understanding automated environment also. So even standards on auditing are also expecting the auditor, like SA 315 is also expecting the auditor to obtain an understanding of IT. Keep aside a standard. If as an auditor, if you start using information systems, your efficiency will get increased. Ignore the standard. If you voluntarily start using IT in your audit, efficiency and effectiveness of the audit will get increased. Few more reasons why IT is becoming more and more relevant today is, today's systems and applications are getting used very rapidly. Like I have told, ERP softwares like Tally, SAP, this usage has become very much rapid. Complexity of transactions. Today complexity has also increased a lot. To handle that complex transactions, we need to use systems. High-tech nature of business. Today some businesses model itself is depending on Technology like telecom business, e-commerce business, if technology is not there, these businesses are not there. Volume of the transactions is also increasing, and if you have to handle volume of such transactions, you have to make use of information technology. Regulatory requirements, even companies act, IT act puts also some responsibilities on the auditor to get relevant about IT, and it is even required by some international standards like ISO, PCI, like this global standards are there, which are also making the auditor to be concerned about IT, and it will even increase the efficiency and effectiveness of audit. So because of all these reasons, IT is becoming more and more relevant for the auditor. Now, as I have mentioned, as an auditor, you should try to obtain an understanding of client's automated environment. What you will specifically try to understand regarding client's environment, client's automated environment? If I told you, assume we are doing audit of the company X Limited. I called my article assistant like you, and I told him, boss, go to that client and try to get try to obtain an understanding of that particular client's automated environment. You are that article assistant. What you will try to understand? Very simple. What I will try to understand, first I will make a list of all the softwares they are using. I will try to understand their purpose. I will try to understand, are they global softwares or local softwares? I will try to understand which software is linked with which software. Is it a in-house developed software or is it a packaged software? And similarly, where the servers are located, are the servers located in India or the servers located in abroad? What is the architecture of the software? Is it a application based or is it a web based software? And who is maintaining IT activities? Is the company itself maintaining it or they have outsourced it? So, and who are the key IT people in the organization? This is what I will try to understand. So if someone asks you what you will specifically try to understand by in the client's automated environment, this is what the list I will say. Like I will try to get a list of information systems that are being used. I will try to understand their purpose, location of the systems, whether they are local systems or global systems, architecture, what kind of mechanism in which they work, versions, what version your client is using, is it an updated version or outdated version, interfaces within the system, which software is linked with which software, is it an in-house software versus packaged software, is it built within the company or is it bought from the market, outsourced activities, did the company outsource any IT activities, maintenance, is it outsourced or handled by the company on its own? Who are the key persons in the IT department like CIO, Chief Information Officer, CISO, Chief Information Security Officer, and also administrators. And whatever understanding that you are getting regarding IT systems, all that understanding you need to maintain a documentation. You need to include all that in your documentation. Whatever understanding you obtain regarding the entire client's automated environment, that should form part of your audit documentation. Like a template has also been given here. Nothing but whatever points we have understood, that we draft it in the form of a table, and we will try to update the details of all the accounting softwares which we have understood, and we will try to store it as a part of our documentation. A format or a template has been given here. Next one. See, using technology is not coming only with advantages. Using technology also will bring some disadvantages along with it. I can say using of technology will even bring some risk with it. Why? Because yes, technology is giving a lot of benefits, but today because of the technology we are facing various risks also. The primary risk which we are facing is loss of data, theft of data, no enough of backups, our privacy getting breached. So like this, the use of IT is also bringing various risk. And when you look from the business perspective, by using IT, what kind of risks will arise? So the list has been given here. Inaccurate processing of data or processing inaccurate data. Sometimes there will be a bug in the software. No matter how much correct data you input, the system will always generate wrong output. Or system will even process inaccurate data also. Even if you enter wrong information also, system will accept. System will not be able to differentiate between what is correct data, what is wrong data. Like when you file some exam application, there will be a mobile number column, no? So try to enter in the mobile number column all zeros and click the submit button. The system will show OTP has been sent to registered mobile number. So system is not able to differentiate that all zeros is a wrong mobile number. System will not be able to differentiate. So it will even process inaccurate data also. And sometimes people might get unauthorized access to the data. Those people who should not get access to the data, they might get it with the help of systems. Or direct data changes. Sometimes people will go and make changes to the data. Accounting record, attendance record, some employees going and changing it. Or sometimes people will get access beyond their requirements, which we call it as excessive access or privilege privileged access. Lack of adequate segregation of duties. Sometimes a person will be given power to do some activities which he is not supposed to do. So segregation of duties might not be there. Unauthorized changes to systems and programs. Sometimes people will go and make the changes to the program directly, to the software directly, they will do the changes. Or sometimes change will be required to be done, but you will fail to make the changes on time. So failure to make the changes on time can also be a risk. And also loss of data. The biggest problem today is loss of data. Data might be stolen, data might be erased, data might be deleted. So all these risks are getting erased from the use of information systems. And if these risks are not mitigated, they will have impact on substantive audit procedures, they will have impact on our compliance procedures, and even they might have impact on our reporting also. Sir, how they will have an impact on substantive procedures, sir? So if I came to know that client is using automated environment, and if that automated environment is not reliable, I will not be able to rely on data which I am getting from system. If I am not able to rely on the data directly, what I will do is first I will get the data, check whether it is accurate or not, then only I can start using it. So that means your work is getting increased here. The systems are reliable, you will download the data and directly use it. If the systems are not reliable, first you have to download the data, check whether it is reliable or not, then only I can start using it. Next, how it will have impact on compliance procedures. See, if you are unable to trust the client's automated environment, definitely those internal controls which are implemented in that systems also you will not be able to rely. And when you are not able to rely on internal controls, when you decided that controls are ineffective, you need to perform more substantive audit procedures. So this is how it will impact compliance procedures. And if the risks are very severe and not mitigated, auditor might consider communicating that information with those charged with governance, and he will even consider issuing the modified opinion also. Clear? So these are the risks arising from the use of IT and how it is going to have an impact on our audit procedures. Next, what are various testing methods in automated environment? If you want to test the client's automated environment, what methods are available? So out of 7 methods which we have, 4 will be relevant here. We can do inquiry, we can do inspection, we can do observation, or even we can do reperformance. So out of 7 methods available, 4 methods will be suitable for testing in the automated environment. What are they? Inquiry, inspection, observation, reperformance. And as we all are aware, out of these 4 methods, which one is the most efficient? Efficient means what? Less time consuming. Out of these 4 methods, which one will be most efficient? The most efficient method will be inquiry. Inquiry can be completed in very less amount of time. Whereas the most effective method is reperformance. Effective means what? Perfect evidence you will get it by reperformance. Whereas if you want to complete the work in less time, you have to do inquiry. But the problem is inquiry is efficient but not effective. You can complete inquiry in less time, but it will not give perfect evidence. Reperformance will be effective but not efficient. Reperformance will give you perfect evidence, but you take a lot of time for doing that reperformance. So if you want to strike the balance between efficiency as well as effectiveness, then you can follow a combination of inquiry along with inspection. So most efficient method is inquiry, most effective method is reperformance. If you want to strike the balance between efficiency and effectiveness, you can follow the combination of inquiry along with inspection. But finally, by the end of the day, it is auditor's professional judgment to decide which method he wants to follow, which combination he has to follow. There is no hard and fast rule anywhere. Auditor should use only this approach. So like that, there is no hard and fast rule anywhere. It's up to auditor's choice to decide which audit method he wants to use and in what combination he wants to use it. However, when testing in an automated environment, there are some common things which we need to follow. There are some main points which we need to check in the automated environment. What are they? First, we need to obtain an understanding of overall automated environment by doing a walkthrough of end-to-end transaction. Nothing but if I want to know whether accounting software is working properly or not, I should do a walkthrough test. Like for example, I want to know whether Tally is working perfectly or not. What I will do is I will pass one fake entry, I will pass one dummy entry, check whether it is correctly reflected in ledgers. I will go and check the trial balance, whether it is correctly reflected. I will go and immediately check whether it is reflected in the financial statements at proper places. So like this, first you should understand how an automatic transaction is processed by doing one walkthrough test. And also you should understand how a user processes transactions under different scenarios, under different circumstances, how the user is processing a transaction. And also check the configuration of the system, check the details of the system, specifications of the system, and also read the system logs to determine what changes are made. System log means nothing but a record which is maintained to update the details of all the changes which are made to the accounting software. From the date of installation, what changes have been made to the accounting software, that details all will be updated in a record that we call it as system log. As an auditor, you should read that system log once to know what changes have been made, and also read their technical manuals and user manuals also. And finally, carry out a test checking, negative testing. Negative testing means you should enter a wrong information into the system and check whether error message is displayed or not. So these are some common methods which you need to do in automated environment, like obtaining an understanding of automated transaction, understanding how a user is processing transaction under different scenarios, study the configuration of the system, read the system logs, read the technical manual or user manual, and even try to carry out a negative testing also. Clear, everybody? Let us now proceed further with the next question, which is regarding data analytics. So the most important question from the examination perspective. So let us try to understand what exactly is this data analytics. See, as we all are aware, as someone has correctly quoted, data is the new oil today. Data is the new currency today. So we have bulk of data available. So wherever we go, we have access to an unlimited amount of data. So there is no restriction on availability of data. But just having the data will not create any edge for you. Just having a bulk amount of data available with you does not create any edge, does not create any benefit for you. You should be able to analyze that large volumes of data, make some meaningful analysis out of it, interpret that data, and use it for your decision making purpose. That is where exactly the advantage lies. Just having access to bulk amount of data is not going to create any value addition. Whatever data that you have, you should be able to analyze it, you should be able to interpret it, convert it into meaningful analysis, and use it for decision making purposes. That is where the true value addition lies. See, today when we use social media platforms, we are leaving behind tons of data available to the social media platforms. We use so many social media platforms from the time we wake up till the time we go to bed. And whenever we are using all the social media platforms, we are leaving the traces of data. Now, all these social media platforms are going to make millions and billions of dollars of revenue by selling all your data. Like Facebook, when we use the Facebook and all, we are leaving behind traces of lot of data. When we use Instagram, we are also leaving a hell of our data there. Just imagine Google as a platform. So Google will have a track of what we are searching for, what websites we are having access, what we are watching on YouTube, where we are traveling, Google Maps, where we are making payments, Google Pay. So like this, whatever we do, everywhere we are leaving behind the traces of the data. Now all the social media platforms will sell our data for billions of dollars actually. Now who will buy this data? So businesses will buy this data. Other OTT platforms buy this data. Supermarkets buy this data. E-commerce platforms buy this data. And even political parties buy this data. So all these people will buy the data. For what purposes, sir? So now all these businesses, from the data whatever they have bought, they will do some analysis out of it and use that for their decision making purposes, for expanding their businesses, for improving their profitability, for providing better customer service. But keeping in mind the vast amount of data available today, we doesn't have enough of human processing power to analyze all that data. We humans can't handle that much amount of data. So in order to handle and analyze that large volume of data, we need some tools, techniques and softwares like Excel, Tableau, Power BI. So like that, we need advanced tools and techniques to analyze the large volumes of data available. So that tools and techniques which are used to tap vast amounts of data to make some meaningful analysis out of it, that combination of tools and techniques, we call it as data analytics tools. So what is the meaning of data analytics tools? So if you have a look at this definition here, the combination of processes, tools and techniques that are used to tap vast amounts of electronic data to obtain meaningful information. That tools we call it as what? Data analytics. Example, Excel is a data analytics tool, Tableau is a data analytics tool, Power BI is a data analytics tool. So like that, today we have so many tools and techniques available to analyze that large volumes of data, that we call it as data analytics. And companies will get benefited out of this data analytics immensely. They are using this data analytics tools for increasing their profitability, for better customer service, for gaining competitive advantage, and even for more efficient operations. And these tools are not just used by the companies. Today these tools are getting even used by the auditor while conducting the audit to obtain the sufficient and appropriate audit evidence. So the use of data analytics application is not just restricted for businesses. Even auditors also can make use of these data analytics tools and techniques to obtain audit evidence while they are doing the audit. And in case if the auditor is using data analytics tools for obtaining audit evidence, then we call them as computer assisted audit techniques, we call them. So even auditors also can make use of this data analytics tools in the audit process to obtain good results. And the tools and techniques which the auditor will use in applying the principles of data analytics are known as computer assisted audit techniques, or CAT in short. Clear? Nothing. Data analytics is nothing but tools and techniques which are used to tap large volumes of data. If those tools are used by the auditor for doing audit and for obtaining audit evidence, that we call them as computer assisted audit techniques. That's it. Now, how auditor can specifically make use of data analytics today? For what and all purposes today the data analytics can be used in the audit? For checking completeness of data. Using this computer assisted audit techniques, auditor can check whatever information that is provided to him, is it complete or incomplete. He can use it for selection of audit samples. As we all know, we do the audit by performing audit procedures on a sample. And how we will select the sample? So in the selection of sample also auditor is going to make use of data analytics tools. And recomputation, for checking the arithmetical calculations, then for checking recomputations, for doing the calculations and all, and also for checking arithmetical accuracy of the mathematical calculations, there also auditor is going to make use of data analytics. And even today we have softwares available to analyze even the journal entries to find out the frauds. So today's softwares are available for even doing fraud investigation. Forensic softwares are available, and even data analytics can be used for finding out control weaknesses also. So that is what the usage of data analytics in audit. For these many number of purposes, even auditor also can make use of data analytics while doing the audit. Understood? And then finally, as an auditor, if you have any findings in the client's automated environment, if you have verified the client's automated environments, its controls, its operations, etc. So how you will report that? If you have any observation regarding the client's automated environment, how auditor should report? Very simple. Whenever auditor finds any exceptions or deficiencies in the automated environment, the auditor need to report this matter to relevant stakeholders. That stakeholders could be management, that could be those charged with governance, board of directors, audit committee, whoever it is. As an auditor, it is quite common after completing the audit, you might find out some exceptions or deficiencies in the automated environment. Although all those deficiencies or findings are required to be communicated with relevant stakeholders. And some points you need to keep in mind while doing that reporting. First, to find out whether there is any weaknesses. If yes, what is the impact of the weakness? You have to mention in that findings. And if it is a normal deficiency, report to the management. If it is a significant deficiency, report it to those charged with governance. Clear, everybody? So these are the points which auditor need to consider while reporting his findings. Understood, everybody? So this is what regarding points which we need to consider while reporting the findings or exceptions in the client's automated environment. And I am saying deficiency. What exactly is the meaning of deficiency in internal control system? Very simple. If the control is designed, implemented or maintained, but it is not able to prevent, detect or correct the misstatements, then we say there is a deficiency in internal control system. Or if a control is altogether missing, that also we call it as a deficiency in internal control system. So what is a deficiency in internal control? Either control is there, but it failed miserably to prevent, detect or correct the misstatement, or the control is altogether missing. That also we call it as a deficiency only. So these are all the points which auditor needs to keep in mind while reporting his findings to the relevant stakeholders. Understood everybody? So this is what regarding audit in an automated environment. Very small chapter, very simple topics, and that too compulsory questions in the examination. Clear everybody? Right. Now we will start revising the chapter audit sampling. Once again, a very small chapter, but compulsory question from the said chapter audit sampling. So without any delay further, let us try to quickly revise the chapter audit sampling. Once again, a very small chapter, very easy content also. So we'll try to cover it. So audit sampling. So as we all are aware, as we have seen in the chapter nature, objective and scope of audit, when the auditor performs substantive audit procedures, he will not perform on 100% of the transactions. The auditor will try to verify the transactions on sampling basis. Now, what exactly is the meaning of verifying transactions on sampling basis? So if I have to put it in a normal terms, if you are not performing audit procedures on the entire population, but instead you are taking a small part of the population and on that you are performing audit procedures to form a conclusion on entire population from which that sample is selected, that I simply call it as audit sampling. So if I have to give you example, so there are total 10,000 transactions in the entity. I don't have enough of time to perform audit procedures on the entire 10,000 transactions. So what I have done is, out of that 10,000 transactions, I have taken a sample of 1,000 transactions. On this, I will perform audit procedures. So this total 10,000 transactions will be called as population. Out of that, I have selected 1,000 transactions that I call it as sample. So now after selecting a sample, I will perform audit procedures on sample. And by performing audit procedures on the sample of 1,000 transaction, I will have my observations, I will have my findings. On the basis of that audit procedures, will I form conclusion only on the sample, or will I form conclusion on the entire population from which I have selected the sample? On what I am going to form the conclusion? So my objective will be to form a conclusion on entire population from which the sample is selected. So I will perform audit procedures on the sample, but on the results of that audit procedures, I will not just form conclusion on just the sample, I will form a conclusion on entire population from which the sample has been selected. One simple example, out of the class of 100 students, I don't have enough of time to test the knowledge of these 100 students. So I have taken a sample of 10 students. To these 10 students, I have asked the questions. So these 10 students will be my sample. 100 students will be population. On the basis of responses which I get from the sample of these 10 students, I will form a conclusion about entire class of 100 students. That is what the meaning of audit sampling. So now if I put it in the form of a technical definition, so let us open the material for that. So if whatever explanation which I have given, if I try to put it in the form of a definition, you will be able to find the definition here. So as per SA 530, SA 530 is the relevant standard which is completely talking about audit sampling. So as per that SA 530, audit sampling refers to application of audit procedures to less than 100% of items in the population. We are performing audit procedures, but not on the 100% of the items in the population, to less than 100% of items in the population. When I say less than 100%, it could be 5%, it could be 2%, it could be 10%, it could be 99% also. So how much percentage? Irrelevant. But we are performing audit procedures to less than 100% of items in the population in order to form conclusion on the entire population from which the sample is selected. So we perform audit procedures, and on the basis of that, we will form conclusion not just on the sample, we will form a conclusion on entire population from which the sample is selected. Then let us ask few more questions. Let me ask you a few more questions. Do you think is audit sampling mandatory? Is it compulsory for the auditor to mandatorily follow the sampling approach? Should he must and should verify transactions on sampling basis only? The answer is no. It is not mandatory for the auditor to compulsorily verify the transactions on sampling basis. No standard says that. Even SA 530 also doesn't say that. Then what does SA 530 say, sir? See, don't be of a wrong notion that just because there is a dedicated standard talking about audit sampling is mandatory. No. What SA 530 says is, or even if you go to SA 200, what SA 200 says is, as an auditor, you are required to express an opinion on the financial statements. That is what your objective. Now, will you express your opinion by doing 100% verification? Will you express your opinion by doing verification on sampling basis? That is something which auditor has to decide on the basis of his professional judgment. So no standard has made it mandatory for the auditor to compulsorily verify the transactions on sampling basis. No standard has been made it mandatory. It's completely up to the choice of the auditor. The auditor will use his professional judgment. That is, he will use his knowledge, experience and training. Then he will decide. On that basis, he will decide whether he will go for 100% verification or sampling. Not just sampling, guys. From the beginning, if you observe it, they will not say anywhere what exactly needs to be done. It anywhere from the beginning of the audit, you can once again pay attention. Nowhere they will say this is what exactly auditor has to do. Everywhere the standards will tell you all the possibilities available, and they will end it with one simple word: you using your professional judgment, you have to decide. Like they have told 7 methods for obtaining audit evidence, but the standard did not say auditor has to use only inquiry, inspection. They did not say it. That is something which auditor has to decide, applying his knowledge, experience and training. So like this, even if you take audit evidence, sufficient and appropriate audit evidence, they will say. But what amounts to sufficiency, what amounts to appropriateness, nowhere it was mentioned. Once again, based on professional judgment. So the auditor, using his professional judgment, he will decide whether he will go for sampling or he will do 100% verification. And while taking that decision, whether he will do 100% verification or he will do sampling, he will consider various factors in mind. So what factors he will consider while deciding extent of checking? That means, will he do 100% verification or will he verify the transactions on sampling basis? That will be decided by what factors? So the following factors will decide it. It depends on size of the organization. If you are doing audit of one small entity, limited number of transactions, there you might think of doing 100% verification. On the other hand, if you are conducting audit of a company which is of the size of Reliance Industries Limited, doing 100% verification is close to impossible there. So size of the organization you will consider in deciding whether you will do 100% verification or sampling. Even you will consider effectiveness of internal controls. If the controls are very much effective, I will try to do sampling. If the controls are not effective, I might prefer to go for 100% verification. It even depends on how adequate and reliable books of accounts are. If I believe that books of accounts are more reliable, I will try to do 100% verification. If they are not reliable, I will try to do if they are reliable, I will do sampling. If they are not reliable, I will try to do 100% verification. The auditor will even consider tolerable error range, the risk which auditor is willing to accept. Tolerate means what? Which you are willing to accept. So even auditor will decide, one of the factor he will consider is tolerable error range. How much error auditor is willing to accept, willing to tolerate. If the auditor is not at all willing to tolerate any risk, he will do 100% verification. On the other hand, if he is willing to tolerate some amount of risk, then he will go for sampling. And it will even depend on degree of the confidence required by the auditor. If the auditor is expecting high level of confidence to express the opinion, he will do 100% verification. If the auditor is satisfied with a little bit less of confidence also, then he will go for sampling. So the auditor, after considering all these factors, then he will decide whether he will do 100% verification or he will follow sampling. Clear? So this is what regarding what are the factors to be considered while deciding whether to do 100% verification or to go for sampling. Now, one more small question here. Define the term population. Also state characteristics of the population. See, if you want your sample conclusions to be correct, out of the sample will form conclusion on the entire population. No. So if you expect your conclusions have to be correct, then the population from which you are selecting the sample, that should have certain characteristics. First of all, what do you mean by population? So as I've already told you, the entire set of data, that large mass of data from which the sample is selected, that I call it as population. One more term we need to understand: sampling unit. Nothing but each and every item which make up the entire population, that I call it as sampling unit. Like if I am saying the class contains 100 students, if I say the population is 100, for this class the population is 100. Now out of that, each and every student who is making up the population, that will be called as a sampling unit. If I say total population of 10,000 transactions is there, each and every transaction which is making up this 10,000 population, that we call it a sampling unit. Nothing but individual item which make up the population, I call it a sampling unit. Now, population should have what characteristics, sir? If you want our conclusions to be correct, the population from which you are selecting the sample, that should have three characteristics. What are they? The population should be appropriate. Appropriate means the population should contain only those transactions which belong to the population. It should not contain irrelevant items. It should contain only relevant items and which belong to that population only should be there. So first characteristic which population should have is appropriate. The population should be appropriate. It should contain only relevant items. Irrelevant items should not be there. And also the population should be complete. You should not select the sample from an incomplete population. We should always try to select the population, select the sample from a complete population, not from an incomplete population. Next one, your sample should be reliable. Sorry, your population should be reliable. Your population should be trustworthy. So if you want your conclusions on the basis of sample to be correct, then the population from which you are selecting the sample should have these three characteristics. One is appropriateness, other one is completeness, and the other one is reliability. Clear? Now coming to the main concept, what are the approaches for sampling? What are approaches to sampling? So broadly speaking, there are two broad approaches for conducting the sampling. The samples can be selected by using two broad approaches. What are they, sir? Number one is statistical sampling, and the other one is non-statistical sampling. This non-statistical sampling can also be called as judgmental sampling also. So there are two broad approaches to sampling. One is a statistical and the other one is non-statistical sampling. Let us try to understand what is statistical sampling and what is this non-statistical sampling. Statistical sampling means those sampling method, those sampling approach in which there is a random selection of items. In which there is what? Random selection of items. What do you mean by random selection, sir? Every item should have a equal chance of selection. In which approach it will be there? In the case of statistical approach, there will be a random selection. Each and every item will have an equal chance of coming into the sample. At the same time, in the case of statistical sampling, I follow scientific concepts like I use mathematical concepts and also I use probability theories. What I will use? Probability theories also I will use. So sample will be selected using mathematical concepts and probability theories. And this statistical sampling is considered to be more scientific. Why? Because here we are using mathematical and probability concepts. So the statistical sampling approach is more scientific and it is also objective. What do you mean by objective? It is unbiased. What is it? It is unbiased. Why it is unbiased? Why? Because we are giving equal chance of selection for each and every item. So that's why statistical sampling will be scientific and also objective. So these are three characteristics of statistical sampling. Random selection, it uses mathematical theories and probability theories. It is more scientific and objective. Whereas when it comes to non-statistical sampling, it can be defined as the sampling approach which does not have the characteristics of statistical sampling, that we call it as non-statistical sampling. So non-statistical sampling does not have which characteristics of statistical sampling. That means here random selection will not be there. It doesn't use mathematical theories and probability theories. This method is neither scientific nor objective. Then how the hell sample will be selected? So the sample will be selected simply using auditor's professional judgment. If not following any of the approach, then how simply the sample will be selected? The sample will be simply selected by using auditor's professional judgment. That means auditor will use his knowledge, experience and training, and depending on the facts and circumstances of each case, he will decide what item should come into his sample. And one more thing here, in this kind of non-statistical sampling, there is always a risk of personal bias. Here bias will be there. Bias cannot be eliminated in the case of non-statistical sampling. That means it is not objective. But in the case of statistical sampling, we will try to make sure that there is no bias. But that risk of personal bias cannot be eliminated in the non-statistical approach. Clear, everybody? Now, between the statistical versus non-statistical sampling, which one is more preferable? So practically speaking, statistical sampling is bit more beneficial than when compared with the non-statistical sampling. Why? Because this method is going to be more mathematical, scientific, and it is objective. That's why statistical sampling is bit more reliable than when compared with the non-statistical sampling. Does that mean the auditor should always use only statistical sampling approach? No, I never said that. When we do comparative study, I'm just telling you that statistical sampling is a bit better than non-statistical sampling. I never told that auditor should make use of only statistical sampling. Did I say that? No, I never used that phrase. So basically statistical sampling is more beneficial, but whether auditor will use statistical sampling or he will make use of non-statistical sampling, that is something auditor will decide on the basis of professional judgment. Who will decide it? Auditor himself will decide on the basis of professional judgment whether he will follow statistical approach or he will follow non-statistical approach. That auditor himself has to decide using his knowledge, experience and training. But one point SA 530 says whatever may be the approach, either statistical or non-statistical, the auditor should try to make sure that the sample is representative of entire population. What auditor should make sure? Whatever sample that you have selected, that sample should be representative of entire population. It should have all the characteristics of the population in the sample also. The sample should be representative of entire population. So these are two broad approaches, statistical versus non-statistical. Now let us talk about next important concept from this particular chapter, methods of sampling. What we will understand now? What are the various methods of committing the sampling, or what are the various techniques available for committing the sampling? So number one, the most widely used method is random sampling. The most widely used method is what? Random sampling. The name itself says random. Every item should have a equal chance of selection. So random sampling refers to such a kind of sampling where each and every item will have equal chance of selection. Sir, how that will be ensured, sir? How can we make sure that each and every item will have an equal chance of selection? By using some tools called random number generators or random number tables. You can use manual tools like random number tables, which you can buy it from the market, or today we can make use of the internet, or on our mobile also we can generate the random numbers. So like that, one simple example if I have to give you, so just you have to go to the Google and search for random number generator. So you will find a template something like this. This is simply a random number generator. It will generate the random numbers for you without any bias. Take for example, from 1 to 10,000 transactions, I want a sample of 100 transactions. But I want to make sure that each and every item should have equal chance of selection. Biasedness should not be there. So I have entered the minimum value, maximum value. I click the generate button. Now the system is showing 4130. So invoice number 4130 I will take into my sample. Once again I will go and click the generate button. Now it is telling me pick up the invoice number 1309. I will pick 1309. Once again I am clicking here. Now it is saying 6764 invoice number to pick. I will pick that. So like this, how many number of samples I want, I can generate that many random numbers. You tell me, did I show any bias here? Is there any bias here? No, there is no simple bias. So like this, if you select the sample by using tools like random number generators or random number tables, which will completely eliminate the bias, that we call it as random sampling. And this random sampling also will be of two types. One is simple random sampling and the other one is stratified random sampling. Now what is the simple random sampling, stratified random sampling? See, simple random sampling is nothing but just whatever we have done now. By simply making use of random number tables and random number generators, if we select the sample, that is what simply a simple random sample. But simple random sample will be suitable only for homogeneous population. It is suitable for what? Homogeneous population. Those populations which have similar characteristics, in that case only simple random sampling will be very useful. When the population is having dissimilar characteristics, or when the population is spread over a wide range, then simple random sampling alone will not be enough. We need to follow stratified random sampling. In homogeneous or when the transactions are in a similar range, then simple random sampling will be useful. But in case of heterogeneous population or when the range of the transactions is very high, then we have to follow something called stratified random sampling. Like for example, purchases are there, total 10,000 invoices are there, and this total 10,000 purchases are made from 4 suppliers, A, B, C, D. 4 suppliers have provided it. Now if I follow simple random sampling, there is no guarantee in my sample all the supplier related purchase will come or not. I can't guarantee it. Why? Because your population is having dissimilar characteristics. So before I use the random number tables or generators, what I will do is I will divide this entire population into subpopulation. I will divide invoices separately which are bought from Mr. A. Some 3,000 invoices came here. I divided those invoices which are brought from Mr. B. 2,500 invoices came here. I divided the invoices from supplier C. 1,500 invoices came here. I divided the invoices from supplier D. Some 4,000 invoices came here. So first I have divided entire population which is having dissimilar characteristics into subpopulation having similar characteristics. This division of the population I call it as stratification. This division of the population of different characteristics into subpopulation of similar characteristics, I call it as what? Stratification. Now from each of the subpopulation, once again I will select the sample. Now using once again random number tables and random number generators. For example, from this 3,000 transactions, I want 50. How I will select that 50? By using random number table and random number generators. From this 2,500, I want another 50. Once again, make use of random number tables and random number generators. So like this, from each of the subpopulation, I will select the sample. Once again, using random number tables and generators. This entire process, I call it as stratification. So I will say stratification is just an extended version of simple random sampling. In the simple random sampling, directly we make use of random number tables and generators. But in the stratified random sampling, first we divide the entire population into subpopulation. Then we go for simple random sampling. This entire collective process, I call it as stratified random sampling, which is the most widely used technique. Next approach, there is one more approach called systematic sampling or interval sampling. There is one more approach called systematic sampling or interval sampling. Now, what is the systematic sampling or interval sampling? See, this involves doing some math. Here we'll do some math. Here we'll calculate a figure called sampling interval. Here we'll calculate a figure called sampling interval. And how to calculate that sampling interval? So, simply dividing size of the population with required sample size. What I should do? I should divide the size of the population with required sample size. For example, total 10,000 transactions are there. Out of that, I want a sample size of 100. If you divide it, you will get some figure n. Here that n is equal to 100. This I call it as sampling interval. Now, every 100th item I will take into my sample. Every 100th item I will take into my sample. Like I will take the first item, then 100, then 200, then 300, like that every 100th item I will take. So this is what I call it as sampling, systematic sampling or interval sampling, in which first I need to calculate a figure called sampling interval by dividing the size of the population with sample size, and every nth item should be taken into my sample. So this is what systematic sampling or interval sampling. One more approach is there, value weighted selection or monetary unit sampling also we call it. Monetary unit sampling or value weighted selection also we can say it. The name itself says if you are selecting the sample or if you are analyzing the sample results by giving importance, by giving weightage to the value of the transactions, that I call it as monetary unit sampling or value weighted selection. So what is monetary unit sampling or value weighted selection? While selecting the sample or while analyzing the sample return while analyzing the sample results, if I give importance to value of the transaction instead of number of transactions, that I call it as monetary unit sampling or value weighted selection. Like for example, if I am deciding that whatever purchases are there which are more than 10 lakhs, I will verify full transactions. Invoices from 5 lakhs to 10 lakhs, I will verify 20%. Invoices from 2 lakhs to 5 lakhs, I will verify 10%. Whatever invoices are there which are less than 2 lakh rupees, I will verify only 5%. So now in the selection of the sample, you are giving importance to value of the transaction. So this I simply call it as value weighted selection. Next one more technique, block sampling. One more technique is what? Block sampling. Now in the block sampling, what will happen is, instead of picking one item into my sample, I will select a block of continuous items into my sample. Like for example, somebody has gave me a file which contains 1000 invoices in that. In that, I want 100 invoices. In normal sampling approaches, what I will do is, I will pick one item till the time I get the count of 100. But in the block sampling, what I will do is from all these 1000 invoices, somewhere randomly, I will pick all at once 100 items. I will in a single shot, I will pick 100 items continuously. In normal other approaches, what I will do, I will pick one item till the time I get the count of 100. But in the block sampling, what I will do, from somewhere in between, continuous 100 items all at once I will pick. This is what the block sampling is. But this block sampling is not that effective. Why block sampling is not that effective? Why? Because if you observe, populations are all arranged in some sequence. In the data arrangement, some sequence will be followed, either chronological order, alphabetical order, some sort of order will be there. If you select a series of continuous items, what will happen is you tend to have similar characteristics in your sample. You get all the similar items in your sample, you will not be able to cover different characteristics. That is the main drawback of block sampling. And one more last thing is there, very important, haphazard sampling. What is that? Haphazard sampling. So as the name itself says, in the haphazard sampling, I will not follow any specific approach. I am not going to follow any approach, any technique, any specific technique I am not going to follow. Even though I don't follow any specific technique, I will try to make sure that there is no bias. I will not follow any technique, but at the same time, I will try to make sure that my bias is not playing any role. Such a kind of sampling, we call it as haphazard sampling. If I have to give you a vague example, just I am closing my eyes, randomly I am picking some invoice. This is what haphazard sampling. I did not follow any standard technique. At the same time, I will not let the bias. I have not given priority to any item. I have given equal priority. This we call it as haphazard sampling, where we don't follow any technique, but at the same time, we will not let our bias to play any role. See, this method is also not that effective. Why? Because we don't follow any specific technique. So that's why this method is not effective. It will be even difficult to justify in the future also. If tomorrow, if your opinion has gone wrong, if the court, if the judge in the court is asking you, boss, how you have selected the sample, you can't show him a video where you are closing your eyes and picking the invoices. So it will be very vague to establish in the future. So that's why haphazard sampling is also not that effective when compared with other approaches. So these are all the specific methods which are available for performing the sampling. Clear? So almost a majority of the content we have covered. So we have seen methods, approaches, everything we have covered. Yeah, then a few more things. 3 terms we need to understand. When I say sampling process involves 3 steps. The sampling process involves how many steps? 3 steps are involved in the sampling process. What are they? So number 1 is sample design. Oh my God. Number 1 is sample design. Number 2, sample size. Number 3, sample selection. So when you are doing sampling, the sampling involves 3 steps. Number 1 is sample design. Number 2 is sample size. Number 3 is sample selection. Now just first let us try to understand the meaning of the terms sample design, sample size and sample selection. Sample design means which technique you want to follow. Just now I have told you different methods, random sampling, monetary unit, value weighted selection, so many things I have covered. Now which method will be suitable for which item of financial statements? Taking that decision, I call it as sample design. Which method will be suitable? Should I use random sampling? Should I use monetary unit sampling? In the random sampling also, should I use simple random sampling or should I use stratified random sampling? So taking that decision is the first step, which we call it as sample design, deciding on which method to be followed. Then sample size. Sample size means how many number of items you will take into your sample. Will you take 100 items? Will you take 200 items? Will you take 500 items? Will you take 10% of the items? So how many number of items will you take into the sample? That we call it as sample size. Now once you have decided the method of sampling, once you decided this much sample size you want, for example, you have decided you will follow random sampling and 100 will be your sample size. The last step will be selection of the samples. Now depending on the approach, whatever you have adopted, you should start selecting the items in your sample. Clear everybody? So these are the 3 steps which will be involved in the sampling process. Sample design, first you have to select the method which you want to follow. And on what basis method will be decided? So this method will be mainly decided on the basis of characteristics of the population. Your purpose of audit procedures and also characteristics of population. Like one simple example if I have to give, if you came to know that population is homogeneous population, I will follow simple random sampling. If I came to know that population is a heterogeneous population, I will go for stratified random sampling. So keeping the purpose of audit procedures, like if you see here, Keeping in mind the purpose of audit procedures and characteristics of the population, the auditor will take a decision regarding sample design. Now, sir, how many number of items should be there in your sample? What should be the sample size? One simple thing I will say, professional judgment. They did not say anywhere this much amount of sample size will be appropriate. It all depends on auditor's professional judgment. What the standard has simply told is the auditor shall determine a sample size which is sufficient to reduce sampling risk to an acceptably low level. You should choose sample size in such a manner that your sampling risk is kept at a low level. That means if you observe carefully here, they are not saying any specific percentage. They have left it on the shoulders of the auditor. They have left it to the auditor's choice. You apply your professional judgment and decide how much should be your appropriate sample size. Now, once you have decided on the method, once you have decided on the sample size, now start selecting the items from the sample, so from the population into your sample. Clear? Right. So this is what regarding the three terms. Now, one more important question here. What are the factors to be considered by the auditor while deciding appropriate sample size? Very important for true or false statements. Listen carefully now. So as I have told, how many number of items should be there in your sample? That is something auditor will decide on the basis of professional judgment. But while taking that decision, auditor will consider certain factors. That means should he go for bigger sample size or should he go for smaller sample size? That decision he will take after considering various factors. What are they? Like if you see here, desired level of assurance. If the auditor needs more assurance, he will go for bigger sample size. If the auditor wants low level of assurance, he will go with the smaller sample size. That's all. So here what kind of relationship is there between desired level of assurance required and the sample size? There is a direct relationship. So higher the level of assurance required by the auditor, bigger will be the sample size. Next one. It also depends on expected rate of deviation or misstatement. Nothing but if I put it in simple terms, it depends on risk of material misstatement. If the risk is higher, if you assess it that risk of material misstatement is high, you will go for bigger sample size. If you assess that risk of material misstatement is lower, you will go for smaller sample size. So here also what kind of relationship is there? Direct relationship. So there is a direct relationship between expected rate of deviation or misstatement. Nothing but risk of material misstatement and sample size both have a direct relationship. And one more thing, it depends on effectiveness of controls also. If the controls are very effective, I will go for smaller sample size. If the controls are not that effective, I will go for bigger sample size. It also depends on tolerable rate of deviation. The misstatement which auditor is willing to accept. The misstatement which auditor is willing to accept, the risk which auditor is willing to accept. So if you observe here, what kind of relationship will be there between tolerable rate of deviation or misstatement and the sample size? What kind of relationship exists? Direct or inverse? Here there will be a inverse relationship. Very, very important guys. Here what relationship will be there? Inverse relationship will be there. Which means if I say auditor's tolerable misstatement is very low, that means auditor is willing to accept very less amount of misstatement. Auditor is willing to take very less risk, then he will go for bigger sample size. On the other hand, if I say tolerable misstatement is very high, that means auditor is willing to accept more risk, he will go for smaller sample size. So what kind of relationship exists here? There is an inverse relationship. Higher the tolerable misstatement by the auditor, lower will be the sample size. Lower the tolerable misstatement by the auditor, higher will be the sample size. So inverse relationship exists. It even depends on characteristics of population. Like for homogeneous population, we will select a smaller sample size. For a heterogeneous population, we will select a larger sample size. So these are the various factors to be kept in mind while deciding what should be the appropriate sample size. Now one more last concept, I will revise it from this particular chapter, which is sampling risk. Very important discussion once again. We will try to revise this sampling risk, and with that we will end the revision of audit sampling. So what is sampling risk? See, whenever auditor decides to verify the transactions on sampling basis, there is an unavoidable risk there. Why? Because when you say out of 10,000 transactions, I will perform audit procedures on 1,000 transactions, you are indirectly saying that 9,000 transactions you are not verifying. And in that 9,000 transactions which you did not verify, there could be an error, there could be a fraud, there could be a material misstatement. And since that transactions you are not verifying at all, these errors, frauds or misstatements will never come to your notice. Yes or no? So when auditor performs the audit procedures on sampling basis, there is always a risk that auditor's opinion might go wrong because of sampling. That I call it as sampling risk. So you might choose an inappropriate sample because of which you are unable to find out errors, frauds or material misstatements. This is what the simple meaning of the sampling risk. But this term has been complicatedly defined. So what they have defined is sampling risk is the risk that auditor's conclusion based on a sample may be different from the conclusion if the entire population were subjected to same audit procedure. Which means whatever conclusions you derive by performing audit procedures on the sample, if you perform the same audit procedures on the entire population, your conclusion would have been different. So what they are trying to say here, like for example, out of 10,000 transactions, I have taken a sample of 1,000 transactions. On this 1,000 transactions, I performed audit procedures. I did not find out any material misstatement. There is no material misstatement. If I would have performed audit procedures on the entire population, might be I could have found out a material misstatement. So the conclusion which you derive by performing audit procedures on the sample will be different if you perform the same audit procedures on the entire population. That risk only we call it as sampling risk. Nothing but if I put it in simple terms, the risk of giving wrong opinion because of sample or risk of selecting an inappropriate sample, we call it as sampling risk. And this sampling risk is going to have an impact on test of controls also. It is going to have an impact on test of details also. So let us try to understand how it is going to have an impact on test of controls and how it is going to have an impact on test of details. Listen carefully. This I will try to revise. So how it will have an impact on test of controls. Listen guys, listen carefully. Let us try to understand. So assume that this is a entire population of internal controls. Out of this entire population of internal controls, I have taken one small sample of internal control. This is the entire population of internal control and the smaller circle is sample of internal controls. And I performed audit procedures on this sample. I performed audit procedures on this sample. On the basis of my audit procedures, I concluded that internal controls are effective. I verified the sample of internal controls. I did not find any deviations and I have decided that internal controls are effective. If I have decided that internal controls are effective, I will try to perform less substantive audit procedures. This is what I have decided by performing audit procedures on sample. If I would have performed audit procedures on the entire population of internal controls, I would have found out some deviations. So I should have formed a conclusion that internal controls are ineffective. I should have formed, if I perform audit procedures on the entire population, I would have formed a conclusion that internal controls are ineffective. I should have performed more substantive audit procedures, but on the basis of sample, I have taken a wrong decision and decided to perform less substantive audit procedures. So if I performed audit procedures on entire population, I could have decided that internal controls are ineffective. I should have performed more substantive audit procedures, but because of sample, I am performing less substantive audit procedures. Because of sample, I am performing less substantive audit procedures. This risk we call it as risk of over-reliance. As the name itself says, on the basis of sample, you are overly relying on internal controls. When controls are not effective, on the basis of sample, you are believing that controls are effective. Because of that, when more substantive audit procedures are required, you are performing less substantive audit procedures. So your effectiveness of the audit will get impacted. Your work will be ineffective. Some misstatements you might not be able to identify. So effectiveness will be impacted. Effectiveness will not be there in the audit. Now, if you look at from the other way around, assume another scenario, population of internal controls. From that, I have taken a sample. On this sample, I have started performing audit procedures. And in my sample only, I got one misstatement. I got one deviation. So I thought in my sample of control only, if there is a deviation, there will be deviation in the entire controls also. So I have decided that internal controls are ineffective. So resultantly, I have taken decision that I will perform more substantive audit procedures. But if you would have performed audit procedures on the entire population, you would have come to a conclusion that the deviation which you got in the sample, that is the only deviation. In fact, internal controls are effective. Internal controls are in fact effective. Only one little bit of deviation is there. So you should have taken a decision to perform less substantive audit procedures, but because of sample, you are taking a decision that you will perform more substantive audit procedures. This risk we call it as risk of, just a minute guys. Oh god, shit. 1 minute. Yeah. So this risk we are going to call it as risk of under reliance. Why we call it as risk of under reliance? Why? Because when controls are effective on the basis of sampling, you are forming a conclusion that controls are ineffective. So when less substantive audit procedures are perfect, you are performing unnecessarily more substantive audit procedures. Here your efficiency will get affected. That means you will unnecessarily take a more time. Effectiveness will be there, but what will be impacted in the second case? Efficiency will be impacted in the second case. Similarly, this audit risk or this sampling risk will have impact even on test of details also. How it will have an impact on test of details? Let us try to quickly cover it. So now once again, imagine a population. Now the population will be of transactions entries in the books of accounts. From that, I have taken a sample. On this sample, I have performed audit procedures. And in my sample, I did not find out any material misstatement. Since I did not find out any material misstatement, I have decided that I will give unmodified opinion. I will give what? Unmodified opinion. But in fact, if you would have performed the audit procedures on the entire population, you would have concluded that there is a material misstatement. So you should have given you should have given a modified opinion, but because of sample, you are taking a wrong decision and you are giving unmodified opinion, which is inappropriate. Why? Because if you would have performed audit procedures on the entire population, you would have come to the conclusion that material misstatement is there. You should have given modified opinion, but by taking the sampling route, you are deciding that you will give unmodified opinion. So when modified opinion is appropriate, you are giving unmodified opinion. This will lead to audit risk. Here this will lead to audit risk. So this risk we call it as risk of incorrect acceptance, we call it. Why risk of incorrect acceptance? Why? Because on the basis of sample, we are wrongly accepting that financial statements are free from material misstatements, incorrect acceptance. So because of that, you will give unmodified opinion when modified opinion is appropriate. This will lead to audit risk. Now let us look it from the other way around. Once again, a population of transactions. From that, I have taken a sample. In my sample, I performed audit procedures. My bad luck, in the sample only I found misstatement. I thought that if in my sample only this misstatement is there, how much misstatement could be there in the entire population? So I decided there is a material misstatement and gave a modified opinion. But in fact, if you would have performed audit procedures on the entire population, you would have realized that this is the only mistake in the entire population that is immaterial. So you would have decided that there is no material misstatement. This is the appropriate decision. In fact, the misstatement which you got in the sample, that is the only misstatement. In rest of the entire population, there is no misstatement at all. So frankly, you should have taken a decision that financial statements do not contain any material misstatement. So you should have given unmodified opinion, but because of sampling, you are giving a modified opinion. Will this come under audit risk? No, this will not come under audit risk. Why? Because if you go back to the definition of audit, we specifically told that audit risk excludes giving a modified opinion when unmodified is appropriate. This scenario will get covered in the audit risk, but this scenario will not get covered in the audit risk. And this risk we call it as risk of incorrect rejection. What do we call it? Risk of incorrect rejection. Why the name? Risk of incorrect rejection. This name because on the basis of sample, we are rejecting the fact that financial statements are free from material misstatements, when in fact the financial statements are free from material misstatements. So incorrectly you are rejecting the fact. So this will not lead to audit risk. Understood? So this is how sampling risk will have an impact on test of controls as well as test of details. And we have one more small concept, non-sampling risk. Non-sampling risk means you are giving inappropriate opinion, but that has nothing to do with the sampling. You have selected correct sample only, but either by performing wrong audit procedures or by performing or wrongly interpreting audit evidences, or because of your human mistakes, if you form a wrong opinion, that we call it as non-sampling risk. The risk of expressing inappropriate opinion by any reason other than sampling, because of your human mistakes, inappropriate conclusions, wrong interpretations, because of that your opinion is going wrong, that we call it as non-sampling risk. That's all. So these are the key concepts from the chapter audit sampling. So successfully we are done with that also. Now we will start the next chapter, which is going to be analytical procedures. So what we'll be starting now? Analytical procedures will be starting now. So very simple and small. Let us try to quickly revise this. So analytical procedures, as we all are aware, analytical procedures is one of the method for performing audit procedures. And what exactly is the meaning of analytical procedures? So analytical procedures means in these procedures, we will try to evaluate financial information. That is, we'll try to analyze whether the financial information is correct or not, but not by doing the routine checking of checking the supporting documents, etc. How we will try to do this audit procedures is by studying plausible relationship, acceptable relationship between two things. So here we study either relationship between, just a minute guys. So here we study either the relationship between two financial items, or we even study relationship between one financial item and one non-financial item. So in the analytical procedures, we try to evaluate whether the financial information is correct or not, either by studying relationship between two financial items, or by studying relationship between a financial item and a non-financial item. Like if I have to give you examples for studying relationship between two financial items, gross profit percentage. When you calculate the gross profit percentage, simply you are studying relationship between two items, gross profit and total revenue of the company. Net profit percentage, you are studying relationship between net profit and turnover or total revenue of the company. Fixed asset turnover ratio, studying relationship between fixed assets and turnover, two financial items. So like this, I can study relationship between two financial items, or alternatively, I can study relationship between a financial item and a non-financial item. Like when, if I give you examples of studying relationship between financial and non-financial item, number one, number of employees and salary cost. Number of employees is a non-financial item, salary cost is a financial item. Or number of electricity units consumed into power and fuel charges. So electricity units consumed is a non-financial item, power and fuel charges is a financial item. Number of employees and revenue, non-financial item and financial item. So like this, I can study relationship between two financial items, and I can study relationship between a financial item and non-financial item. Now, just studying the relationship is not analytical procedure. After studying the relationship, the next step is doing comparison. What I need to do? I need to do comparison. Now here, the auditor can do two kinds of comparison. Number one, he can do intra-firm comparison, or he can do inter-firm comparison. Auditor can do two kinds of comparison. You can either do intra-firm comparison, or even you can do inter-firm comparison. Examples of intra-firm comparison, if I have to say, comparing the current year's ratios or relationships with the last year. Current year's data with the last year's data you can compare. Or current year's data with the budgets or forecast, expected information you can compare. So these are the examples of intra-firm comparison, comparing with the prior years, comparing with the budgets, etc. Whereas inter-firm comparison with outside sources, like you can compare your client's information with the competitors' information. You can compare your client's information with the industry averages. So like this, if you are doing the comparison with the external sources, that we call it as inter-firm comparison. So first we will study the relationship, then we try to do the comparison. By doing this comparison, you will find out fluctuations or deviations or unusual or unexpected relationships. By doing this comparison, we will try to find out, is there any huge fluctuation? Is there any huge deviation? Is there any inconsistent relationship? If at all you find any fluctuation, if at all you find any deviation, if at all you find any inconsistent relationship, you should not just immediately jump to the conclusion that there is a material misstatement. One more step will be there. We need to investigate that fluctuation or deviation and finally come to the conclusion, is that deviation or fluctuation, is it because of a genuine reason or is it because of a material misstatement? Is it because of a genuine reason or is it because of a material misstatement? That we need to investigate and find it out further. So like this, analytical procedures involves these many steps. First we study the relationship, then we do the comparison, then we try to identify fluctuations, deviations or inconsistent relationship, then we will try to investigate further and finally find out whether the financial statements contain any material misstatement. So this is what simply happens in the analytical procedures. Now talking about the next thing, what is the purpose of analytical procedures? See, analytical procedures can be used as risk assessment procedure, or even it can be used as substantive audit procedure. If the analytical procedure is used as a risk assessment procedure, the purpose will be to identify risk of material misstatement. If the analytical procedure is used as a risk assessment procedure, the purpose will be to identify and assess risk of material misstatement. On the other hand, if I am using analytical procedure as a substantive audit procedure, here my objective will be to find out material misstatements. See, finding out risk of material misstatement is different. Finding out material misstatement is different. So if you use it as a risk assessment procedure, you will just identify the risk of material misstatement. On the other hand, if you use analytical procedure as a substantive audit procedure, you will try to in fact find out the misstatement directly, not the risk of material misstatement. In addition to that, standard will say one more purpose. We can use analytical procedures at the conclusion of the audit also, at the stage of completion of the audit, to just determine whether the financial statements are consistent with the auditor's understanding. Whatever information that is getting presented in the financial statements, is it matching with your understanding or not? To find it out, even analytical procedures will be performed at the conclusion stage also. So broadly, three purposes of analytical procedures. You can use it as a risk assessment procedure to identify risk of material misstatement. You can use it as a substantive audit procedure to find out the actual misstatement. Even you can use it at the conclusion of the audit to find out whether the financial statements are consistent, are matching with the auditor's understanding about the entity or not. So these are three specific purposes. Now talking about timing. When I say timing, when the when the analytical procedures will be performed, I will simply say it will be used in the planning phase as a risk assessment procedure. It will be used in the testing phase as a substantive audit procedure, and even it could be used at the conclusion phase of the audit also. In one word, it can be used at all the phases of the audit. At the planning phase, it can be used, at the testing phase, it can be used, and even it can be used at conclusion phase of the audit. This is what regarding timing. And one more thing, sometimes they will ask you, what is substantive analytical procedure? We understood analytical procedure, but sometimes they might even ask you, write about substantive analytical procedure. Now, what is difference between analytical procedure and the substantive audit procedure? Once again, very simple discussion. As I have told, analytical procedure can be used either as a risk assessment procedure or as a substantive audit procedure. If you are using analytical procedure as a substantive audit procedure, that only we call it a substantive analytical procedure. Simple as that. So analytical procedure is having multiple applications. It can be used as risk assessment. It can be used as substantive audit procedure. So if you are using analytical procedures as a substantive audit procedure, that we call it a substantive analytical procedure. Why? Because as we know, when I say substantive audit procedures, it can be performed either by way of test of details or it can be performed by way of analytical procedures. Either I can perform test of details or I can do analytical procedures. If I have decided to perform analytical procedures for obtaining evidence regarding items of the financial statements, that only I call it as substantive analytical procedures. And one more thing, whether the auditor shall use test of details or he shall use analytical procedures, that who will decide? Auditor himself will decide. On what basis he will decide? On the basis of professional judgment he will decide. So this is what regarding substantive analytical procedures. Now let us talk about techniques which are available for performing analytical procedures. So broadly 4 techniques are available for performing the analytical procedures, which are: number 1 is trend analysis, number 2 ratio analysis, number 3 reasonableness test, number 4 structural modeling. So there are 4 techniques available for performing substantive audit procedures. What are they? Trend analysis, ratio analysis, reasonableness test, and structured modeling. So let us try to understand what happens in each of this technique. First, we will start with the trend analysis. As the name itself says, here what I will do is, I will study regarding one particular information over a period of time. Like for example, sales data I am tracking. Last 5 years sale data I have gathered. Now I started analyzing the trend of the last 5 years sales. I came to know that year after year, the sales are increasing at the rate of 10% per annum. And the current year's turnover, and the last year's turnover was 100 crores. Now if the trend is there, how much should be the next year's turnover? 110 crore rupees. So now I will see whether the current year's turnover is in line with the trend or not. Yes, the current year's turnover has come somewhere around 110 crores. Okay, the trend is still in line. But on the other hand, if the current year's turnover was 90 crores, here clearly the trend has been broken. I will try to analyze further, has the trend been broken because of genuine reason or management tried to understate their sales value. So like this, I will study the trend of one particular item over prior years and I will check whether account balance is moving in line with the trend or not. That I call it as trend analysis. Now talking about ratio analysis is completely the study of relationship between two financial items. Why? Because an individual balance sheet item, if I give it to you, you will not do any analysis out of it. For example, if I have given debtors balance for the current year and debtors balance for the prior year, what analysis you will do? Nothing you will do. In addition to that, if I also give you sales data of the current year and previous year, now you can make some valuable analysis out of it. So ratio analysis is nothing but study of relationship between two financial items. Why? Because individual items are often difficult to predict, but relationship with another item can be easily studied. Next one, reasonableness test. In the reasonableness test, I will not go to prior years. Even I will not study relationship between two financial items also. But instead what I do in the reasonableness test is, I will take the financial item and I will study its relationship with non-financial item of the same financial year. I will not go to prior years. I will not study relationship between two items. But in fact, what I will do, I will take one financial item and I will study its relationship with non-financial item of the same year, not even the prior year also. Like current year's closing stock versus current year's warehouse space, storage space. Sorry. So if I study relationship between value of the closing stock and storage space available with the company for the current year. So I am studying relationship between a financial item and a non-financial item of the same financial year. So that's what will happen in the reasonableness test. And one more thing, last thing, this structured modeling. So these are actually statistical tools. If I have to put it in simple terms, these are softwares built on advanced statistical concepts like regression, path analysis, etc. These systems will automatically study the data and predict the outcome. So such a kind of software tools which are developed using statistical concepts which do the comparisons automatically, that I call it as structural modeling. However, this method is not that frequently used by the auditors. Why? Because normal technology only will not be comfortable in using. Now technology mixed with the statistics, two gray areas are involved here. That's why it is a very rarely used method in the industry. So whatever it is, four techniques are available: trend analysis, ratio analysis, reasonableness test, and structural modeling. Clear? Now talking about the next question. So next concept actually, if you want to perform analytical procedure as a substantive audit procedure, it involves 4 steps. How many steps? 4 steps. Let us try to understand what are they. Let me open the material. Yeah, so this is what I am talking about. What are the steps? So if you read it here, what are the steps involved in performing analytical procedure as a substantive audit procedure? So if you want to use analytical procedure as a substantive audit procedure, it involves 4 steps. What are they? Number 1, we need to determine the suitability of analytical procedure. Nothing but which analytical procedure is suitable for which item of financial statement. First we have to decide that. Like just now I have told you, there are 4 broad techniques for performing analytical procedures like trend analysis, ratio analysis, reasonableness test, structured modeling, etc. Now out of these many techniques, which technique will be suitable for which item of financial statements, that needs to be decided or not. So that is the first step. So once you are done with determining the suitability of analytical procedure, then we need to evaluate the reliability of data. So as we all are aware, the results of analytical procedures, whether they are reliable or not, that depends on the data which you are using for performing analytical procedures. Is it reliable or not? So if the data which you are using for performing analytical procedures is reliable, obviously the results of the analytical procedures also will be reliable. So that is the second step, determining reliability of data. So first we will determine which analytical procedure will be suitable for which assertion. Second one, we will determine whether data is reliable or not. Once we are done with that, the third step is whatever expectations that we have developed or whatever deviations that we have developed, whether that will result in a detection of misstatement or we are doing wasteful analysis, that we need to find it out. So this I will try to explain in a separate question. So each and every point here will be a separate question that we will talk about it. So just carefully follow. So whatever expectation that we have developed using analytical procedure, whether that will result in a material misstatement or not, that we need to analyze. That is the third step. And finally, the last step in performing analytical procedure as a substantive audit procedure is further investigation of whatever deviations that have been found out. So these are the 4 steps involved in performing analytical procedures. Number 1, determine the suitability of particular analytical procedure. Number 2, determine the reliability of data. Number 3, check whether expectation developed using analytical procedure will result in a material misstatement or not. Last one, do the further investigation. So let us try to understand how to fulfill each of this step. Talking about the first step, determining suitability of particular analytical procedure. See, which analytical procedure will be suitable for which item of financial statements. This decision should be taken by whom? Auditor. On what basis he has to take that decision? Professional judgment. That's all. Answer is over. So if they ask you how to determine the suitability of particular analytical procedure for a given item of financial statement, it has to be decided by auditor. And on what basis auditor will decide? Exclusively on the basis of professional judgment. That is, using his knowledge, experience and training, the auditor shall decide which technique will be suitable for which item of financial statement. Sometimes a simple predictive model will work. Like if the revenue is increasing, profit should increase. Sometimes these kind of unsophisticated predictive model can work as an effective analytical procedure. But sometimes you might need advanced and complex relationships to find out a material misstatement. So like this, that is what question number 8 is about here. If you observe carefully, the next 4 questions will be talking about each and every step in a detailed manner. So in the question number 7, 4 steps they are saying. The remaining 4 questions are, the next 4 questions are addressing each of the step. So question number 8, suitability of analytical procedure. Which analytical procedure will be suitable? It depends on what? The summary is that it has to be decided by auditor. That is, auditor will use his professional judgment. Auditor will analyze which technique will help him in identifying material misstatement, and on the basis of that analysis, auditor will decide which analytical procedure will suit him. And sometimes a simple unsophisticated predictive model can also work, but sometimes you might be required to study advanced relationships also. It all depends on facts and circumstances of each case. So first step done. Okay, using my professional judgment, I have decided which technique will be suitable. What is the second step, guys? Determining reliability of data. Why? Because the results which you are getting from analytical procedures, whether they will be reliable or not, that depends on the data which you are using for analytical procedures. Is it reliable or not? Which means if the data which you are using for analytical procedures is reliable, obviously the results of that analytical procedures also will be reliable. On the other hand, if you perform analytical procedures on a non-reliable data, obviously the results of analytical procedures also will not be reliable. So that is what the introductory statement they say here. The reliability of results of analytical procedures depends upon reliability of underlying data. Accordingly, the following are relevant when determining whether data is reliable for the purpose of substantive analytical procedures or not. So the results of analytical procedures, whether they are reliable or not, that depends on reliability of data. Now, how to decide whether data is reliable or not? That's what the factors are going to say here. So what are the factors which will determine the reliability of data? Let us see. So it depends on source of the information available. So whether data is reliable or not, it depends on the source from which you are getting it. If you are getting it from a reliable source, yes, data will be reliable. If you are not getting it from an independent source, then data will not be reliable. Next, it depends on comparability. The more comparability the information has, the more reliable it will be. For example, if you are conducting audit of such a business which is selling customized products, there is no competitor to compare the data. So you will not be able to determine whether that data is reliable or not. On the other hand, if you have a close source to compare, then the data will be reliable. So second factor which will decide the reliability of data is comparability, whether the given data is comparable with other items or not. And third one, it depends on nature and relevance of the information. What is the nature of the information? How relevant that information is for you? That also will decide. And finally, what are the controls which are operating over the preparation of that data? If the controls over the preparation of data are working effectively, then data will be reliable. If the controls over the preparation of data are not working effectively, then the data will not be reliable. Clear? So these are all the factors which will decide whether data will be reliable or not. 4 factors, guys. Simply the source from which you are getting the information, comparability of that information, that is whether the information is comparable or not. Third one, nature and relevance of the information. Fourth one, controls over the preparation of data. Now talking about next step, so we have determined the suitability of analytical procedure. We have determined whether data is reliable or not. The next step is what are the matters which are relevant for the auditor's evaluation of whether expectation developed using this analytical procedure, will it result in a material misstatement or not? Important question, guys. I will explain this in a detailed manner. Please pay attention. See, by performing analytical procedures, sometimes I will get a deviation. Quite possible I studied the relationship. By studying the relationship, I got deviation. Now what I will do to that deviation? I will investigate. Now once I investigate that deviation, 2 outcomes could be possible. One is by doing investigation, I might find out a material misstatement. But sometimes after completing my investigation, I will come to a conclusion that till now I have done the wrong analysis. I might come to a conclusion that till now I have done a wrong analysis. So once I find out deviation or fluctuation, if I investigate that further, there are chances that I will find out a material misstatement. At the same time, there are even chances sometimes I end up doing wrong analysis. I will realize it till now I have done the wrong analysis. This is not the proper analysis. So what are the factors that will help you to find out whatever expectation, whatever deviation that you have found out by doing the analytical procedures, will it result in a material misstatement or will you end up doing wrong analysis? That depends on what factors. A bit complicated, guys, but since this is a marathon, we can't dig deeper. Why? Because this alone small question will take half an hour of discussion. So I am revising it. If possible, I will try to upload a separate video talking in a detailed manner about that evaluation. Okay, so just we are revising it. Just go with the flow. So what are the factors which will decide whatever expectation, whatever deviation that you have got it by performing analytical procedures, whether that will result in a material misstatement or you will end up doing wrong analysis? That depends on what factors. So as per the answer, that depends on 3 factors actually. Number 1, the accuracy with which the information can be predicted. Higher the accuracy in prediction, more chances that the deviation will result in material misstatement. Lesser the accuracy with which you can predict the data, lesser will be the chances that that deviation will result in a material misstatement. One simple example to make you understand. Assume that I studied gross profit of a company which is engaged in automobile sector. Like I studied the gross profit of Tata Motors. So gross profit of Tata Motors is, my client company is Tata Motors. So gross profit of Tata Motors is, assume some 35%. Now the close competitor for Tata Motors, Maruti Suzuki, exactly in same line of business. They maintain uniform sale prices. They obtain common kind of raw materials. So more or less on the basis of this Tata Motors gross profit, I can accurately predict the gross profit of Maruti Suzuki. Why? Because they're more predictable. Gross profit is more predictable. Both the companies are into same industry. They maintain same selling prices. They have same kind of raw material cost. So gross profit will be more or less common. I can predict it with more accuracy. So my client company Tata Motors made a 35% gross profit. But when I look at the gross profit of the Maruti Suzuki, their gross profit is only 20%. Now there is a huge deviation, 15% deviation is there. If I investigate this further, are there chances for finding out misstatement or will I end up doing wrong analysis? Here the chances for finding out misstatements are higher. I will not end up doing wrong analysis. The chances for detecting a misstatement is very much higher here. Let me give you another scenario. See, once again, I am doing audit of Tata Motors. I calculated here another ratio. Some ratio I have calculated research and development expenditure as a percentage of sales. I have calculated research and development expenditure divided by sales into 100. I came to know that my client company is spending 10% on research and development expenditure. Out of the total revenue, 10% goes to research and development. Whereas the competitor, Maruti Suzuki, they're spending only 2% on research and development expenditure. Now, if you do the comparison, there is 8% deviation. If I investigate this further, are the chances for finding out material misstatement are higher, or will I end up doing wrong analysis? Which chances are higher? Here the chances are you will end up doing wrong analysis. Why? Because research and development expenditure is not predictable. It is a discretionary expenditure. It is a non-predictable item. You can predict it with less accuracy. Why? Because if you extend this example only, if you investigate this also, even if you go and ask the Tata Motors company, sir, your competitor is spending only 2% on research and development. Why are you spending 10%? What my client will say, sir, my choice. I'm more concerned about the future. That's why I'm spending more amount. That's why I'm spending more amount of money. So research and development expenditure can be predicted with less accuracy. On the other hand, gross profit can be predicted with more accuracy. So higher the accuracy in prediction, the more chances that the deviation in that case will result in material misstatement. So that's why I told, in case of gross profit, if I get a deviation, if I investigate that further, there are more chances I will find out material misstatement. In this ratio, if I find this deviation, even if I investigate further, chances that I will end up doing wrong analysis, I will not be able to find material misstatement. So first factor is the accuracy with which the expected results can be predicted. Second one is the degree to which the information can be disaggregated, the degree to which the information can be separated. Like if I am conducting audit of Reliance Industries Limited, as we all know, Reliance Industries Limited is there into multiple business. Main business is petroleum exploration, etc. Then they have the telecom segment, retail segment, multiple businesses are there. I calculated gross profit ratio of Reliance Industries Limited for the entire company. I calculated gross profit. 40% is the gross profit. This I compared with Indian Oil Corporation, whose gross profit is 30%. Now I did the comparison. There is a 10% difference. You tell me, if I investigate this further, there are more chances for finding out misstatement or ending up doing wrong analysis. There are more chances you will end up doing wrong analysis. Why? Because Reliance Industries Limited is there into multiple businesses. Indian Oil Corporation is there into only petroleum business. On the other hand, if I divide the information of Reliance Industries Limited business wise, if I calculate exclusively what is the gross profit of only petroleum business, and that gross profit, if I compare it with the Indian Oil Corporation, there if I get a deviation, there are more chances of finding out misstatement. On the other hand, if I calculate gross profit for Reliance Industries Limited as a whole, and if I did the comparison with Indian Oil Corporation as a company as a whole, then I will not be able to find out material misstatement. I will end up doing wrong analysis. On the other hand, if I can segregate the information business wise, and then if I did the comparison, then I have more chances of finding out material misstatement. So whether you will be able to find out material misstatement or not, one more factor that will decide it, the degree to which the information can be segregated or separated. And finally, it also depends on the third factor, availability of information, whether you have completely available information or not. See, if you perform analytical procedures on complete data, on full data, completely available data, there if you get deviation, more chances for finding out material misstatement. If you perform analytical procedures on incomplete data, like your client you have 12 months of data, competitor you have only 6 months of data, but still you did the comparison, find out deviation. You tell me, will you have chances for finding out material misstatement or chances for ending up with wrong analysis? There are more chances for ending up with wrong analysis. On the other hand, if I perform analytical procedures on complete data, and in that if I got deviation, there are more chances I will find out a material misstatement. So factors which will decide whatever expectation I have regarding analytical procedure, whether they will result in a material misstatement or not, that depends on three factors: accuracy with which the information can be predicted, the degree to which the information can be disaggregated, and it also depends on availability of information. So these three factors are going to decide whether expectation developed using analytical procedure will result in a material misstatement or not. Clear? That is the third step. So three steps we have seen. Number one, determining suitability of analytical procedure. Number two, checking the reliability of data. Number three, whether expectation developed using analytical procedure will result in a material misstatement or not. And now the last step is investigation. Whatever deviations you have got, that you need to investigate. Why? Because the moment you find deviation, you should not jump that you have found a misstatement. Always the deviation will not lead to material misstatement. That deviation, we need to investigate that deviation further and thereby find out whether that difference is because of a valid, genuine reason, or is it really because of a material misstatement. Clear? And how we will investigate? We have to simply go and investigate with the management. Go and ask the management, sir, explain me why these many differences are there. If the management is not able to give you enough of explanation, then what we will try to do? We will try to perform alternative audit procedures. If alternative audit procedures are also not possible, then we modify our opinion. That's it. Understood, everybody? So this is how we need to investigate. Simply go and investigate the management, and if they are unable to give appropriate answer, try to perform alternative audit procedures. If they are also not possible, try to modify your opinion. Clear? So we are successfully done revising 4 chapters, as I have mentioned, which are actually which are actually small in size but compulsory question. What are that 4 chapters, guys? Fraud and responsibilities of auditor, audit in an automated environment, audit sampling, analytical procedures. Even though chapters are very small, since I did a comprehensive revision, we have easily taken some 3 hours of time. Around 3 hours we have spent on revising this 4 small chapters, and all this time which we have spent is really worthy. Why? Because very important chapter. Definitely the questions will be there from this chapter. In the worst case scenario also 14 to 16 marks. Understood? So this is what regarding the 4 chapters. Clear, everybody? Right. So now we will start revising the chapter audit strategy, audit planning, and audit program. So this chapter, the nature of the chapter itself is, it might not be that suitable for revision. Why? Because in this particular chapter, there is no such conceptual discussion is there which we have to revise. So why? Because the entire chapter will contain such a kind of questions which will be talking about what is the meaning of audit strategy, what are the advantages of audit strategy, what factors you have to consider in development of audit strategy. The same thing follows for audit planning and audit program. So point wise questions will be there, very less amount of concepts will be there. So we will try to do one quick and thorough revision of this chapter, audit strategy, audit plan, and audit program. And in this particular chapter, the content regarding audit strategy, audit plan, and audit program has actually been taken from the standard SA 300. So SA 300 is a relevant standard which is talking about, or which is giving all the guidance regarding audit strategy, audit planning, audit program, etc. So first let us get familiar with the terms. What is audit strategy? What is audit plan? And what is this audit program? First we will try to get an understanding how they differentiate from each other. That we will try to revise it. Then we will go into the questions from this chapter. Now, first of all, we will concentrate on audit strategy. See, audit strategy is the most summarized version. Audit strategy among all the three, between among audit strategy, audit plan, and audit program, which one is the most summarized version? Audit strategy is the most summarized version. And practically speaking, in the audit strategy, no much decisions will be taken. What simply audit strategy will try to convey is how much time we will take for completing the audit and how many resources will be required to complete the audit. That's all. The audit strategy will list out only 2 things. Within what time we will complete the audit, with what resources we will complete the audit. We will try to set it out in the form of one simple paragraph. That only we call it as audit strategy. Like for example, assume an audit firm ABC & Co. They have been appointed as auditor of the company X Limited. Now, before they actually start doing the audit, there is a requirement for doing a proper planning. And in the planning process, the first step is what? Deciding the strategy. Now, auditors, after studying about the organization, after performing risk assessment procedures and all, now the auditors ABC & Co has decided that they will complete the audit of this company X Limited within 15 days of time with an engagement team of 10 team members. That's all. This is what the strategy. what is the time required, what is the time within which audit is expected to be completed, and what is the resources, what are the resources which are required to complete the engagement. That I have decided. This audit form will try to write it in one simple paragraph. We will do the audit of this company X Limited in 15 days of time, and with a team of 10 engagement team members. That summarized paragraph only we call it as audit strategy, nothing else. So this is what the simple meaning of audit strategy, which is the most summarized version of all the three. Now what happens in the audit plan? So audit plan is nothing but allocation of time and resources, whatever you have decided in the strategy. This is the simple meaning of the term audit plan. In the audit plan, whatever time and resources that you have decided in the strategy, that allocation is going to happen. Like for example, you told that you are going to complete the audit within 15 days with 10 engagement team members. No. Now the work of the entire audit has to be divided among these 10 engagement team members. Along with that, this 15 days of time also should be allocated. Like the plan will look something like this. For example, first risk assessment procedures. It will be done by so and so concerned engagement team member, assume Mr. A, who is an engagement partner, and risk assessment procedure will be completed in 1.5 days. And then compliance procedures. In the compliance procedures, we try to study internal controls, and internal controls also will be there in different areas. Now in each area, who will verify internal control, within what time that verification will happen. Like for example, internal controls in the area of assets will be verified by a person called Mr. B, who is an audit manager. Time allocated is 1 day. Another area, liabilities. Internal controls in the liabilities related area will be verified by another person, Mr. C, who is a paid assistant. Time allocated will be 1 day. Similarly, for expenses, this area's internal controls will be verified by another person, Mr. D. Time allocated is 1.5 day. And incomes, who will verify what time it will take. Similarly, substantive audit procedures. Now, who will perform substantive audit procedures in each of this area, and what time within which this substantive audit procedures are required to be completed. So if you observe carefully, what I have done here is simply I have developed an audit plan. So from this we can say that audit plan is nothing but whatever time I have decided in the strategy, whatever engagement team members which I have decided in the strategy, that work allocation should be done among all the engagement team members, and even time allocation has to be done among all the engagement team members. That allocation of time and resources among different engagement team members, that only I call it as a plan. This is how simply an audit plan will look like. Area of work, who will do it, within what time it will be completed. Now comes the last part, audit program, which is actually the most detailed version among all the three. Audit program is a what? The most detailed version among audit strategy, audit plan, and audit program. Audit strategy is the most summarized version, which is the most detailed version. Audit program is the most detailed version among audit strategy, plan, and program. Now, what information will be there in the audit program? So, the audit program is going to contain series of verification procedures which are required to be applied to each and every area. What audit program will contain? It is going to contain a series of verification procedures which are required to be performed in each and every area of audit. If I put it in other way around, audit program is nothing but an implementation guide for audit plan. So first we develop audit strategy. On the basis of that, we will develop audit plan, and the audit plan's much more detailed version, the implementation guide for the audit plan, we call it as a audit program. So it is how typically, so if I give you one practical example, how the audit program might look like. Take for example, purchases area. In the audit plan, this work was allocated to one person, Mr. X. Time allocated was 1.5 day. Now in this 1.5 day, what and all activities Mr. X has to do, the detailed instructions, series of verification procedures, everything will be listed down in the audit program. So if I give some scenario here, audit program for purchases will look something like this. It will contain series of instruction. So I will say minimum 10% of the sample should be taken. Whatever invoices are there which are more than 10 lakh rupees, try to get the external confirmation. Whatever invoices are there which are less than 1 lakh rupees, just to do inquiry and stop it. And try to do the recomputations, try to compare the purchase expenses with the GST amount, try to do the recalculation. So like that, in this purchases area, this concerned person, Mr. X, he will spend 1.5 days of time. But in this 1.5 days of time, what and all techniques he has to follow, what and all verification procedures he has to implement, how much sample size he has to take, which audit method he has to follow, which whether controls are reliable or not. So like that, all instructions will be given. That document which contains a series of verification procedures along with instructions to the engagement team members, that I am going to call it as a audit program. So that's why I say audit program is nothing but the implementation guide for audit plan. This is what we simply need to understand, the differences between audit strategy, audit plan and audit program. Now, if we have a look at the questions from this chapter, as I have mentioned, the rest of all the questions are going to be in the form of what factors you will consider in development of audit strategy, what will be the advantages, what will be disadvantages, like that. A set of questions will be there. Let us try to quickly cover them. So just a minute. I will open the material. Yeah. So if we have a look here, what are the factors? Question number 1, what are the factors which are required to be considered in development of overall audit strategy? So as we all know, the first step, the first stage in the planning process is development of audit strategy. And in the audit strategy, as I have told, you will decide only on two things: how much time you will spend on doing the audit, how many resources you will use for completing the audit. Only these two things will be decided. But while deciding this strategy also, it is not something like whatever comes to the auditor's mind, he will decide, or he will not take the chits and decide, or he will not toss the coin and decide this much time I will spend, these many resources I will spend. It is not a decision which will be taken out of fluke. So while deciding this audit strategy, auditor needs to consider various factors. So what factors you will consider, so while developing audit strategy? Number 1, characteristics of the engagement. You need to study about the characteristics of your client's audit engagement, like what is the size of the organization, how many locations they have to do the audit, what will be their volume of operations, what is the size of the entity. So like that, first factor which you need to consider is consider the characteristics of the engagement. Nature and characteristics of your client you have to keep in mind. Then reporting objectives, you need to even keep in mind, is there any reporting objective, is there any time limit within which you are supposed to complete the audit? Consider that reporting objectives. And even if there are any other factors which are significant, which are important in your professional judgment, try to consider that factors also. And even try to consider the results of preliminary engagement activities also. Before we actually start doing the audit, we will perform some activities called preliminary engagement activities. Sir, what will be that preliminary engagement activities? So very simple. Preliminary engagement activities will be, before I accept the client's engagement, I will try to perform some factors regarding accepting and continuation of client relationship, which we have seen in the chapter nature, objective and scope of audit. So 4 things like checking whether management is having integrity or not, whether you will be able to comply with ethical requirements, whether you have enough of competence to complete the audit, and significant matters which have arisen during the course of audit. So those activities will come under preliminary engagement activities. Along with that, checking with the compliance of engagement requirements. And even communicating with the previous auditor. Even you have to communicate with the previous auditor. That is also one of the preliminary engagement activity. So like that, before you actually start doing the audit, you would have performed some preliminary engagement activities. By performing that preliminary engagement activities, you would have got some information, even use that information also in deciding that audit strategy. And if you have performed any other assignments for this client in the past, if you have done any other engagements, like previously you have done tax audit for them, or previously you have done internal audit for them. So if you have performed any other assignments for the same client, and from that other engagements, if you have got any knowledge, consider that knowledge also in deciding the audit strategy. And finally, determine how many number of resources you have, whether do you have enough of resources. If I am having a very limited number of resources available, what I will do is I will try to extend my timeline. If I have plenty of resources, I will try to reduce my time limit. So like this, the auditor, after keeping all these factors in mind, like characteristics of the engagement, reporting objectives, significant factors, results of the preliminary engagement activities, knowledge which you have gained on other engagements, and keeping in mind the nature, timing and extent of resources, auditor will decide within what time and with what resources he is going to complete the audit. Now, by establishing this audit strategy, there will be various advantage. And one important statement here for true or false statements, the auditor shall establish overall audit strategy that sets the scope, timing and direction in the development of audit plan. Which means first auditor will decide audit strategy, and on the basis of that audit strategy, the auditor is going to develop the audit plan. Sometimes they might confuse you in the examination in the form of a true or false statements. What they will say is the auditor will establish an audit plan that sets the scope, timing and direction in the development of audit strategy. Do you agree with that? No. The auditor will establish audit strategy that sets the scope, timing and direction in the development of audit plan. So first audit strategy and then only audit plan. And even audit strategy will be established after risk assessment procedures, not before the risk assessment procedure. Why? Because one of the factor which I told you to consider in development of audit strategy is nature of the engagement, characteristics of the client. And you will come to know about the characteristics of the client only after performing risk assessment procedure. So first we will perform risk assessment procedure, then only we will proceed further for development of audit strategy. And what benefits will be there for establishing audit strategy? You will be able to betterly deploy your resources. Betterly you can handle your resources. Which work has to be done by which person? In case if there is a complex area, there you will allocate highly experienced team members. If there is a less complex area, there you will try to allocate less experienced team members. So you can take better decisions regarding deployment of resources by having a strategy in place. And even how many number of resources are required for each audit area. Like for purchases, how many people are required? For sales, how many people are required? For inventory verification, how many people are required? That you can betterly plan. And when these resources are to be deployed, should I use one engagement team member from the beginning, or his presence is required somewhere halfway through the audit? So even you can plan the timing of the resources also. First, you will decide better resources, which characteristics of the resources, like whether you require experienced resources or less experienced resources. That is number one. Second one, you can decide on how many number of resources you will require. Number three, you can even plan the timing when the resources will be required. At the beginning they will be required, or at the ending they will be required, or during the course of audit you need the resources. You can even betterly decide on timing of the resources also. And even you can betterly manage your resources. You can provide them proper directions, and even you can supervise them properly. And if you have a strategy in place, even you can betterly plan your meetings also. Team briefings, we say. Engagement team discussion will have meetings among themselves. So you can betterly plan that meetings, not that meetings, even you can plan where they are expected to take place. Should they take place on site or off site? Should they happen at the client's premises or auditor's premises? That decisions also can be taken. So if you establish audit strategy, all these advantages will be there. Now, once we develop audit strategy, the next step is what? Development of audit plan. So now this question is, what and all you will try to cover in your audit plan? What and all aspects should be covered in the audit plan? What and all activities must be included in your audit plan? Very simple, guys. In your plan, you should allocate sufficient amount of time for understanding about client's business. Nothing but in your audit plan, you need to allocate some amount of time for risk assessment procedures. After that, you need to allocate some amount of time for determining reliance on control to be placed, reliance to be placed on internal control. Nothing but you should allocate some time for compliance procedures also. After that, in your audit plan, even you should try to allocate the time for nature, timing and extent of audit procedures. Nothing but once again here, substantive audit procedures. Very simple, your plan should cover time for risk assessment procedures. Your plan should cover time for compliance procedures. Even your plan should cover time for substantive audit procedures. Finally, you should even allocate some amount of time for coordinating the work also. So if you have decided to do the audit for 15 days, you should not plan the audit even on the 15th day also. You should complete audit by 13th day or 12th day. Some last 2-3 days, you should keep it for coordination, so that all the engagement team members will sit together, discuss their observations, and they will form a common conclusion. So in your audit plan, try to reserve some time for coordination also, for meetings and discussions also you have to allocate. So your plan should cover time for risk assessment procedures, for compliance procedures, for substantive audit procedures, and even you should set out some time for coordination of the work of engagement team members also. Now, what will be the benefits of planning? One simple thing, guys, whatever benefits we have seen for audit strategy, almost all the same benefits will be there for audit planning also. So I'm not reading it once again. Why? Because most of the points will match here. And even in the exam, if you are not exactly able to remember, you are, I will say one simple suggestion. So if you are feeling troublesome in remembering these many answers or advantages of audit strategy, advantages of audit plan, how can I remember these many number of points? I will suggest you one simple thing. Just remember one benefits of audit strategy you remember. If they ask you benefits of audit strategy, write the same thing. If they ask you benefits of audit plan, then also write the same thing. See, I'm not saying it just because whatever comes to my mind. I'm saying it because even if you have some time, go through these points, you'll be able to realize that most of the points will match. I will not say if you write the same answer, you will get full marks, but at least by writing some similar points, 60-70% of the marks you will get no. But you are reducing your time for the preparation here. So that's why even if they ask you what are the benefits of audit plan, write the same benefits which you have read for audit strategy only. So this is what regarding benefits of audit planning. And next question, see, as I have told, you have to develop your audit strategy after knowing the client's business. Everybody agree with me or not? We have to develop audit strategy, audit plan, etc. once we have very good knowledge of the client's business. Okay, understood. Knowledge of the client's business is important. But if I am asking you, boss, go and obtain the knowledge of client's business, what you will exactly try to obtain knowledge of? You are an article assistant, assume I'm calling you and I'm asking, we are going to do audit of so and so company. I want you to go to the client's premises and get the knowledge of our client. You are an article assistant. I gave you that responsibility. What things you will try to understand, or what matters regarding which you will try to obtain knowledge of? What you will try to understand? Very simple. What I will try to understand is, if someone is asking you what matters you will try to understand regarding client's business, very simple. First, I will try to understand external requirements, external factors, to which industry my client belongs, what kind of business they are engaged into, what are the laws and regulations which are applicable for them, what is their applicable financial reporting framework. First, I will try to understand these external factors. To which industry my company belongs, what are the laws and regulations which my client has to comply with, what is the applicable financial reporting framework for that client. So first, I will try to understand their external matters. Number two, I will try to understand their internal matters, like what kind of operations they are doing. If they are manufacturing entity, is that a capital intensive company or labor intensive company? How the company is financed? Is it debt financed or is it equity financed? Who are the key people in the organization? So like this, I will try to understand internal matters. Then I will try to understand about their accounting policies, what accounting policies they are following. And whatever accounting policies which they are following, are they appropriate? Are they consistently applied? This I will try to understand. I will try to understand what business risk my client is facing, what strategies they are following, and what risk my client will be facing. Like different businesses will have different kind of risk. Some companies will have a risk of failing to update with the changes in the technology. Some companies will have a risk of lack of able to get the financing from the borrowers. Some companies will not be able to get the financing. That is a risk for some companies. Some companies might have a risk that their products are getting obsolete. That means their products are no longer relevant in the industry. So like that, I will try to understand what strategy my client is following and what business risks they are facing. Along with that, even I will try to understand their financial performance also. I will try to review their financial performance by reading this credit rating reports, by reading their credit scores. Even I will try to understand financial performance. So if someone is asking you, go and obtain the knowledge of client's business, these are the specific things which you need to understand. What are they? External matters, internal matters, their accounting policies, what risk they are facing, what strategies they are following, what is their financial performance. All these things you need to obtain an understanding of. So these are the 5 points. That's what this question number 5 will be. What is the client, what knowledge you will try to obtain regarding client's business, right? So now talking about next thing is, audit planning is a continuous process. So audit planning is not a one-time activity. It is continuous and iterative process. That doesn't mean throughout the audit we'll be doing only planning. No, that is not what the meaning of the sentence. The meaning of the sentence is, at the beginning of the audit, we will develop our audit plan. But it is not a requirement that once you have decided your plan, you have to bind by it strictly. No. We will decide audit plan, but during the course of audit, If we find that we are required to make some changes to the audit plan, you are always open to make that changes. And sometimes you have, if your audit has to be effective, you have to definitely make the changes. You cannot say, so I have decided my plan at the beginning of the audit, I will follow it strictly, no matter whatever happens, I will not deviate. You can't pass these statements. At the beginning we will decide audit, but during the course of audit, if any changes are required, we should be ready to make that changes in order to make our audit effective. So that's why they say that even SA 300 also says that planning is not a discrete phase of an audit. It is not a separate phase of an audit, but rather it is a continuous and iterative process. It is a repetitive process. And this planning process often begins after the completion of the previous audit, and it will continue until the completion of the current audit assignment. So audit planning will start from the time the last year's audit is completed, then the audit planning will start and it will continue till the completion of current year's audit. What does that mean? Throughout the audit we'll be doing only planning? No, at the beginning of audit we will do the planning, but throughout the audit, if at all, if any circumstances require us to make the changes to our plan, strategy, etc., we will be ready to do it. That is what the meaning of the sentence. Clear? So that is what all this question is about. Audit planning is a continuous process. Yes, you have to agree to that statement and write why it is it. Clear? Next one. So then, now let me ask you one more question. See, preparation of audit strategy and audit plan, it is whose responsibility? Preparation of audit strategy and audit plan, it is whose responsibility? Undoubtedly auditor's responsibility. Auditor is responsible for the preparation of audit strategy and the audit plan. Does that mean auditor single-handedly, without involving anybody else, will he single-handedly develop audit strategy and audit plan? No. There is no doubt auditor is responsible for development of audit strategy and audit plan, but he will not do it single-handedly. He will involve different people. Whom he will involve? So there is no doubt engagement team members he will involve. His audit assistants, his paid assistants, audit managers. There is no doubt engagement team will be involved. Sir, why engagement team involvement is required? Why? Because if you involve engagement team members, you will come to know what are the capabilities and expertise of each of your engagement team member, so that work allocation can be done in a better manner. You can allocate the work in a better manner. So if you have to allocate the work in a better manner, definitely you have to involve engagement team members while development of audit strategy and audit plan. There is no doubt about it, and in fact auditor will do it. Along with the engagement team members, sometimes even auditor might be required to involve management and client's staff also. What even auditor should do? Should even try to involve management and client's staff also. Sir, why management and client's staff's involvement is required, sir? Why? Because during the course of audit, at various instances, we need the help of the management. We need the help of client's staff. Like for example, I want to do physical verification, but at that point of time, I want the store in charge to be available. So if the store in charge is there, then only I can do physical verification. So that's why at various instances of the audit, since we are required to take the help of management and client's staff, even you have to involve the management and client's staff in the development of audit plan and strategy. But one thing we have to make sure, we should not discuss detailed audit plan with them. What we should not do? We should not discuss detailed audit plan with them. Why? Because if you discuss the detailed audit plan with them, what you are going to do becomes predictable. If it becomes predictable, effectiveness of the audit will be lost. So we have to involve management and client's staff only to the extent it is necessary of their involvement. We should not discuss a detailed audit plan and strategy with them. Why? Because that will make our audit plan and audit altogether, audit will become ineffective if you discuss a detailed audit plans with them. Clear? Next one. So once again, write a short note on changes to planning the decisions during the course of audit. Repeated question only. As I have told, during the course of audit, because of some reasons, we might be required to change our plans. We might be required to change our decisions, whatever we have made regarding our audit strategy and plan. We might be required to make some changes to the decision. Sir, why that changes will be required? So might be sometimes we come across unexpected events. Some unexpected events will happen that might require us to change our strategy, planning and program. or even that could be because of change in conditions. Whatever conditions that are prevailing at the time when we are planning the audit, those conditions might not be there at the time when the audit is getting performed. That change in conditions also might require the auditor to change the decisions regarding strategy and plan. Or even sometimes auditor will come to know about extra information which is not available at the time when you have planned for the audit. So like this, because of unexpected events or because of change in conditions or some extra information coming to the auditor's knowledge, because of these reasons, you might be required to make changes to your audit strategy and audit plan. Clear? Next most important question. See, undoubtedly, when we go for audit, if I am an engagement partner, as I have already told earlier, I will not single-handedly go and complete the audit. I will take all my team with me. And when I am taking a team with me, definitely I am taking the team along with me to allocate the work to them. So if I have taken 10 people along with me for the audit, for each and every person, I will allocate the work. Now, being an engagement partner, whatever work I have allocated to my engagement team members, can I blindly believe it, or should I need to review that work done by my engagement team members? The standard says you need to review the work allocated to your engagement team members. Not just review, you need to direct them. You need to give proper instructions how the work has to be carried out. You need to supervise them when they are doing the work, whether they are doing the work properly or not. You need to supervise them. And after they have completed the work, the engagement partner should even review the work performed by engagement team members. So there is a requirement for the engagement partner for providing direction, instructions to the engagement team members or supervising them when they are actually doing the work. And after they have done the work, there is even a requirement on the engagement partner to review the work performed by engagement team members. Now, what are the factors which affect extent of direction, supervision and review? That means, will you give more direction, more supervision, more review, or will you give less direction, less supervision, less review? That depends on what factors. Understood the question first? What are the factors which affect direction, supervision and review of engagement team members? Which means, as I have mentioned, whether you will give more direction, more supervision, more review, or will you give less direction, less supervision, less review? That depends on what factors. Very simple, 4 factors they will say. Number 1, it depends on size and complexity of the entity. See, if the client's operations are very complex, very difficult to understand, I will give more direction, more supervision, review. On the other hand, my client's operations are very simple, then I will give lesser direction, lesser supervision, lesser review. And also it depends on area of audit. Some areas might be very complicated. In that area, you have to give more direction. Other areas might be very simple. There you give less direction. So it depends on area of that particular audit also. It even depends on risk of material misstatement. If the risk is very high, more direction, more supervision, more review. If the risk is low, lesser direction, lesser supervision, lesser review. It even depends on capabilities and competence of individual team members. How capable and competent your team members are. If the team members are more experienced, well versed, they are very much capable, they have done this kind of audit so many number of times, lesser direction, lesser supervision, lesser review. On the other hand, my engagement team contains some new candidates for whom this kind of audit is new for them. I will give more direction, more supervision, more review. So like this, what extent of direction, supervision and review you will give, that depends on these factors: size and complexity of entity, the area of the audit, risk of material misstatement, and it even depends on capabilities and competence of individual team members. Clear? Important question from the examination perspective. And 10th question, very general question: whatever audit strategy and whatever audit plan that you have developed, that needs to be documented. Why? Because it contains all the key decisions which you have taken regarding the audit. So whatever audit plan, audit strategy that you have decided, you should not just throw it away. You need to store it as a part of your audit documentation. And what and all you will document? So I will document my overall audit strategy. I will document my audit plan, and any changes if I have made to the strategy and plan during the course of audit, I will record the changes. Not just recording the changes, even I will update what are the reasons for such changes and whatever discussions I had with the entity's key persons and other communications or agreements, and finally your auditor's report. All these things should form part of your audit documentation. Clear? So then comes the audit program related questions. As I've already told you, audit program contains series of verification procedures to be applied for each item of the financial statements, not just time and resources. In the audit program, I will mention even instructions regarding verification procedures which are required to be followed by my engagement team members. And it is nothing but an implementation guide for audit plan. Audit program is nothing but what? An implementation guide for audit plan. So in simple words, audit program is nothing but it is a detailed plan of applying the audit procedures in each of the area, along with the technique which you have to follow, along with the evidences which you have to obtain. But one problem with this audit program is you can't develop one standardized audit program which can be used for all the clients. We can't do it. We can't develop one single audit program which suits the requirements of all the clients. We can't do it. Why? Because client to client, nature of industry changes, nature of operation changes, risk changes, the manner of business changes. So that's why we can't develop one single audit program which suits requirements of all the clients. So that's why, depending on requirement of each and every client, we need to customize our audit program. What we need to do? We need to customize our audit program depending on requirements of each and every client. We cannot develop one standardized audit program. We have to customize it according to the requirements of each and every client. Clear? And what points you will keep in mind while developing an audit program? We should always try to stay within our scope. We have to decide audit program in such a manner that we are not going beyond our scope and limitations. And you have to identify the best evidence and include instructions to obtain the best available evidences. And I should give instructions to apply only those steps which are useful. Don't unnecessarily include routine and useless steps in the audit program. Don't unnecessarily waste the time. And even I should consider all possibilities of error, and even I should give instructions regarding coordination, which person has to coordinate with which person, give the instructions for coordination also. And few more elements regarding audit program. Audit program cannot be an oral audit program. It should always be in a written format. An audit program is always a written audit program. And in the audit program, objectives should be stated along with instructions to the assistants also should be included. And how much you can rely on internal controls, include it in the audit program. Timing, how much time you have to perform, that also you have to include it. And your audit program should be always in line with audit plan. Your audit program should not deviate from the audit plan. Your audit program should always be in line with audit plan. And like the way we are making changes to audit strategy and audit plan as and when required, similarly in the audit program also, during the course of audit, if you feel like some circumstances require you to make the changes to the audit program, you are open to do it. Like the way we can make changes to audit strategy and audit plan, we are even permitted to make changes to our audit program also. So the auditor shall continuously update the audit program as and when the audit progresses. During the course of audit, if you find out any new instruction, you can add it to the audit program. If you find some instruction as redundant, not at all useful, you can remove that from the audit program after consulting with appropriate senior or engagement partner. So that periodical review of audit programs also will be required. Next questions are going to be common advantages of audit program. Once again, this will contain most of the points which will be similar to advantages of audit strategy and audit plan. But the thing here is the audit program will even contain disadvantages also. By having audit program, there will be even some disadvantages. What are they? The work will become more mechanical. Since engagement partner is giving all the instructions which audit team member has to follow, so some people might feel that audit program is becoming very mechanical. So that means some routine work they are doing, so engagement team members might lose interest in the audit. And also it becomes rigid and inflexible. That means once instructions are given, you have to strictly follow. Sometimes you will not be permitted to deviate from the instructions. So that's why it becomes inflexible. You cannot adopt changes into that audit program. That is one more disadvantage. It becomes rigid and inflexible. And also sometimes inefficient assistants may take shelter behind this program. Sometimes some lazy people will be there in the engagement team. They will be given some 10 instructions in the audit program. They will follow. See, even after following the 10 instructions, there is one straight away on the face one fraud is there. Even an instruction is not given, some fraud is there which is on the face it is visible. Even without any instruction also you can follow. You can find it out. And in fact, that article assistant has found out the fraud, but he did not report it to the engagement partner. When someone asked him, boss, this fraud, why you did not report? He is telling that my partner told me only 10 instructions to follow. I followed that 10 instructions. I did not find out the fraud. So you can't blame me. So like this, inefficient staff, lazy staff might try to take the shelter under audit program. Sometimes the frauds and errors will be there which are directly visible. Without any instruction, you can find it out. But still this lazy staff will not report it and they will try to take protection from this audit program, saying that this instruction was not given. That's why I did not find out. So like this, inefficient assistants may take shelter under this audit program, and sometimes it will kill the initiative of the efficient and enterprising assistants. That means some article assistants or some audit team members will be creative. They will come up with new thoughts. But since they are given a list of instructions, they will lose the interest. Even if they have some innovative thoughts, but his engagement partner might not agree. Sometimes some engagement partners will be very rude. Even if you take some instructions to them, even if you take some new thing which has come to your notice to them, they will say no, simply follow the instructions which I have given you, don't be over smart. So if you listen these kind of things from the partner, that will kill the initiative of the engagement team members. So like this, audit program contains advantages, but not just advantages. Audit program sometimes will even bring these kind of disadvantages also. Clear? So this is what the disadvantages of audit program. So with this, we are done with all the concepts from SA 300, audit strategy, audit plan and audit program. We are done. Clear? But one more small concept is there from this chapter, which is regarding materiality. Which is regarding what? Materiality. And regarding materiality, there is one standard SA 320 which has given the guidance relating to how to fix the materiality, meaning of materiality, etc. So let us try to quickly revise this materiality related concepts also. So long ago we have seen when a misstatement will be considered as material. So as I have already mentioned, as we have already revised in the chapter fundamentals of audit or introduction to audit, we have seen that a misstatement will be considered as material if it could influence the decision of users of financial statements. So when a misstatement will be considered as material, a misstatement will be considered as material if it is having the capability to influence decisions of users of the financial statements. Because of some misstatement, if the users are changing their decision, that we simply call it as material. But the problem with this materiality is it is not a exact definition. We can't precisely define materiality. It is not an absolute term. Rather, it is a subjective term, or even we can say it as a relative term. Materiality is relative. Whatever is material in one circumstance, that might not be material in another circumstance. In the Reliance Industries Limited, 1 crore is not material, but the same 1 crore will be material in another company which is hardly having a turnover of 100 crore. So that is what the meaning of relativity. Materiality is a very much relative term. It is very much a subjective term. Understood? Next, and one more thing here, and one more specific thing here. Materiality can be either decided in the quantitative terms, or materiality can be even decided in qualitative terms also. But in most of the cases, we decide it in amounts and figures, percentages we can say, like 1 crore is material, 10% is material. So in most of the cases, we decide materiality in quantitative terms, in numbers. But sometimes qualitative aspects also can be material. Like if I say fundamental accounting assumptions are material. See, fundamental accounting assumptions are not something which are numbers. Fundamental accounting assumptions, like whether financial statements are prepared on going concern basis, whether they follow accrual basis, these are material things or not. But are we deciding them as material because of the figures? No. This is something which is qualitative. Other than amounts and balances also sometimes could be material. So the point which I want to make here is materiality need not be always expressed in quantitative terms. Materiality sometimes can be based on qualitative aspects also. Other than figures and numbers also, sometimes some items could be material. Now let us talk about how to fix the materiality, fixing of materiality. Very simple. The standard says that, SA 320 says that materiality can be decided by multiplying an appropriate percentage with a suitable benchmark. You have to decide one percentage. Once again, depending on your professional judgment, you have to decide one percentage. That percentage should be multiplied with the benchmark. Like for example, some 5% I have decided. Now this 5% should be multiplied with the benchmark. Sir, what could be benchmark? Sir, benchmark could be anything from the financial statements. It could be net profits. It could be gross profits. It could be turnover. It could be net worth. It could be total expenses. So like that, any item of the financial statements can be taken as a benchmark. So you will take a benchmark, you will decide one percentage. By multiplying that percentage with the benchmark, you will get something called materiality. Like I have taken profit as a benchmark. Profit is 100 crore rupees. 5% is materiality, which I have decided 5% into 100 crores. 5 crores will be my materiality. If the misstatement is less than 5 crores, I will not modify my opinion. If the misstatement is more than 5 crores, then I will modify my opinion. So this is how materiality will be fixed. And the standard even says materiality should be fixed at two levels: overall materiality and performance materiality. Materiality should be fixed at how many levels? Two levels. What are they? Overall materiality, performance materiality. Now, what is this overall materiality? The materiality level decided for the entire financial statements as a whole. The materiality level decided for overall financial statements, that I call it as overall materiality. There is other name for that. We even call it as pervasive level materiality. Like if I am saying, if the entire financial statements contain 10 crores of misstatement, then I will consider entire financial statements are misstated. So like that, if you decide the materiality for financial statements as a whole, that I call it as overall materiality. On the other hand, if you are deciding materiality for individual items of the financial statement separately, that I call it as performance materiality. Like I am deciding materiality for purchases separately. If purchases contain 2 crores of misstatement, then I will consider purchases as misstated. If the sales contain 1 crore of misstatement, then I will consider sales as misstated. So like that, if you are deciding materiality level for individual items of the financial statements, that I call it as performance materiality. So like this, materiality as per SA 320 should be decided at two levels: overall materiality and performance materiality. Then coming to few more points. Sir, you are telling a percentage has to be multiplied by benchmark, and you have given various examples of the benchmark. Now how to decide which one will be appropriate benchmark? So you are telling profit also could be a benchmark, gross profit could be a benchmark, turnover should be a benchmark, can be benchmark, net worth can be a benchmark. So like that, these many examples you are saying, but which benchmark auditor has to take? So that depends on some factors. Sir, which factors? Sir, the factors will be like, it sometimes there will be indication in applicable law or regulation. Like for example, in case of Income Tax Act, they say 40A3 payments. If the cash payments of more than 10,000 rupees, they will be disallowed. Now, while verifying cash payments, what will be my materiality level? 10,000 will be materiality. So like this, sometimes there will be application in law and regulation. Sometimes there will be indication in applicable financial reporting framework. Like Schedule 3 is saying, any item which is more than 1% of overall turnover should be stated separately on the face of P&L. So now indirectly Schedule 3 is giving a hint that turnover can be used as a benchmark. Or it could even depend on information requirements of users of the industry. Like in case of IT sector, people are more interested to know about net profits. In case of FMCG sector, people are more interested to know about turnover. So if I am conducting audit of FMCG, I will take turnover as a benchmark. If I am conducting audit of a IT company, I can take net profit as a benchmark. So sometimes it depends on information requirements of users of the industry. So like this, the auditor will consider various factors. Then he will decide which benchmark will be suitable for deciding materiality level. Understood? And then finally, what could be the sources from which the benchmark could be taken? So assume after considering all these factors, I have decided profit will be my benchmark. From where I will take the profit, sir? From where I will take is, if the current year financial statements are ready, from the current year financial statements only I will take it. In case if the current year financial statements are not ready, I can take it from the previous year's financial statements, I can take it from the budgeted figures, or even I can take it from the interim or quarterly financial statements also. So these are all the various sources from which the benchmarks can be taken from. And one more thing here, this materiality also, whatever I have decided, you need not strictly follow it during the course of audit. Because of change in the circumstances, even you can revise your materiality levels. There is no hard and fast rule that you have to follow materiality throughout. Whatever materiality that you have decided at the beginning of the audit, that you have to follow it strictly. No, not required. During the course of audit, because of some circumstances, if you would feel like revising the materiality levels, you can successfully do it. So revision of materiality is also permitted. And not just that, even you have to document the materiality related information also. So how you have decided overall materiality, how you have decided performance materiality, basis for calculation, did you revise it, if in case if revised levels of materiality, and also what are the reasons for that revision. So all these things relating to materiality should be even documented also. So you can do revision of materiality at the same time. All these matters are required to be documented in the book, documented as a part of our audit documentation. So this is what SA 320 says about materiality. With this, we have revised all the key concepts from audit strategy, planning and program. In fact, two standards we have covered, SA 300 and SA 320. Both the standards we have successfully covered it. Now we will start revising the chapter Audit of Banks. One of the important chapter once again from the examination perspective. So let us try to revise now this particular topic relating to how to conduct audit of the banks. So that's what the title itself makes it very clear. In this chapter, we are going to discuss about the provisions relating to whenever we are conducting audit of a bank, how we are supposed to do the audit, what things we have to cover, and what are the functions of the bank. So all these things we are going to revise in this particular chapter. So without any delay further, let us start revising it. First of all, when we call an entity as a bank, when I call an entity as a bank, so I call an entity as a bank which is in the active, which are doing two kinds of activities. So two activities must be done in order to call an entity as a bank. One is they should accept the deposits from the public, and the other one, they should lend the loans to the public. So an entity which is doing both the activities, which is even accepting deposits from the public, at the same time it is lending loans to the public. So if an entity is doing both kinds of activities, then we call such an entity as bank. On the other hand, if an entity is doing only one part of this activity, that is either if it is accepting deposits or it is lending loans, not both, such an entity we call it as NBFC, non-banking financial institutions. So the only differentiating factor between the two is bank will do both the kinds of activities, whereas NBFCs or non-banking financial companies will do only one part of this activity. And when it comes to governing law related to banks, see here, generally most of the banks take up the form of company. So banks will be governed by the provisions of Companies Act 2013. In addition to that, the exclusively for the banks, we have one more regulatory requirement, which is a Banking Regulation Act. So banks are even required to comply with the Banking Regulation Act also. So talking about laws and regulations, the main governing laws relating to banks are, one is Companies Act 2013, the provisions of the Companies Act 2013 the banks have to comply with. Apart from that, the banks are even required to comply with the Banking Regulation Act also. Apart from that, there will be RBI related rules and regulations. Like this, so much of compliance framework will be there for the banks. Clear everybody? So now, what are the peculiar features of the bank? What are the main features of the bank? One is they handle huge amount of public money. They handle huge amount of public money. They are a place of trust. People place a lot of trust in the case of banking system. And also they are subject to highly reputational risk. They are highly subject to what? Reputational risk. That means if some bad news starts circulating regarding one bank, it will have the tremors in the entire banking sector. Entire banking sector will get affected even if there is one small bad news circulating regarding one of the bank. And for all these banks, we have one regulatory authority. All the banking system, all these banks and NBFCs are all regulated by a system called, are all regulated by one common regulator. And that common regulator in the case of our country for the banking sector is RBI. Reserve Bank of India is going to be the regulator for the banking sector in our country. So these are some basic discussion regarding banks. What does banks do? What are the governing laws? And what are the peculiar features? And who is the regulator? Now first let us try to understand about what are the various types of banks. Depending upon the functions which the banks are providing, depending upon the people whom they are serving, banks are divided into different categories. And specifically, if I say, there are somewhere around 6 categories of banks are there, depending upon the kind of services they are providing and depending on the people whom they are providing the services. So the 6 categories are listed down here. As you could see the list here: commercial banks, regional rural banks, cooperative banks, payments bank, development banks, and small finance banks. Let us try to understand what does each bank do and how do they differ from each other. First, starting with commercial banks. Commercial banks are the most common kind of banks which we see. So commercial banks are those banks which are in the business of two activities: accepting deposits and they grant loans, and they will do it with the intention of making a profit out of it. Obviously, no. How do banks make money? They will accept deposits and offer you some interest. They will give loans and they will charge interest. Generally, the loan which will be charged on the loans, the interest which will be charged on the loans will be higher than interest which the bank will be paying on deposits. The differential component is only the profit for banking system. So commercial banks are those banks which are accepting deposits and granting advances with the intention of making profit out of that differential interest component. So those banks we call them as commercial banks. Then we have regional rural banks. The name itself says these are the banks which are incorporated to meet the banking and financial needs of rural communities. The people who are there in the rural areas, to meet the banking and financial requirements of that rural areas, special kinds of banks are incorporated, which we call them as RRBs, regional rural banks. Then we have something called cooperative banks. We also call them as cooperative credit societies. Nothing but these are also banks, but they are incorporated under the provisions of Cooperative Societies Act. These are also banks, but instead of getting incorporated themselves as companies, they will incorporate themselves as cooperative societies under Cooperative Societies Act. And the main differentiation between this bank, between a normal bank and a cooperative bank, is normal bank will meet the needs of all the common public, but cooperative banks will meet the needs of only one specific group of people. Like there will be certain banks who will offer loans and accept deposits only to the farmers. There will be certain banks who will accept deposits and offer loans only for those people who are there in the small scale industry. So like that, cooperative banks are the banks which are incorporated under Cooperative Societies Act, and they don't provide banking services for all the common public. Only to their members they will provide services who generally belong to one common occupation, business, service, etc. Next category of bank, which is payments bank. These are the recent innovation by the RBI. Payments bank like Paytm Payments Bank, Airtel Payments Bank. So in the recent times, the payments bank have become quite popular. And how do they differ from other banks is, payments bank can accept restricted deposits. They can accept some restricted deposit, but they cannot issue loans and credit cards. Payments bank get the banking license from the RBI, but the payments bank license will permit a payments bank only to accept the deposits, that to restricted deposits only the payments bank can accept, but they cannot issue loans and credit cards. They can even issue debit cards also, but they can't issue loans and credit cards. That is what the payments bank are. Now we have development banks. Development banks are those banks which will cater to or which will provide funds for infrastructural facilities which are important for economic growth of the country. So we have category of banks called development banks. These banks will not cater to domestical or residential purposes. Now these banks will try to provide funds for those industries which are involved in infrastructural facilities which are very important for the growth of the country, like construction sector, IT sector. So these kind of infrastructure entities only these banks will provide the loans or provide services. Examples are IDBI, Industrial Development Bank of India, IFCI, and also SIDBI. These are the examples of development banks which will offer loans only to infrastructural companies which are helpful for economic growth of the country. Then we have small finance banks. These are the banks which are incorporated to serve the needs of unserved and unorganized sector, like marginal farmers, small and micro business units like matchbox industry. So in order to cater to the needs of this unserved and unorganized sectors, separate set of banks have been incorporated, which we call them as small finance banks. So like this, depending upon the services which they are providing, depending upon the customers whom they are serving, banks are specifically divided into these 6 categories. Clear? Next, talking about the next concept, as I have already told you, all the banks, entire banking sector in our country is regulated by one common regulator. Who is that regulator? RBI is that regulator of the banks in our country. And how does RBI regulate the banking sector? Through various ways they try to regulate the banking sector, like issue banking license. If anybody wants to carry out a banking business in India, if a new bank wants to start their business in India, they can't do it unless and until they get the permission from the RBI. Not just a new bank, if an existing bank wants to open a new branch at a new location, for that also RBI's license will be required. Like SBI, if they want to open a branch at a new location, they can't do it unless they get the license from RBI. So RBI is a issuer of banking license. Next, and also RBI will be called as bankers bank. Why so? See, if we need a loan, we go to bank. If we have to deposit our money, we go to bank. If a bank wants loan, whom they will approach? RBI. If a bank wants to deposit their money, whom they will approach? RBI, they will approach. So that's why we call RBI as a bankers bank. And even banks are required to maintain some mandatory ratios called CRR, SLR ratio. Certain amount of money they have to keep with RBI and specified investments. Who do you think will decide that? What is the rate of CRR and SLR? That rates of CRR and SLR will be decided by RBI, which every bank has to comply with. And even RBI has been given the power to inspect any bank without any prior intimation. Just like that, RBI can go and inspect any premises of the bank. And even the RBI is a money supplier and controller of the credit. They control the supply and demand of money in the economy by way of their monetary policies. Like they try to increase the repo rates, reverse repo rates. By doing that, they even try to control the supply and demand of money in the economy to control the inflation. And prudential norms, even RBI will prescribe the prudential norms also. As we all are aware, in the case of banks, there will be asset classification, standard, substandard, loss, doubtful, and for each category of asset, there is certain percentage of provision which needs to be created. Who do you think has told you this asset classification and provisioning requirements? RBI has guided it. So RBI will even prescribe set prudential norms also for income recognition, asset classification, provisioning related matters. And finally, the RBI will also ensure there is a good corporate governance, there is a good corporate management in the banks. How they will ensure good corporate management, sir? They have given a fit and proper criteria who can act as a director of a bank. They have given a criteria. Like for a normal company, a person just like that can't become a director. If somebody wants to act as a director of a bank, RBI has given some qualifications. So fit and proper criteria they have given. Only those people can get appointed as directors of the board of bank. And even if the RBI finds any suspicious activity, any malicious activities in the functions of the banks, they can even appoint their representatives as additional directors in the board of directors. In the recent times, S Bank contains an additional director appointed by RBI. RBL Bank contains an additional director appointed by RBI. So like that, if RBI suspects something wrong is happening in the banks, they can even appoint their additional directors, their representatives as additional directors in the board of such banks. Clear? So like this, by determining CRR, by giving license, by acting as a banker's bank, and also by inspecting any bank, through all these functions, RBI is trying to regulate the entire banking sector in our country. Then what is regulatory framework? What are the list of laws and regulations which are applicable for bank? There are numerous laws and regulations which banks has to comply with. Running a bank is not at all easy. At every step, for every activity, there will be set of rules and regulations. That list of laws has been given here. Like as you could see here, banking regulation, RBI, Companies Act, SBI Act, and banking companies acquisition and transfer of undertakings, blah blah blah. So like this, we have so many laws and regulations which are mandatorily required to be complied by the bank regarding various activities. Then, on the basis of levels of computerization, banks are divided into three categories. On the basis of levels of computerization, the banks are divided into how many categories? Three categories. What are they? Non-computerized, partially computerized, fully computerized. The name itself says non-computerized. Non-computerized means those kind of banks where even today also all the activities are happening with the pen and paper. Manually, if the activities of the banks are getting carried out, that we call it as non-computerized banks. For the time being now, there are no such non-computerized banks. Today we will not be able to see any bank which is still doing all the activities manually. So these are not existing, practically speaking. Second one, partially computerized banks. These are the banks in which only some activities are computerized, but majority of activities are happening in the form of manual environment. Whereas the last one, fully computerized banks, this is what the today's banks are, which are fully computerized. Each and every transaction happens to the systems by using one robust software called CBS, core banking solution, a software. These are the softwares which banks will use. CBS, we call them core banking solutions. By using this core banking solutions, each and every activity of the bank will be carried out with the help of computers. So on the basis of computerization, these are the three categories of banks. Now, NPA norms we will discuss regarding some special matters, important concept from this particular chapter. So NPA norms for certain special kinds of advances, somewhere around 8 special cases they have given. Let us try to revise them quickly. First one, accounts regularized near about the balance sheet date. Now, what do you mean by accounts regularized? Accounts regularized means accounts with a few credit entries close to the balance sheet date. See, as we all know, Banking Regulation Act says if an account remains overdue for more than 90 days, that needs to be classified as NPA. But generally, banks management doesn't want to show higher NPAs. Why? Because that will show that if there are high NPAs in the bank's financial statements, that means that bank is not good performing. If the bank is not good performing, the managers, etc., will not get their promotions. So that's why what some people will try to do in the banks is an account will remain overdue for more than 90 days. If it remains overdue, that will go to NPA. But bank manager doesn't want this to happen. So what he will do is close to the balance sheet date, he will try to pass some fake credit entries. He will pretend he will pass some fake credit entries and try to look like he will try to make that he will try to represent the transaction something like that person has actually paid the money. So fake credit entries they will pass in the books of accounts, so that if you pass a fake credit entry, the account will not show as overdue for more than 90 days and the account will not be classified as NPA. And then next year what they will do is they will revise this entry, they will rectify this entry once again. So like this, sometimes some management of some bank managers etc. try to play these kind of cheap tricks to avoid NPA recognition. So those kind of accounts we call them as accounts regularized near about the balance sheet date. The name itself says accounts which are made good close to the balance sheet date. How they will be made good? By passing few fake credit entries. So as an auditor, if you find any such account which contains some fake entries close to the balance sheet date, you need to handle that asset classification with care. And if you have evidence that these entries are fake entries, you have to insist the management to compulsorily classify that as NPA. In case if the bank management, if that particular branch manager is not ready to classify it as NPA, give the modified opinion. Clear? That's what they say here. So what are accounts regularized near about the balance sheet date? These are the accounts with a few credits received just before the date of balance sheet date. Why they will be received just before the date of balance sheet date? To avoid that NPA classification. The asset classification of such accounts should be handled with care. If the account indicates weakness, then the account should be deemed as NPA. If you find that these entries are fake entries, you should insist the management to compulsorily classify it as NPA. Clear? Next one, government guaranteed advances. Here they say that if any advance is guaranteed by central government. What do you mean by guaranteed by central government? Guaranteed by central government means central government stood as guarantor. That means some entity is taking loan and central government is coming and saying that if you give the loan to this entity, if this entity doesn't repay the loan, we will repay the loan. So like that, if any central government guaranteed advance is there, and in that advance account, even if the amount remains overdue for more than 90 days, you need not classify that as NPA. You can keep that in the standard category only. When central government has given a guarantee and that guarantee has not been cancelled, and in that account if the borrower is not repaying money and even if that account remains overdue for more than 90 days, the bank need not classify it as NPA. They can keep it in the standard category only. Why? Because central government has given a guarantee. But the catch here is this account, for the purpose of asset classification, that will remain in standard category, but for income recognition that account should be classified as NPA. For income recognition that will be classified as NPA. That means, which if I have to simply put it, for asset classification that loan will remain in standard, but income will be recognized only on cash basis even though it is in the standard category. Understood guys? Very important. Central government guaranteed advances, if they remain overdue for more than 90 days also, still don't take it to NPA classification. Keep it in the standard category only. But income you have to recognize only on cash basis. Income you can't recognize it on accrual basis. And this privilege will be there only if the guarantee is given by central government. If at all state government is giving any guarantee, then there is no special privilege, nothing. State government guaranteed advances, if they remain overdue for more than 90 days, they will be classified as NPA. No special privilege will be given if the state government has given a guarantee. Special privilege will be there only if the central government has given a guarantee. That's all. This is what regarding second point. Now, third one is advances under consortium, or even we can call them as consortium advances. Now, first of all, what is the meaning of consortium advances? The name itself says consortium means group. So, if a group of banks coming together and giving loans collectively to one borrower, that loans we call them as consortium advances. Like for example, four banks came together: SBI, Axis Bank, ICICI, and PNB. So these four banks came together, everyone given a share of loan, and they have collectively given a total of 1000 crore rupees of loan to some entity called X Limited. And out of this 1000 crore rupees of loan, SBI has given 600 crores, Axis Bank has given 100 crores, ICICI Bank has given 150 crores, PNB has given 150 crores. So now a group of banks came together and collectively they gave a loan of 1000 crore rupees to a company called X Limited. Now these loans will be called as consortium advances. And in the case of consortium advances, there will be one lead bank, remaining will be members bank. Which bank will be lead bank? So the bank which is having highest share will be called as a lead bank. In our example, who will become the lead bank? SBI will become the lead bank. Why? Because they have the highest share. Now, when the group of banks have given the loan, now repayment should happen. Sometimes what will happen is, this company has made a repayment installment they have to pay, 100 crores of installment they have to pay. Which company? X Limited. Why? Because they are the borrower. Now this company X Limited paid this 100 crore rupees of installment amount to SBI, lead bank. Now what SBI should do is, it should keep its share and transfer the share to the remaining members bank. So when the lead bank is receiving the payment from the borrower, it should keep its share. So in our example, if 100 crores of installment is repaid, out of that 60 crores only will go to SBI. So SBI should keep this 60 crore rupees, and remaining 40 crores they have to distribute it to the remaining members bank like Axis Bank, ICICI Bank and PNB. But sometimes what will happen is, lead bank will receive the money, 100 crore rupees they have received the payment, but they are not transferring the share to the members bank. Lead bank has received all the installment amount, but they are not transferring the money to this members bank. Now what members bank will do is, if in the members bank account, if amount remains overdue for more than 90 days, they will classify the X Limited account as overdue, sorry, NPA. So here if you observe carefully, what is happening is, this borrower has honestly made the payment to the lead bank, but the default has happened from the lead bank side. Lead bank did not transfer the share to members bank. But still, whose account is getting classified as NPA? Borrower's account is only getting classified as NPA. So that's why what RBI suggests is, in case of consortium advances, there should be proper communication happening between lead banks and members bank. Which means the members bank, before classifying the account as NPA, they should first ask lead bank to give a confirmation whether lead bank received any share of the members bank. If lead bank told that, yes, we have received your share, but we did not transfer, then the member bank should stop themselves from recognizing this borrower's account as NPA. Why? Because your borrower did not do any mistake. Who has done the mistake? Lead bank. So that's why lead bank and members bank should have proper communication, and they should ensure that they should get either confirmation from the lead bank that they have received money on behalf of the members bank, and they will transfer it later. This will avoid unnecessary classification of NPAs in case of consortium advances. So this is what the NPA treatment in case of consortium advances. Then talking about next thing, accounts where there is a erosion in the value of the security. Accounts where there is a what? Erosion in the value of the security. Sir, what is erosion in the value of security? Sir, erosion in the value of security means reduction in the value of security. As we all are aware, whenever we approach the banker and ask a loan from them, bank will not give the loan looking at our face. He will ask you some security. You will give some security. So now sometimes what will happen is, you gave the security and got the loan. And normal circumstances, if you observe, the value of the security will be generally greater than the amount of loan given. Take for example, you have given 100 lakhs worth of property as a security. The bank will not give even 100 lakh rupees of loan. They will always give you loan less than 100 lakh rupees. So you have given 100 lakhs worth of asset as a security, and assume banker has given 70 lakh rupees of loan. Now, after getting the loan, some event has happened which caused the security to lose its value. Like for example, I have given this building as a security, but after I have taken a loan, there was an earthquake and the building was damaged. So now we will say this scenario as erosion in the value of the security. Value of the security has got reduced. Now, in case if the value of the security has got reduced, if there is a erosion in the value of the security, then that loan should be classified as either loss asset or as doubtful asset. Sir, when it should be classified as a doubtful asset? So they say if the realizable value of security is less than 50% of previously assessed value. Very important, you need to keep this point in mind. Previously assessed value. If the realizable value of security has become less than 50% of previously assessed value of the security. What is the previous value of the security? 100 lakh rupees. Now, if the value of if the realizable value is less than 50% of this value, assume the value of the security has become only 40 lakh rupees now. So now the realizable value of the security is less than 50% of the previously assessed value, which is 100 lakhs, which is equal to 50 lakh rupees. Now this entire loan of 70 lakh rupees will be classified under doubtful category and appropriate provisioning will be made. Whereas when it will be classified as loss asset is if the realizable value is less than 10% of outstanding amount in the borrower's account. What here? Outstanding amount. For doubtful asset, they are asking you to compare realizable value with previously assessed value. But for loss asset, they will ask you to compare the realizable value with outstanding balance. See here, outstanding balance is 70 lakh rupees. If the realizable value of the security has become less than 10% of 70 lakh, less than 7 lakh rupees, if the value of property has become now, assume the realizable value is only 5 lakh rupees, which is less than 10% of outstanding amount in the borrower's account. Now this entire 70 lakh rupees of loan will be classified as loss asset. So one important thing, I don't know whether you have paid attention or not. If not, please pay that attention. For doubtful category, we need to compare realizable value of the security with previously assessed value. Whereas for the purpose of loss asset, we need to compare the realizable value of the security with outstanding borrower's amount. Clear? So this is what the NPA treatment in case if there is a erosion in the value of the security. Next one is audit advances against term deposits, NSCs, KVPs. Sometimes some borrowers will get the loan and the security which they will offer is either they will offer security of fixed deposits which they have in the bank, or they can give national savings certificates as a security, or they may give KVPs, Kisan Vikas Patras and Indra Vikas Patras as security. So giving these kind of assets as security, assume a borrower has got the loan. Now the RBI says that if the loan has been taken giving these assets as security, and if that account remains overdue for more than 90 days, then this account need not be classified as NPA. The loan has been taken against the security of fixed deposits, NSCs, KVPs or IVPs, and if it remains overdue for more than 90 days also, still you need not classify it as NPA, provided one condition they will say here, provided adequate margin is available. Provided what is available? Adequate margin. What is that margin, sir? Margin means the excess of security value over that outstanding loan amount. As I have told just now, the bank will never give you loan equal to the value of security. It will always give lesser than the value of security. Assume a client has deposited 10 lakh rupees of FD that was given as security, and banker gave him 7 lakh rupees of loan. Now this loan has become outstanding for more than 90 days, overdue for more than 90 days. Should you treat it as NPA? Not required. Why? Because we have enough of margin, 3 lakh rupees of margin we have. Now next year, 1 lakh rupees of interest got accrued. It became 8 lakh rupees and 10 lakh rupees is a security, FD value. Now, is it required to be classified as NPA? Not required. Why? Because still 2 lakh rupees of margin is there. Next year, 1.5 lakh rupees of interest got added. It become 9.5 lakh rupees and 10 lakh rupees is the security amount. Still no need to classify it as NPA. Why? Because still margin is available. Next year, 2 lakh rupees of interest got added. Now it become 11.5 lakh rupees, whereas security amount is 10 lakh rupees only. Now the margin is not there. Now this account needs to be classified as NPA. So loans taken against fixed deposits, KVPs, IVPs, NSs, they need not be classified as NPA provided the condition is sufficient margin should be available. Now first I will explain H point, agricultural advances. See, NPA norms for agricultural advances are a bit different. Here normal outstanding for more than 90 days will not become applicable. For the purpose of agricultural advances, crops will be divided into two categories. One is long duration crop, other one is short duration crop. Long duration crop means those crops which take a crop season of more than 1 year. Whereas short duration crops means which takes a crop season of less than 1 year. So crop season means what? From the date of sowing of the seeds till the time of harvesting. If it is going to take more than 1 year of time, that we call it as long duration crops. On the other hand, if the crop you will get it before 1 year only, that we call it as short duration crops. Now loans can be given for long duration crops also. Loans can be given for short duration crops also. Loans given for long duration crops will be treated as NPA if they remain outstanding for more than one crop season. If they remain outstanding for more than one crop season. Whereas short duration crops, loans given for short duration crops will be treated as NPA provided if they remain overdue for more than 2 crop seasons. So depending on how many crop seasons are outstanding, whether we will classify it as NPA or not will depend. So if the loan is given for long duration crop, if they remain outstanding for more than one crop season, if we give the loan for short duration crop, if it remains overdue for more than 2 crop seasons, then NPA classification will become applicable. Clear? Now the big doubt is, sir, who will decide this crop season? So at every state there will be a state level bankers committee. That state level bankers committee will decide what is the crop season. That crop season will be final. Next one, what if agricultural advances are affected by natural calamities? See, sometimes what will happen is the banker will give a loan to the farmer. But after giving a loan to the farmer, some calamity has happened, some floods or drought, something has happened because of which crops were affected. If the crops were affected, the farmer will not be able to repay the loan. Now, RBI has given the permission for the banks to decide on renegotiation. They can take relief measures. RBI has given permission to the banks to take relief measures in case agricultural advances are affected by natural calamities. Sir, what relief measures banks can take? So, they can take relief measures like extending the due date, or they can convert a short-term loan into long-term loan. So like that, revision can happen. Now, in case if the bank has taken any relief measures because agricultural advances are affected by natural calamities, you need not classify them as NPA. As per older terms and conditions, NPA norms will become applicable as per revised terms and conditions. Old terms and conditions should be ignored. Like for example, earlier at the beginning when the bank gave a loan, the due date was 31st of January. But crop was affected by natural calamity. So that's why banker extended the due date to 31st of March. Now will you check for NPA norms as per old terms or as per revised terms? We should check NPA norms as per revised terms. Old terms must be ignored. Clear? That is what the meaning of agricultural advances affected by natural calamities. Now we have one more last special item, advances to staff. Sir, in case the bank is giving loans to their employees, can the bank give loans to the employees? Yes. Like for example, SBI is giving loan to one of its employee, housing loan is given for one of the employee. So as we all are aware, bank's ordinary course of business is to give loans. SBI is one of the ordinary course of business is to give housing loans. Similarly, SBI has given housing loan to one of its employee. So if SBI has given housing loan to one of its employee, is this loan given in the capacity of a banker or is this loan given in the capacity of employer? This loan is given in the capacity of banker. Why? Because it is ordinary course of business for SBI to give housing loans. So they are giving loan to employee also. So it is the loan given in the capacity of a banker only. Why? Because for everybody, SBI will give housing loans. Now, if SBI has given loans to employees in the capacity of banker, will NPA norms apply for these loans also? Yes. Now, based on what terms and conditions? Will there be any special terms for recognizing loans given to employees as NPAs? No, no special terms. The summary is whatever NPA norms that are applicable for ordinary customers, the same NPA norms will be applicable even if the banks are giving loans to their employees. No special NPA norms. If normal housing loans are getting recognized as NPA if they remain overdue for more than 90 days, the same logic will become applicable even if the loan is given to employee also. No special privilege will be there. Now, sometimes the banks might give loan in the capacity of an employer. Sometimes bank can give loans to his employers in the capacity of an employer, not banker. Example, if I have to give salary advance. Why salary advance is the loan given in the capacity of employer? Why? Because banks will give salary advance only to their employees. If I go to the SBI and ask them to give me salary advance, they will not give. So in case if the bank is giving the loan in the capacity of an employer like salary advances, they will not, for them NPA norms will not be applicable, and generally these loans given in the capacity of an employer will not be shown as a business asset also, it will be shown as other asset in the books of accounts in the balance sheet. Clear? So this is what one of the most important question from this entire chapter, NPA norms in some special cases. So we have covered 8 such special cases where NPA norms we have to be pretty careful or a bit different. Clear? This is what the major concept in this particular chapter. Remaining topics we can cover in no time. In very less amount of time we can revise the remaining chapters from this particular chapter. So let us try to proceed further. Now coming to the next concept, we will try to understand about now securities, types of securities accepted by the bank, and what are the various modes of creation of security. So talking about the securities, whatever securities the bank will be accepting, those securities can be broadly divided into two categories. One is primary security and the other one is collateral security. Primary security means the main security, the principal security, the main security against which the loan has been given. That we call it as primary security. Like I went to the banker and told that, sir, I will give you my factory building as a security, give me certain amount of loan. So here the main security against which the loan has been granted is factory building. Now factory building will be called as primary security. Now collateral security means in addition to primary security, if any additional security is offered, that we call it as collateral security. Like banker told, okay sir, we will accept factory building as a security, but even we want some extra security, why don't you give your stock as an additional security? Now this stock will become collateral security. So securities will be of broadly two types. One is primary security and the other one is collateral security. And different kinds of assets can be accepted as security. Like the list has been given here, immovable properties can be accepted as security, current assets like goods, stock, debtors, trade receivables, gold, ornaments and bullion, raw gold or ornaments can be accepted as security, plantation, nothing but your crops, in case of agricultural advances that only will be your security, and third party guarantees, life insurance policies, shares, like this there are numerous kinds of securities which can be accepted by the bank. Now talking about various modes of creation of security, there are 6 modes for creation of security. Let us try to understand each of the mode of creation of security. First one will be mortgage. Mortgage is the term used. Mortgage is a mode of security which will be used in case if the immovable property is given as security. In case if the immovable property is given as security, that mode of creation of security we call it as what? Mortgage. Like land, buildings, etc. And these mortgages will be of two types. One is registered mortgage and the other one is equitable mortgage. What is registered mortgage means? In this registered mortgage, we are going to enter into a document called mortgage deed. Nothing but whatever security we are giving, that will be registered on a stamp paper. So both the borrower and lender both will undergo one agreement, a written agreement, which we call it as mortgage deed. Registration will happen. Whereas when it comes to equitable mortgage, there is no registration, no nothing, just it involves mere delivery. I will take the original documents and give it to the banker and keep it with the banker till the time I repay the loan. So that mere delivery of title documents will happen in the equitable mortgage, but in the registered mortgage, I will enter into a written agreement called mortgage deed. So this is what regarding mortgage. Next, the two popular modes of creation of security are, one is a pledge and other one is hypothecation. So when it comes to these two modes of creation of security, these two terms will be used when any movable asset has been given as security, like stock, vehicles, gold, jewelry, etc. So when movable assets are given as security, they will either take up the form of pledge or they will take up the form of hypothecation. The differentiating factor between the two is, in the case of pledge, possession will get transferred to the banker. In the case of pledge, possession will get transferred to the banker. Like best example, if I have to give gold loans. If you take the gold loan, the banker will not let you keep the gold with you. You have to transfer the possession of that gold with the banker. You have to give the possession of that gold to the banker. That gold will remain with the banker and you will get it back only once you repay your loan. So those kind of securities where possession is getting transferred to the banker, that we call it as pledge. Whereas when it comes to hypothecation, neither possession nor ownership, nothing will get transferred to the banker, both will remain with the borrower only. One example will be vehicle loan. If you take any vehicle loan, the vehicle's possession will be still with the borrower only. Or working capital loans like cash, credit, OD. If you give stock as a loan, the stock you will not go and give it to the banker, the stock will be with the borrower only. So like this, pledge and hypothecation differentiate in this fundamental point. In case of pledge, possession will get transferred. In case of hypothecation, possession will not get transferred. So this is what regarding pledge and hypothecation. Then we have other mode of security called assignment. Assignment means transfer of existing or future debt in favor of the banker. Like if you are transferring the right to receive debtor to the banker, if you are transferring right to receive the compensation on life insurance policy to the banker, that we call it as assignment, transfer of existing or future debt. And one more thing, only actionable claims can be created as security by way of assignment. What can be created as security by way of assignment? Only actionable claims can be taken as security by way of assignment. Now in the answer they say even two more things. One is set off and the other one is lien. Set off means in case if a person has taken a loan and not repaying it to the banker, but with the same bank, if the person is having a asset also, like a person is that he is having a FD with the bank, from the same bank he has taken a loan also. In case if the person is not repaying the loan, the banker will have a right to adjust that loan against the asset. So this person is having FD. So whatever loan the customer is not repaying, the banker can adjust it against that fixed deposit and asset. Nothing but the right of the bank to adjust a asset and liability, that we call it as set off. And when it comes to set off, both the asset and liability, both the accounts should be in the name of same person, and in both the accounts the same person should have same capacity also, same rights you should have in both the cases. And even this set off right can be exercised against time barred debts also. Set off can be exercised even against time barred debts also. This is what regarding set off. Now coming to the lien as we already are aware, if the banker is holding any possession of the borrower's property and if the borrower is not repaying it, the banker will have a right to retain and sell that property belonging to the third party, property belonging to that borrower, sell it, realize the proceeds and adjust it against the loan liability. So like this, there are 6 modes of creation of security: mortgage, pledge, hypothecation, assignment, set off and lien. Understood? So these are different modes of creation of security. Now talking about remaining questions, next concept we'll talk about drawing power. See, drawing power is the most popularly used term in case of working capital loans like cash credit or overdraft loans. The term drawing power means the maximum amount which the borrower is allowed to withdraw from the short-term loans. The maximum amount which a person can withdraw from the short-term borrowings like cash credit or OD facility, that we call it as drawing power. Now this drawing power is something different from sanction limit. Drawing power is something different from sanction limit. Sanction limit means a maximum exposure which a bank can take with some particular borrower. Like for example, if the banker is sanctioning a loan, working capital loan, cash credit of some 10 lakh rupees has been sanctioned to the borrower. But the banker will not let the borrower withdraw the entire money of 10 lakh rupees. They will sanction it, but they will not let him withdraw. Now they will put one more limit. They will say something, you can maximum withdraw 8 lakh rupees only. Now this 8 lakh rupees maximum amount which can be withdrawn is called as a drawing power. The amount which has been sanctioned, this we call it as sanction limit. Clear? So now when it comes to this drawing power, there are certain things which bank has to fulfill. There are some duties of the bank with regard to this drawing power. So all the accounts must be kept within both the drawing power as well as sanction limit. Each and every working capital loan should always be within the limit of drawing power, within the limit of sanction limit. No account should exceed either drawing power or sanction limit. If at all, if any such thing happens, if you found out in one account the amount has gone beyond the drawing power and sanction limit, that should be immediately brought to the notice of management or head office regularly. And how this drawing power will be calculated? So drawing power will be calculated on the basis of the current stock statement. On what basis drawing power will be calculated? Drawing power shall be calculated on the basis of stock statement submitted by borrower, and that should be latest stock statement. Sir, with what frequency stock statement should be received, sir? RBI has clearly told that stock statement should not be older than 3 months. Stock statement should not be older than 3 months. That means once in every quarter, the bank should make arrangements to get the stock statements from the borrower. The bank cannot accept any stock statement which is older than 3 months. If the bank wants a stock statement which is earlier than 3 months, it is fine. But the banks in any case should not accept the stock statement which is older than 3 months, which impliedly means that once in every quarter, the bank shall get the stock statements from the borrower. And that drawing power should be calculated as per the guidelines decided by the board of directors. Every bank's board of directors will have their set of rules and regulations, how much drawing power will be given. They will keep some margin, 70% we will give drawing power, 80% we will give drawing power. So like that, every bank's board of directors will have their own set of guidelines for calculating the drawing power. So bank should make sure that they are calculating the drawing power as per the guidelines which they have received from board of directors. And as an auditor, what will be your responsibility regarding the drawing power is you have to check whatever stock statements that are getting submitted by the borrower, whether those stock statements are genuine or not. You have to verify that. Even you need to check annual report, and then you have to compare whatever quarterly stock statements that are submitted by the borrower, whether they are matching with the annual report or not. That you have to verify. And in addition to submission of the stock statements, in some cases, banks should even undertake stock audit also. Sir, in what cases banker should go for stock audit? So the banker should go for stock audit in case if the funded exposure is more than 5 crore rupees. Sir, what do you mean by funded exposure? So if the outstanding amount in the cash credit or working capital loan is more than 5 crore rupees, then just getting the stock statement from the borrower alone will not be enough. The banker should go to the premises of that borrower, verify the stock, do the stock audit. Who should do the stock audit, guys? Not auditor. It is bank's responsibility to do stock audit wherever there is a funded exposure of more than 5 crores. And what is the meaning of funded exposure? When the actual outstanding amount in the borrower's account is more than 5 crore rupees, then we call it as funded exposure is more than 5 crore rupees, and the banker should go to the client's premises and do the verification of the stock there. And sometimes auditor might order the bank to do the stock audit even if the funded exposure is less than 5 crores. If the funded exposure is more than 5 crores, mandatory. In other cases, if the auditor feels like necessary, he might order the bank to go and conduct the stock audit even if the funded exposure is less than 5 crore rupees. So this is what regarding drawing power, meaning management responsibilities, auditors responsibilities, and stock audit related requirements. Clear? Now let us talk about audit related matters. First of all, sir, who is eligible for conducting the bank audit? So what are qualifications and disqualifications? Nothing new here. Whatever qualifications, disqualifications which we have read for a company auditor, all that qualifications and disqualifications are equally applicable even for auditor of the bank also. And who will appoint the auditor of a bank? So in the case of SBI, the auditor will be appointed by C&AG after consulting with central government. Whereas subsidiaries of SBI, if any are there, those auditors will be appointed by SBI. For SBI, C&AG will appoint. For subsidiaries of SBI, SBI will appoint. And apart from that, whatever nationalized banks are there, like other nationalized banks, we have Union Bank of India, Canara Bank, so all these kind of nationalized banks, the auditor will be appointed by board of directors, but after getting approval from RBI. In what case? In the case of nationalized banks. And one more thing, in the case of RRBs, here also the auditor will be appointed by board of directors, but here after getting approval from central government. So SBI we have seen, nationalized banks we have seen, RRB we have seen. Apart from that, whatever other banks are there, like private banks which we have today, which we call them as banking companies, Axis Bank, ICICI Bank, etc. In the case of those banks, the auditor will be appointed by shareholders of the bank. Nothing but normal provisions of the Companies Act will become applicable in the case of other than banking company. Sorry, in the case of banking company. And who will decide the remuneration? So in the case of special banks like nationalized banks, SBI, RRBs, remuneration of the auditors will be decided by RBI after consulting with the central government. Whereas in the case of banking companies, the remuneration of the auditor will be decided by shareholder. Nothing but normal provisions of the Companies Act, section 142 of the Companies Act will become applicable here. And coming to the powers, whatever powers the company auditor will have, all those powers will be equally applicable even for bank auditor also. Clear? So these are the provisions regarding who is eligible, who is not eligible, appointment requirements, and remuneration fixation. Now, one important step which will happen in the bank audit is not just in the bank audit, if you ask me, in every bank audit, it is very important for all the engagement team members should have a discussion generally at the planning stage of audit. In all audits, especially in the bank audits, all the engagement team members should have some discussion to gain better understanding of the bank, its environment. All the engagement team members should have discussion, and generally these discussions will happen at the planning stage of the audit. And as a part of that engagement team discussions, what things the engagement team members should discuss with each other? In that engagement team discussion, what regarding what matters, a discussion should happen there. The engagement team member should not discuss about their lunch, dinner or breakfast. No, there are certain specific matters relating to audit which engagement team members should discuss as a part of that engagement team discussions. What are they? So they have to discuss about errors which are more likely to happen, or even they might discuss about errors which have already happened in the past, or they could discuss about fraud, by the methods by which fraud can be committed in the bank. And even they should discuss the importance of maintaining professional skepticism throughout the audit. They need to discuss about how to respond to the risk, and even they need to discuss about the need for maintaining alertness. This is nothing but more or less similar to maintaining professional skepticism only. So these are the matters about errors, methods for committing the frauds, professional skepticism, why we need to remain alert, how to respond to the audit risk. These kind of matters generally should be discussed as a part of that engagement team discussion. And what are the advantages of having that discussion? So the main advantages will be, it will provide an opportunity for experienced team members to share their knowledge and experience with the less experienced team members. Through engagement team discussion, the experienced team members can share their experience, can share their knowledge with the less experienced team members. And also, if you have engagement team discussion, that is going to promote better understanding among all the engagement team members. They will have better understanding and coordination among all of them. So these are the advantages of having engagement team discussions. Clear? Now let us talk about overall audit. What will happen from the beginning till the ending of the audit? What and all various aspects will be covered in the bank audit? Overview of the entire bank audit. There will be some initial considerations. That means before we actually start doing audit, some initial considerations we have to consider. What are they? Communication with the previous auditor. As I have told, one of the preliminary engagement activity, if an auditor is going to accept a new bank audit, first he need to communicate with the previous auditor in writing. That you need to do even in the case of bank audit also. Then you need to perform procedures as per SA 220 before accepting and continuing client relationship, like checking the integrity of the management, compliance with the ethical requirements, competence of engagement team members, etc. Significant matters, you need to check that here also. Declaration of indebtedness, special point. Every bank auditor before his appointment, he should give a written declaration of indebtedness. Is he indebted to the bank? If yes, how much amount? Whether at any point of time his account has been classified as NPA. That written declaration should be given by every bank auditor. And also, they need to draft the engagement letter. Whatever terms and conditions are there, that needs to be put it down in the form of a written agreement signed by the auditor, signed by the bank management. And one more thing, the banker should not perform any other internal assignments. If you are performing statutory audit for a bank, you should not perform any other internal assignments like tax services, consultancy services. Nothing but section 144 is there, no? That will apply even here also. No internal assignments should be provided. And finally, you need to establish your engagement team. Decide which people you are taking for audit, how much time you will take for audit. So establish your engagement team. So these are initial considerations which we will do even before we start doing the audit. What are they? Communication with the previous auditor, checking the factors for accepting and continuing client relationship, giving a written declaration of indebtedness, drafting the engagement letter, not performing any kind of internal assignments, and finally establishing engagement team. And after that, as we all know, the first and foremost procedures which we do will be risk assessment procedure. Nothing but we will try to understand about the bank, its environment, its internal control. For what purpose? To identify the risk of material misstatement, so that on the basis of that risk of material misstatement identified, we can plan our nature, timing and extent of further audit procedures, especially substantive audit procedures and compliance procedures. And then, as we have seen in the previous question, we need to have engagement team discussion. After that engagement team discussion, we need to develop a audit plan as per SA 300. And after developing audit plan, we need to even decide materiality, as we have seen in SA 320, taking a percentage, multiplying with the benchmark, etc. Then consider whether going concern is valid for this particular bank or not. And even you are supposed to maintain professional skepticism. Apart from that, you need to do some two special things in the case of audit of banks. One is checking the stress testing framework. Other one is testing the Basel III framework. So what is this stress testing framework and Basel III framework? Let me give you a brief here. So stress testing framework means whether, RBI has released one set of rules and regulations which has been given the name called the stress testing framework. Nothing but in this stress testing framework, the RBI has given some rules and regulations which they are expecting every bank to follow. So as an auditor, I need to check whatever stress testing framework is there which is released by RBI, whether it has been implemented or not. Sir, what exactly is there in the stress testing framework? Not relevant for our discussion. Just remember, RBI has released a document which contains rules and regulations called stress testing framework. Whether bank has complied with the stress testing framework or not, that I need to verify. In addition to that, even there is one more framework called Basel III framework. See, stress testing framework is a national level framework released by RBI, whereas Basel III framework is a global regulatory framework which is released by a committee called BCBS, Basel Committee on Banking Supervision. In this Basel III framework also, there are some rules and regulations for effective functioning of the banks. As an auditor, even if I am conducting audit of a bank, I need to check whether my client's bank has complied with that Basel III framework or not. That also I need to verify. So these are the two special points which will be there in the case of bank audit. One is checking the stress testing framework, other one is checking the Basel III framework. Difference between the two is stress testing framework is a national level framework released by RBI. Basel III framework is a global level framework released by BCBS, which will be followed by the banks all over the world. Apart from that, even I need to verify other reports also, like I need to go through previous year's audit reports, I need to go through any inspections done by RBI, I need to check any head office inspection reports, I need to go through internal audit reports, and also any reports on verification of security. Like that, check other reports which are available with the bank to find out whether in any of these reports negative comments are given regarding loans and advances given by the bank. Clear? This is what the entire overview of bank audit. This is what I will do in the entire bank audit from the beginning till the ending. Now let us talk about how to conduct audit of specific items of the bank. As we all know, the major item of the balance sheet will be advances. So if you are conducting audit of a company, how would you verify advances of a bank? So how would I verify advances? Before I explain about how would I verify the advances, first advances are classified into two categories. One is funded advance and the other one is non-funded advances. Funded advances means those advances which involve outflow of funds from the bank. Like housing loan, funded advance. Why? Because bank will give the money to us. Personal loan, funded advance. Why? Because there is an outflow of funds from the bank. Whereas another kind of advances also could be there, which we call them as non-funded facilities, which will not involve any outflow of funds. Like banker is giving letter of credit or banker is giving guarantee. They will not involve any outflow of funds. That we call it as non-funded facilities. So since we understood types of advances, now let us try to understand what things we need to verify regarding loans. First, we need to do some preliminary examination. Basic checking we have to give for all loans and advances. In the basic checking, what we will verify? First, we need to ensure that before the bank is giving any loan to the borrower, whether they are checking credit worthiness of the borrower or not. What do you mean by credit worthiness? Repaying capability. How that repaying capability will be found out? By going through his credit score, CIBIL score, etc. So whether banker is giving loan only after checking credit worthiness of the borrower. And also, if the bank is giving loan, banker should give loan only after getting approval from concerned person. That concerned person will be generally the branch manager. So only after getting approval from concerned person in the bank, then only the banker should have given the loan. Check whether banker is taking approval or not. And also whatever necessary documents are there for the purpose of that loan, all that documents are executed, like loan agreement, security agreements, whether all the documents have been signed, has been signed by the banker and the borrower or not, that also I need to check. Then when it comes to security, I need to check certain aspects regarding security as an auditor. I need to check whether the securities are registered in the name of the bank. In case if the shares and debentures are given as security, that should be transferred in the name of the bank till the time loan is repaid. And always in the account, sufficient margin should be kept, not just at the beginning of the loan. Throughout the tenure of the loan, sufficient margin should be kept. And even if the security contents are there with the bank, like in the case of pledge, the banker will be holding the possession of the security. Even periodically, that assets also should be checked whether they are in the safe custody or not. Why? Because if tomorrow borrower comes and repays the loan, the banker is having an obligation to give back that assets to the borrower. So that's why whatever assets which are there in the possession of the banker, that should be verified. So these are the aspects which we need to verify with regard to security. Then in case of short-term loans, we have this concept of drawing power. Anyhow, we know this, how the drawing power should be calculated. How drawing power should be calculated? Drawing power register should be updated every month. Every month you have to update the drawing power register, and all the accounts should be kept within the drawing power and sanction limit. In case if you find any account which has exceeded the drawing power or sanction limit, that account should be immediately brought to the notice of higher officials like head office or RBI. So these are the points which I need to keep in mind when I have to verify this advances of the bank, assets of the bank, loans which are given by the bank. These are the points which I need to check. Similarly, there are even a few questions which are talking about how we will verify various other aspects also, other items of the financial statements. Like if you see the question here, how will you conduct audit of incomes of the bank? As we all are aware, banks will have different kinds of income, like interest income will be there, bill discounting income, or bills for commission income. So like that, various kinds of incomes will be there. How do we verify, if you are conducting audit of a bank, how do you verify the incomes of the bank? First of all, very important point here, there is one basic income recognition policy given by RBI. RBI has given one basic income recognition policy. Let us see what is that income recognition policy. So RBI has advised that in respect of any income which exceeds either 1% of the total income of the bank or 1% of the net profits before taxes, that should be considered on accrual basis. So what the RBI has told, if any income which exceeds either 1% of total income or if it is exceeding 1% of net profit before taxes, that income must be recorded on accrual basis. Now, if I put it in other way around, what they're trying to say, so if the bank is having any income, see, I'm telling you opposite sentence. What RBI is saying is, if income is more than 1% of total income, or if certain category of income is more than 1% of net profit before taxes, that must be recognized on accrual. If I put it in other way around, how it will sound like? It will sound something like, if a income is less than 1% of total income and also less than 1% of net profit before taxes, that may be recognized on cash basis. That is what the other way around. No, I am just telling you the other side of the coin. In one way, they are saying if income is more than 1% of total income or 1% of net profit before taxes, you have to recognize it on accrual. If you put it in other way around, what it will sound like? If an income is less than 1% of total income of the bank and also less than 1% of net profit before taxes, you need not recognize it on accrual basis. You can recognize it on cash basis. That freedom has been given for the banker. Let me try to explain it with the help of one example. Assume the total income of the bank is 100 crore rupees and also net profit of the bank is some 10 crore rupees. If any kind of income is less than 1% and also is less than 1% of total income and also less than 1% of total net profit. Now obviously whichever will be the smaller one, so if it is less than 1% if you calculate, here it will become 1 crore, here 1% if you calculate it will become 10 lakh rupees. So if you take both into consideration, if any kind of income is there which is less than 10 lakh rupees, that if the bank want, that can recognize it on cash basis. Assume that the banker is having some income from bill discounting. The total bill discounting income itself is 7 lakh rupees. The total bill discounting income is how much? 7 lakh rupees. Now this total bill discounting income is less than 1% of the total income of the bank and also less than 1% of the net profit of the bank. Why? Because it is 7 lakh rupees. So it is less than 1% of total income. At the same time, it is less than 1% of net profit also. Now this bill discounting income that can be recognized on cash basis, no need to recognize it on accrual basis. This freedom has been given to the banker. So this is what the income recognition policy. Now let us talk about how to verify various incomes of the bank. First we will talk about interest income. As we all know, general policy for income recognition of interest is it will be recognized on accrual basis. But one condition, if the account has turned out to be NPA, then we need to recognize that income on cash basis. If the account is not NPA, we can continue to recognize interest income on accrual basis. But in case if the income has been, if the asset has become NPA, if the loan account has become NPA, that interest income should be recognized only and only on cash basis. You should not recognize it on accrual basis. Understood? That is point number one. Second one, see, going forward, you will stop accruing income. Agreed. But what even Banking Regulation Act says is, if an account has turned out to be NPA, now the income which is already recognized but not yet realized, income which is already recognized but not yet realized, that should be even reversed back. So if an account turns out as NPA, going forward you will stop accruing income. Not just will stop accruing the income which is already recognized but not yet realized, that should be even reversed. Understood? Even though you reverse it, for control purposes, we can try to keep it in one memorandum account. We will exclude it from the statement of P&L, but we will try to maintain one control account, which we generally call it as memorandum account. In that memorandum account, you can keep it, but from the books of accounts, you will not show it either as a income. Yeah, going forward, you will stop accruing it, and not just that, even you will reverse it, the income which you have already recognized but not yet realized. And one more extra clarification here, if an account turns out to be NPA, not just interest income, all other incomes like fees, etc., those also should be reversed. Fees, processing fees, like that, banks will try to charge income with different names. If an account turns out as NPA, not just interest income, all these other incomes also should be reversed, and provided if they are not realized. If the income is already recognized but already and it is realized, no need to reverse it. When the matter of reversal happens, when income is already recognized but not yet realized, then whatever income you have recognized, everything should be reversed back. Understood? So these are the points which you need to keep in mind when it comes to interest income. Now, talking about other incomes, now we will speak about bill discounting income. As we all know, bill discounting is also a kind of financing service only. And we have to be very careful if the bill duration is falling over 2 financial years. Like for example, the bank has discounted the bill on 1st of March 2022. And the total discounting income from which they have received is 9 lakh rupees. The actual due date of the bill is somewhere around 31st of May 2022. And what is the bill discounting income? 9 lakh rupees. Now, how to recognize this bill discounting income? All at once? No. The bill discounting income should be apportioned over that bill duration. If you observe, the bill duration is 3 months here, March, April, May. So this 9 lakh rupees of income should be recognized over a duration of 3 months. But if you observe carefully, in between there is a balance sheet date, 31st of March will come. So out of this 9 lakh rupees, only 1 month's income can be recognized in the financial year 21-22. 3 lakh rupees will be recognized. What about that unrecognized income of 6 lakh rupees? How you will show it as on balance sheet date? So my question is, bill discounting income should be recognized over the tenure of the bill. Here I am saying in between financial year is date of the balance sheet is coming. In this year, only 1 month's income will be recognized. 3 lakhs I will recognize. How you will show this 6 lakh rupees of income as on balance sheet date? That has to be shown as a liability. Why? Because it is a income received in advance, that has to be shown as liability as on the balance sheet date. As unexpired rebate, you have to show it as a liability in the books of accounts. So this is what the accounting treatment for bill discounting income. Next, bills for collection. From bills for collection, the banker will receive even commission also, but here the accounting treatment is very simple. When it comes to bills for collection, no need for apportionment over the tenure of the bill. Why? Because bills for collection is not a financing arrangement, it is a consultancy or outsourcing service. The banker will be entitled for bills for collection commission only when the banker has collected the money from the third party. Yes or no? So here there is no concept of apportionment. Bills for collection income can be recognized as and when the banker has collected the amount from that third party. See, the differentiating factor between bill discounting and bills for collection is, in case of bill discounting, the banker will give the money well in advance, even before they collect it. Whereas in case of bills for collection, the banker will give the money to that concerned person only after they have collected the money from the third party. So that's why bill discounting is a kind of financing arrangement, whereas bills for collection is an outsourcing arrangement. Understood? And one more thing, the last kind of income, rescheduling income also will be there for the banks. Now, what is this rescheduling income? Assume a borrower is there, he has taken loan. The actual due date of the loan is 31st of March 2022. So before the due date, the borrower approached the banker and told, sir, my due date is approaching on 31st of March 2022. I have a due date, but I don't have enough of money to repay it. So let us make one agreement. What he is requesting the banker to extend the due date to 31st of March 2024. Sometimes, as a valid business decision, the banker might agree to it. So the banker has extended the due date. This is simply called as rescheduling. But banker will not extend the due date for free of cost. For the coming 2 years, he will charge interest. That will be there. But in addition to that coming 2 years of interest, he will charge some one-time fee for the purpose of extension of this due date. Take for example, the banker is saying, okay, I will extend the due date by 2 years, but for that you have to pay me processing fees of 1 lakh rupees. So like this one-time income they will charge. Now this income of 1 lakh rupees which has been charged for extension of the due date, that we call it as rescheduling income. Now what is the accounting treatment for that rescheduling income? Should you recognize all the rescheduling income at once? No, the Banking Regulation Act says this rescheduling income should be recognized over the rescheduled period. What is the rescheduled period here? 2 years. Over a period of 2 years, this 1 lakh rupees of income should be recognized, not all at once. Clear? So this is how we need to, these are the points which we need to verify regarding income of the banks. Now talking about expenses, the main expense of the bank will be interest expense. How do you verify interest expense? How we will verify? By doing some comparison, analytical procedures we will do. We will calculate weighted average rate of interest for the current year. We try to compare it with the last year's weighted average rate. If we find any deviation, we try to investigate that further. So like this, by performing analytical procedures, we can check the reasonableness of interest paid. Along with that, randomly we need to do some calculations, recomputations, arithmetical accuracy we have to check. Like we need to check that interest has been charged on all the accounts till the date of balance sheet, and whatever interest the bank is paying on the deposits, it should be as per bank's internal rules and regulations, and that interest rate should be even as per RBI directives, and that interest rate should even match with agreements which the banker has entered with the depositors. And in case of FD, that interest rate should be even cross checked with FD certificate. FD certificate will be there. In that FD certificate, interest rate will be prescribed. So the banker, the auditor should check whatever interest that has been paid with the fixed deposits, that is matching with the interest rate on the fixed deposit certificate. And in case of inter-branch balances, if one branch of a bank is giving money to the another branch of the same bank, on that also interest has to be charged, and that interest rate will be prescribed by head office. So as per the interest rate decided by the head office, even interest should be charged on inter-branch balances also. So this is how we need to verify interest expense. But as we all are aware, interest expense is not the only expense for the bank. There will be other expenses also. Like as you could see here, there will be various other expenses which has been given a specific name, broadly operating expenses they have called it. So when I say operating expenses, everything will come here. Staff salary, rental, office maintenance, all this will come here. Now what you need to verify regarding all other operating expenses? 3 common points they have told. First, we need to check for all this other operating expenses, proper internal controls are there or not. And along with that, wherever possible, we should try to check all that expenses with the supporting documents like invoices and receipts. And wherever suitable, we will try to perform analytical procedures. And next biggest expense in the statement of P&L in the case of banks will be provisions. And one provision will be provision in respect of NPS. When it comes to provision for NPS, first we need to check whether classification has been done properly as per RBI rules and regulations. And along with that, for each category of asset, appropriate provision rate is also determined under Banking Regulation Act only. So I need to check whether asset classification and provisioning has been done as per Banking Regulation Act. And another will be provision for taxation. I need to check whatever provision the bank has calculated for taxation, whether that is correct or not. How you can check it? You are also aware of income tax provisions. Recalculate the tax liability on your own once again, and try to compare that tax provision which you have calculated with the management's calculation. And apart from that, various other provisions also will be there. Whatever other provisions are there, like provisions for warranties, etc. Check under what circumstances these provisions are created and whether that provisions are adequate or not. So I have explained you how to conduct audit of incomes, how to conduct audit of advances, how to conduct audit of expenses also. Now we will try to end our revision with revision of this particular chapter with one particular concept, which is reporting requirements. What will be the reporting requirements of auditors of the bank? Let us have it. Let us try to revise it. So first, some bank auditors are required to make a report to central government. Which bank auditors, sir? Are all bank auditors required to submit a report to central government? No. Then which bank auditors will be required to submit a report to central government? Only auditors of nationalized bank and auditors of SBI are only required to submit a report to the central government. And in that report, what they should mention? So in that report, they should mention whether financial statements give a true and fair view of profit or loss and affairs of the entity. that they have to mention. Number one, auditors of nationalized bank and SBI are required to submit a report to central government. In that report, they have to mention whether financial statements give true and fair view, whether auditor has got all the explanation and information, whatever he want, and whatever transactions that you have observed, whether those transactions are all within the powers of the bank, and whatever returns you have, whatever returns you want from the branches and other offices that you have received it or not. So including these 4 points, the auditors of SBI and nationalized bank, they will submit a report to the central government. And format of the report will be that report has to be prepared after complying with the standards on audit. And in that audit report, one extra disclosure is required to be given by central auditor. What is that extra disclosure is? In the entire bank, if there are any unaudited branches, the central auditor should mention in his audit report how many number of such unaudited branches are there. And just mentioning the number of unaudited branches alone will not be enough. Even the auditor should quantify what are the advances, deposits, interest, income and expense of that unaudited branches also should be mentioned in the main audit report. Take for example, for SBI, Central Statutory Auditor is doing audit, he is preparing audit report. Now he needs to mention in his audit report, out of all the branches of SBI, are there any unaudited branches? Assume some 10 unaudited branches are there. Now the Central Statutory Auditor will say in his audit report, there are some total of 10 unaudited branches. In addition to that, even the Central Statutory Auditor should say, what is the total amount of loans, advances, interest income and interest expense of that 10 unaudited branches also should be mentioned in the audit report. So not just mentioning the number of unaudited branches, even you should quantify the loans, advances, interest, income and expense of that unaudited branches in the main audit report. Along with that, the auditor should even include section 143 reporting requirements. 143 subsection 1 6 matters, 143 subsection 3 9 plus 6 15 matters. All that will be reported under in the case of bank audit also. But however, CARO reporting requirements will not be applicable. Why? Because CAROs are banking companies are exempted from CARO applicability. So apart from that, 143 subsection 3, 143 subsection 1 reporting requirements will be there, but 143 subsection 11, which is CARO, that reporting requirements will not be there. In addition to that, every bank auditor should give one more report called LFAR. This audit report will be applicable for all banks. And what matters will be there in the audit report, sir? These are already specified by RBI. Even there is a time limit for submission of this LFAR. LFAR has to be submitted before 30th of June of every year. LFAR needs to be submitted. In addition to that, auditors of bank will even have one extra reporting requirement. That is, if they find out any fraud, that fraud needs to be reported to RBI. They will report to central government. 143 subsection 12 central government reporting will be there. In addition to that central government reporting, auditors of banks, in case if they come across any fraud, that fraud is required to be reported even to the RBI also. So there is one RBI circular which says that if an accounting professional like you and me, either in the course of internal or external audit, if they find anything susceptible to fraud, or if they find any excess power exercised by the bank, or if they smell any foul play, that means if they find any suspicious transaction, all that matters should be required to report it to RBI. And if they fail to do it, they will be liable for action. They have to face the penalty, consequences, etc. if intentionally they fail to report the fraud to the RBI. So this fraud reporting will also be there, and as I have mentioned, this fraud reporting will be in addition to reporting requirements under 143 subsection 12. And even one more question, there is a list of audit reports which are required to be given by Central Statutory Auditor. Important question. So what are the list of reports that are required to be furnished by Central Statutory Auditors of the bank? Their responsibility will not come to an end just by giving one final audit report. They are required to give so many reports, like as you could see here, report on adequacy and operating effectiveness of internal controls. On internal financial controls, they need to give a separate report. Then just now, as we have seen, they need to give one report called LFAR, whether the bank is complying with SLR requirements, on that separate report, whether the treasury operations of the branch are conducted in accordance with instructions from RBI, whatever treasury operations bank is doing, whether they are as per instructions given by RBI, on that separate report. Report on whether income recognition, asset classification, provisioning, everything has been done properly, on that give a separate report. And if you find any serious irregularity, give a separate report on that. And there are some two committees, Ghosh committee and Jilani committee. These committees will give recommendations for improving the bank's functioning, whether the banks have complied with the recommendations of Ghosh committee and Jilani committee, on that separate report. And even you have to give a report on adverse credit deposit ratios also. These many reports you are required to give in the case of audit of banks. Clear? So with this we have covered all the key concepts from the examination perspective, all the important topics from the chapter audit of banks, we have successfully covered it. Understood everybody? So that's all regarding this audit of banks. Now we will start revising the next chapter, which is going to be audit of cooperative societies. Very small, we can complete in no time. So let us try to revise now the chapter called audit of cooperative societies. So let me open the material here. Yeah. So first, let us try to revise the what is basic difference between the company kind of legal form and cooperative society kind of legal form. See, as we all know, cooperative society is just a kind of legal form. Like if you want to do the business, you can give different kinds of legal constitution. You can incorporate your business as a sole trader. You can incorporate your business as a partnership firm. You can incorporate your business as a company. So like that, one such legal form is cooperative society. And the basic differences between between a company and a cooperative society is a company, few differences if I have to say, a company's membership is not restricted. Company's membership is not restricted. Like if you want to become a shareholders of Reliance Industries Limited, you can become it. Just by buying the shares in the stock exchange, you can become a shareholder of Reliance Industries Limited. See, Reliance did not say that to become a member of Reliance Industries Limited, you must own a petrol bunker. Did they say it? No. Similarly, you and I can just like that go and become the members of Infosys by buying shares in the open market. But in the case of cooperative societies, the membership is restricted. The membership is what? Restricted. Only people belonging to one particular profession, occupation, business can only become members of cooperative society. Whereas in the case of company, no restriction. Anybody can become a member. So if I have to give you some examples, some cooperative societies will be there, which will take in, which will accept membership only from those people who are in the business of dairy business people only they will accept. Some cooperative societies will accept membership only from those people who are farmers. So some cooperative societies will accept membership only if those people are belonging to some small scale industry. So like that, in the case of cooperative society, the membership is restricted. You should belong to one particular occupation, business or community to become a member of cooperative society. There is no such restriction when it comes to company. And one more point of difference here, the main objective of creation of companies will be profit intention, to make the profits. But cooperative society's main intention is not making profits. The main intention of creation of cooperative society is to provide service to all its members. What is the main objective of cooperative society? To provide service to its members. That is the main objective of cooperative society. And even there is a principle, the basic principle on which cooperative societies will be created is one for each and each for all. If I have to give you one best example, Amul is actually a brand name of a cooperative society in which the people who are there in the dairy business will become members of this cooperative society. They are created, this Amul cooperative society was created to provide benefits to all its members, to increase the standard of living of all those people who are engaged in that dairy business. So the main objective for the creation of cooperative society will be service to its members. Understood? And there will be different kinds of cooperative societies will be there depending on the business which they are doing, depending upon the functions which they are performing. There could be producers cooperative society, there could be consumers cooperative society, there could be cooperative credit society, or even we can call them as cooperative banks, or even there could be housing cooperative societies also. So depending on the functions they are performing, depending upon the members whom they are accepting, there will be different kinds of cooperative societies like producer cooperative society, consumer cooperative society, credit cooperative society, and housing cooperative societies. And when we talk about governing laws, sir, what are the governing laws for this cooperative society? The governing laws for the cooperative society will be two. One is Cooperative Societies Act 1912. And in case if the cooperative society is a multi-state cooperative society, then they have another act, Multi-State Cooperative Societies Act 2002. So what are governing laws for the cooperative societies? There are actually two. In case of a normal cooperative society, Cooperative Societies Act 1912 will become applicable. In case if the cooperative society is a multi-state cooperative society, then Multi-State Cooperative Societies Act 2002 will become applicable. Now what is multi-state cooperative society? The name itself says if the cooperative society is having its presence in more than one state, then it will become a multi-state cooperative society. And in case if the society is a multi-state cooperative society, then MSCS Act, Multi-State Cooperative Societies Act 2002 will become applicable. So now in this chapter, we will revise how to conduct audit of cooperative societies as per the rules and regulations given under Cooperative Societies Act 1912 and Multi-State Cooperative Societies Act 2002. Clear? So now let us start revising concepts relating to this audit. First of all, what books of accounts are required to be maintained by cooperative society? What are the books of accounts which are required to be maintained? So under the Cooperative Societies Act 1912, the power has been given to state government to prescribe books of accounts for the society which are operating in their respective state. Like if AP state is there, AP state government will decide what books of accounts are required to be maintained by the people, maintained by the societies who are there in the AP state. If the Maharashtra state government is there, Maharashtra state government will prescribe what books of accounts are required to be maintained by cooperative societies in Maharashtra. So like that, under the Central Act, the state government has been given the power to prescribe the books of accounts. But every state government should prescribe some minimum books. Every state government should prescribe minimum books. What are the minimum books to be prescribed? All sums of money received and expended by the society, nothing but cash book. Every state government must prescribe for the societies in their state. They have to maintain a record which contains the details of money received and expended, cash book, and records relating to sales and purchases of the goods by the society, records relating to assets and liabilities of the society, and in case if the society is engaged in manufacturing of the goods, then records relating to utilization of material and labor, nothing but cost records. So these minimum records must be prescribed by every state government. And these records are only minimum requirements. The society is always at the liberty, at their choice to maintain additional records. Even state government also can prescribe additional records. The above four are what? Just minimum requirements. If the society wants, they can maintain extra records, or if the state government want, they can also prescribe for extra records. So what could be that example of additional records? It could be a daily cash sales summary register, or it could be a register of collection from debtors, or it could be a register for recording recovery of loans, or even it could be a loan disbursement register. Like this, additional records also can be maintained, and even these additional records also just illustrative examples. These are also not conclusive list. So the conclusion which I want to make here is the society, after maintaining minimum books, they are at their choice, or even state government may prescribe additional books also. Whatever additional book they want, they can prescribe, or whatever additional books the society want to maintain, they can maintain at their own freedom. Clear? Next, what services can a chartered accountant provide to a cooperative society apart from audit? We will provide audit. We will do audit of cooperative societies. But in addition to that, what other services we can provide apart from that? So nothing but you can write here section 144 services. That entire list you can write here. We can help them in guiding in the accounts writing. We can help them in installation of accounting systems. We can help them in internal audit. We can provide management consultancy services. We can provide taxation services. So not just audit, we chartered accountants can help the cooperative societies in these various manners. Understood? Now, let us try to understand some restrictions about the cooperative societies. See, cooperative society cannot function in whatever manner they want. Like as I have told, they cannot make anybody a shareholder. Similarly, on their financial matters also, there are so many restrictions imposed. Here the restrictions are very higher than when compared with the company. In the cooperative society, restrictions are very higher. Like there is a restriction on maximum shareholding which one person can hold. There is a restriction on loans. There is a restriction where the society can go and invest their funds. So like that, in the case of cooperative society, there are lot of restrictions. Here I have given a few scenarios. Let us see that restrictions. Number one, restriction on shareholding. One person cannot hold how many number of shares he want. There is a maximum limit which one person is permitted to have the shareholding. So that limit is the maximum amount of shareholder that a single member can hold is either 20% of the total number of shares or having a face value of 1000 rupees, whichever is lower. A single member can hold only maximum of either 20% of the total number of shares, or if they are having a value of 1000 rupees, whichever is lower, only that many maximum shares a individual person can hold. Similarly, the society cannot give loans to anybody. But what in fact Cooperative Societies Act says is, society shall not make loan to any person other than member. Which means a cooperative society can give loans to its members. Other than members, the cooperative society shall not give the loan. However, with a special approval from the registrar of cooperative societies, a registered society can make a loan to another registered society. Generally, every society has been given the power to give the loans to its members. But apart from that, a society can give loan to another registered society, provided they can do it only after getting approval of the registrar of cooperative societies. Then borrowings. There is a restriction on borrowings being accepted. The society shall not accept loans and deposits from persons who are not members. They can accept deposits only from members. From other than members, they can't even accept the loans and borrowings also. And whatever funds the society is having, they can't invest that money wherever they want. The society can't go and invest all their money in the stock markets. There are specific instruments specified in which the society shall invest their money. Apart from these sources, apart from these assets, the society shall not invest its money anywhere else. So where exactly they can invest the money? Like they can invest in central or a state cooperative bank. They can invest in any other bank other than a state or central bank. Like for example, a normal nationalized banks, etc. In that banks they can invest. Or in any of the securities which are specified in section 20 of the Indian Trust Act, like treasury bills, government bonds, etc. Like that, some instruments are specified under Indian Trust Act section 20. In that instruments also society can invest. Or even they can invest in shares, securities, bonds, debentures of another society. That too with a limited liability, not in the share market, guys. A society can buy the shares, securities or debentures of another society with limited liability, not in the shares of the companies or in any other monies permitted by central or state government. So even there is a restriction on the society to invest their money. They can't go and invest it wherever they want. Only in these instruments they have to invest your money. Next one, appropriation of profits to reserve fund. That means every society shall transfer 25% of their profits to reserve fund. They need to maintain one separate fund with the name reserve fund. Every year, out of their profits, 25% of the profits should go to reserve fund before distributing the dividends. That means a society can distribute dividends only out of those profits which are left after transferring the required 25% to reserve fund. So now every year they will make this, they will transfer this money to the reserve fund. No, what they will do with that money? So for what purpose they will use that reserve fund? So here if we read the 9th point, investment of reserve fund outside the business or utilization as working capital. Generally, this reserve fund will be once again used for the cooperative society's business only, for their working capital only. But in some cases, some special purposes also you can use it apart from business and working capital requirements. So whatever 25% of the money we are transferring to reserve fund, that will be generally used for business. But as per the act, for some other purposes outside of the business also the society can use. What are that other purposes outside of the business? So some of the state acts, and once again, this permission is not given by all state governments. Only some state governments they are giving permission. You can invest this reserve fund in some sources outside the business. So what are that some state acts providing? So some state acts provide that a society may use the reserve fund in the business of the society as a working capital. This everybody can do. Or they may invest it as per the provisions of the act. Nothing but just now we have read where a society can go and invest their money, this fourth point. So whatever money which is there in the reserve fund, that money in the reserve fund can be invested in these also, in these instruments also. Or it may be used for some public purposes like which promote the objective of the society. If you feel that if you incur the money in the reserve fund, it will promote the objectives of the society, so even you can use it for some public purposes which will promote the objective of the society. And even the auditor should ensure that strict compliance with the rules and regulations in this matter. Utilization of reserve fund should be seen very carefully. So whatever money that they are transferring to reserve fund, that can be used for business, working capital, they can go and invest in the specified instruments, or they can use it for even any other public purposes if they believe that that is going to promote the objective of the society. So this is what regarding reserve fund. Apart from that, if at all, if any society wants to contribute some money for charitable purposes, they can't use whatever amount they want for charitable purposes. Even on that also there is a limit. A society may, with the sanction of the register, with the approval of the register, they can contribute an amount not exceeding 10% of the net profits, which is remaining after compulsory transfer to the reserve fund. Which means assume that if the society has made 100 crores of profits, in this 25% will go to reserve funds. 25% will go to reserve fund. So if you take that 25 crores, remaining profit will be how much? 75 crores. In that 75 crores, 10%, maximum 10%, a society can contribute for charitable purposes. Don't be of a wrong notion that out of this 100 crores, 10%. No. After taking the amount of the reserve fund, whatever rest of the profit is left out, in that 10% can be invested in, can be used for charitable purposes. Maximum only 10%. That too, for contributing that 10%, you need approval of Registrar of Cooperative Societies. And if you want to contribute some amount to education fund, that also you can do it, provided at prescribed rates. So different states have given different rates. Some state 2%, some state 3%. So according to the rates prescribed by the state government, they can even transfer it to education fund. And if they want to make any other appropriations, they can do any other appropriations subject to the compliance with the rules given by government. Understood? See, these many restrictions will be there in the functioning of the cooperative society. These many restrictions will not be there in the case of company, but cooperative societies will contain these many number of restrictions. Restriction on the shareholding, restriction on the loans, restriction on borrowings, restriction on spending on charitable purposes. For everything we have a restriction. So whatever points I have told you, all these are important for MCQs, true or false statements, etc. Clear? Now let us come to the audit related matters. For a normal cooperative society, who is eligible for getting appointed as an auditor? For company, we have seen, for company who is eligible for getting appointed as an auditor, a chartered accountant having certificate of practice. For a cooperative society, who is eligible for getting appointed as an auditor? Let us see. So eligibility to get appointed as an auditor, generally a chartered accountant having a valid certificate of practice is only permitted to act as auditor of cooperative society, a chartered accountant having COP. But in addition to that, any other person having qualification as required by respective states. That means all over India, chartered accountant having certificate of practice can be appointed as auditor. But what some state governments have done is, we will not only consider chartered accountant, we will even consider other qualifications also. Like what qualifications? So a person who is holding a government diploma in the cooperative accounts, or a person who has served as an auditor in the cooperative department of a government. This other qualifications also will be considered, not by all the states guys, only some state governments have told that we will accept chartered accountancy having certificate of practice, but we will accept even other qualifications also, like what, a person who is holding diploma in cooperative accounts, or a person who has served as auditor in cooperative department. These other qualifications also will be considered, but once again I am saying not all over India, only some states. All over India, which qualification is accepted? Chartered accountant having certificate of practice. Clear? Now, who will make appointment of auditor of a cooperative society? They have very straight away told that registrar of cooperative societies will be there. They will make the appointment of auditor of the cooperative society. Neither members nor the board. The registrar of cooperative society will make the appointment of auditor of a cooperative society. And the auditor so appointed, after he has completed the audit, he will submit the report to registrar only. and fees will be decided by the registrar, but it has to be paid by the society. Appointment done by registrar. Report will be sent to registrar. Fees will be decided by registrar, but fees will be paid by society. Clear? Next one. Now there are some special points which will be there while you are doing audit of a cooperative society. So what are that special points? Some 10 special points they will try to say here. Let us try to understand. First one is regarding overdue debts. First of all, what is the meaning of overdue debts? Overdue debt means what? An amount which is outstanding beyond the due date. So regarding overdue debts of a cooperative society, auditor will have three responsibilities. Number one is classification. Into three categories he need to classify, which are overdue for 0 to 6 months, 6 months to 5 years, and more than 5 years. Three classifications he is supposed to do. After doing classification, he need to assess out of these overdue debts, how many are recoverable, how many are not recoverable. After doing that assessment, the auditor should make sure that there is enough of provision has been created for those debts which are considered to be irrecoverable. So three responsibilities on the auditor regarding overdue debts. What are they? Classification, assessment of recovery, and then whether enough of provision has been created for doubtful debts. So this is what the first special point. Second one, overdue interest. Now first, what is the meaning of overdue interest? Overdue interest means interest which is accrued or accruing in the accounts in respect of which principal is overdue. Those accounts in which principal is overdue, in that accounts whatever interest that is accrued or accruing. For example, I have given loan to one person. 1 lakh rupees of loan I have given. That is a principal amount. Due date is 31st of March. Due date is over, but I did not receive this principal. Now during the tenure of the loan, some interest would have been accrued. No, some 10,000 rupees of interest is accrued. So the interest accrued in respect of those accounts where principal is overdue, that we call it as overdue interest. And accounting treatment we need to verify here. Accounting treatment is this overdue interest will be excluded from interest income. That means it will not be considered while calculating interest income. It should not be taken to statement of P&L. But instead what needs to be done is it has to be taken to one reserve, overdue interest reserve. And from that reserve, it will be transferred to P&L when it is actually realized. Overdue interest will not be taken to statement of P&L directly. But instead what we will do, overdue interest, we will take it to the reserve account, overdue interest reserve. From that reserve, we will take it to P&L when it is actually realized. Which means simply what they are trying to say here is overdue interest should be recognized on cash basis, not on accrual basis. That is what they are trying to communicate here. Very simple point. Third one, bad debt, certification of bad debts. See, some state governments say that if any bad debt has to be written off, that compulsory needs authorization by auditor. Some state governments say this. If a society has to write off some debt as bad, it needs approval, authorization from the auditor. If the state government is putting such requirement, now there is additional responsibility on the auditor. He should check the debtors balance and certify whether they are really bad or not. When there is no such requirement from the state government regarding auditor certification, then auditor need not authorize, but auditor need to check whether managing committee authorized or not. Simple. If there is a authorization requirement on auditor, auditor will authorize. If there is no such requirement, auditor will check managing committee authorized or not. Understood? Now fourth point, valuation of assets and liabilities. This is not anything a special point. This is what routinely we do in every audit. So when it comes to assets, we need to check existence, ownership, valuation of the assets. We need to check that fixed assets are valued at cost less accumulated depreciation. We do it everywhere. And whatever incidental expenses are there, like installation expenses, etc., that also should be capitalized. And whatever current assets are there, they should be valued at cost or market price, whichever is lower. Simple. And when it comes to liabilities, all known liabilities should be brought into account. That means all known liabilities should be shown on the balance sheet. Whatever contingent liabilities are there, they should be shown by way of notes to accounts. That's it. Fifth one, adherence to cooperative principles. See, in the case of cooperative society, just checking financial statements alone will not be enough. Even I need to check for whatever objectives the society has been set, whether that society is able to achieve its objectives or not. So especially in the case of cooperative societies, it is not just enough for me to check the financial statements. I need to even check for whatever objective the society has been set up, whether those objectives are met or not. Sir, on what basis I will assess whether they have achieved the objectives or not? On the basis of profits? No. the whether society has achieved the objectives or not, that I should not assess it on the basis of profits, but I should find it out on the basis of services provided to the members. If the society is providing more services to the members, yes, it is achieving the objective. And even we need to consider principle of propriety. That means in the cooperative societies audit, it is not just enough to check the supporting documents. We should even check whether any expenditure is wastefully getting incurred. We need to find out even when we are verifying expenses, even we need to check that no expense has been wasted. No expense should be incurred without any value addition. So checking that wastage in the expenditure, I call it as what? Proprietary audit, that I have to do it in the case of cooperative societies. Clear? Next one. And apart from that, I need to check all the laws and regulations which are applicable to the society have been complied with or not. Next one, I need to verify the members' passbook, especially in the case of rural cooperative credit societies. So in the rural cooperative societies, people will be illiterate. So their society's management might try to cheat the members by passing wrong entries in the members' passbook. So in the case, if I am conducting audit of a society, that too in a rural area, I need to check the members' passbooks also. And regarding certain matters, the auditor should submit a special report to the register. Regarding 4 matters, auditor should submit a special report. In addition to the main report, you need to submit one extra report. Regarding which matters? 4 matters. What are they? Personal profiteering. If you find that the management of the society, instead of providing benefits to the members, they are getting personally profited out of the transactions of the society, you need to report this matter specially to the register. So personal profiteering by the members of the managing committee. Or if you find out any fraud, regarding that fraud also you have to send a special report. If you find any mismanagement, that means management is taking decisions against cooperative principles, send a special report. And in the case of urban cooperative banks, if you find any disproportionate advances, that means society is giving advances without checking any security, credit worthiness, they are not collecting money. So if you find any of this reckless advancing, this also should be reported to register. So these are the 4 matters regarding which auditor should send a special report. In addition to that, you need to award a class to the society. After you have done the audit, you would form some understanding about functioning of the society. On the basis of understanding of functioning of the society, auditor should award a class. Award a class means giving a grading, like A++. So like that, some grading will be there. Some criteria will be given by the register. According to that criteria, auditor should even award a class to the society, give a grading or ranking to the society. And finally, you should never finalize the audit report without first communicating with the managing committee. So you finalize audit report only after having a discussion with draft audit report with managing committee. But once again here, you are not supposed to take the permission. Just you have to let them know how you are going to give the audit report. That's all. They're not asking you to take the permission. Just have a discussion and do whatever you want to do. So these are all the special points in the audit of a cooperative society. Now coming to the next few questions, what are rights and duties of auditors of cooperative society? When it comes to powers, very simple. The auditor will have access to all the books and documents. The auditor can get extra information and explanation also by inquiring every officer of the society, similar to rights of company auditor only. Now, what will be the duties of cooperative auditors? So the auditor should mention in his audit report whether he has obtained all the necessary information and explanation, whether in his opinion financial statements give true and fair view, whether proper books of accounts are maintained by the society, and whether financial statements are in agreement with the books of accounts or not. So on these are 4 mandatory responsibilities on the auditor which he should mention in his audit report. Now, there are certain matters regarding which auditor need to attach schedules. Previously, we have seen special report. Special report means altogether separate report will be given to the register. But here I am saying schedule. Schedule means not altogether a separate report. Schedule means just an attachment to the main audit report. So regarding certain matters, auditors should need to attach a schedule, an extra attachment to the main audit report. So for which matters schedules will be attached? So once again, 4 matters. What are they? If you find any transactions which are against to the provisions of the act, if you find society has done any transaction which are against to the applicable laws and regulations, you have to attach a schedule for that. all sums which ought to have been brought but not brought into the accounts by the society, like omissions. If you find any entries which are supposed to be included in the books but the society did not include it, attach a schedule for that. Or if you find any asset belonging to the society which is bad or doubtful of recovery, add it as a schedule. And similarly, if you find any irregularity or impropriety in expenditure, regarding that also you have to give a schedule. Understood? So these are the 4 matters regarding which schedules are to be attached to the audit report. So till now, whatever questions we have seen, those are all related to audit of a normal cooperative society. Now we have a few set of questions which are related to audit of a multi-state cooperative society. See, normal cooperative society audit will be governed by Cooperative Societies Act 1912. Multi-state cooperative society related matters will be governed by Multi-State Cooperative Societies Act 2002. Now let us see, what does Multi-State Cooperative Societies Act say about audit of a multi-state cooperative society? First of all, qualification. Who is eligible for conducting audit? Here strictly only chartered accountant having a certificate of practice. For a normal cooperative society, some state governments will consider other qualifications also. But for a multi-state cooperative society, no other qualifications are considered. Only chartered accountant having certificate of practice can only be appointed as auditor of a multi-state cooperative society. And disqualifications, even auditors will suffer from some disqualifications. Who are ineligible for getting appointed as auditor of a cooperative society? Who are they? A body corporate can't be appointed. An officer or employee of the society can't be appointed. A person who is a member or who is in employment of an officer or employee of the society. 141 subsection 3. I think you are able to make some sense. 141 subsection 3 clause A, same thing they say, body corporate, officer or employee, somewhat similar to that. Similarly, a person who is indebted to the multi-state cooperative society or who has given any guarantee or provided any security for an amount exceeding 1000 rupees, those people also will become disqualified. And after appointment, if you attract any disqualification, like under Companies Act, we should here also immediately vacate the office if we attract any subsequent disqualification. Now, authority to appoint. Who will appoint the auditors? In case of first auditor, the auditor will be appointed by board of directors within 1 month. In case of Companies Act, they say 30 days. Here they say 1 month. Don't use these terms interchangeably. 1 month is different, 30 days is different. So please use appropriate terminology. So in the case of multi-state cooperative society, first auditor will be appointed by board within what duration? 1 month. And in case if the board fails to do it, the power will go to members of the society. They will do it in the general meeting. And what is the tenure of the first auditor, sir? Till the conclusion of first AGM. What will be the tenure of subsequent auditor? Now, who will appoint subsequent auditor? Members will do it. And what will be the tenure of subsequent auditor? Till the conclusion of next AGM, they are supposed to hold the office. Clear? So these are the related matters. These are the auditors related provisions as stated in Multi-State Cooperative Societies Act. Now, powers. Powers are same 2 powers. He shall have access to all the books and documents. He can inquire officers and get the extra information. Now, coming to the duties. Duties, they have given it under 3 sections. 73 subsection 2. Auditor is required to report on some matters. This will be very much similar to whatever we have revised in audit reporting. 143 subsection 1. Under 143 subsection 1, there are 6 points which are required to be reported. Out of that, 4 they will give it here. Next one, 73 subsection 3, nothing but right of the auditor to report to the members. This we have seen in the chapter company audit. In the company audit, rights of the auditor, we would have seen one point, right of auditor to report. The same paragraph will be reproduced here. And they have given some duties under 73 subsection 4. This will be very much similar to 143 subsection 3. There we have seen 15 matters. Out of that, first 4 points will be given as it is here. Understood? So this is what the duties are. Almost exact provisions and even limited number of provisions which have been copy pasted only from Companies Act. Clear? So this I am not wasting the time here to explain it in a detailed manner. Then we have last 3 questions left in this chapter. These are a bit important and conceptual. There we will try to spend the time. Now, first we will talk about, in the case of multi-state cooperative society, the central government has been given the power to order for special audit. Who has been given the power to order for special audit? Central government has been given the power to order for special audit of a multi-state cooperative society. When I say special audit, this is in addition to the statutory audit which will happen every year. So section 77 of the Multi-State Cooperative Societies Act, it has given power to the central government to order for special audit. When I say special audit, what do I mean here? It is an additional requirement in addition to the requirements of statutory audit. Now, but central government will not do it for time pass. So central government will do it only when they come across some circumstances. So in what circumstances central government will order for special audit? They give 3 circumstances. If the central government came to know that the affairs of the society are not being managed in accordance with cooperative principles. That means if the central government came to know that multi-state cooperative society is not working for the benefits of the members, instead the management is trying to get benefit out of it, then the central government may order for special audit. Or if the central government came to know that that society is being managed in such a manner that it is likely to cause a serious damage to the entire industry or trade, or central government came to know that multi-state cooperative society, one society is there, it is working in such a manner that not just that society is getting affected, entire industry is in danger, then also they can order for special audit. Or the financial position of the multi-state cooperative society is very bad that its solvency position is in danger. It is about to go bankrupt. Such a bad financial position they are having. So if the central government comes across any of these 3 circumstances, which 3 circumstances? If the affairs are not being managed in accordance with cooperative principles, or the operation of the society is in such a manner that it is likely to cause a serious damage to the entire industry, or the financial position of the society is very bad that its solvency position is in danger. So if the central government comes across any of these 3 circumstances, then they will order for special audit. But one condition here, having these 3 circumstances alone will not be enough. Even one more condition should be fulfilled for the central government to order for special audit. What is that one more condition? That condition is the central government or state government shall hold 51% or more of the paid up share capital in such society. Here is what the condition. Just having the above circumstances alone will not be enough. If the central government wants to order for special audit, the central government or state government or their combination should hold minimum 51% of the paid up share capital in that society, then only they can order for special audit. If that shareholding is not there, even the above circumstances are present, they can't order for special audit. So if they ask you write about applicability of special audit, you need to write that 3 circumstances along with this condition. Now, what is the procedure for conducting special audit? First, who will appoint the special auditor? Central government only will appoint. Who will be appointed to do the special audit? Either they can appoint a chartered accountant, or they can appoint the society's auditor, statutory auditor himself as a special auditor. It's up to central government's decision. Appointment will be made by central government, and whom they will appoint? They can appoint any other chartered accountant, or they can appoint the society's statutory auditor himself to do special audit. That's up to the choice of central government. Who will decide the remuneration? So remuneration will be decided by central government, paid by the society. Central government will decide it, this much remuneration. Who will pay it? Society has to pay it. Sir, what will be the powers, sir? Same like the powers of normal statutory auditors. To whom the special auditor will report, sir? To the central government special auditor will report. What matters he will report, sir? That central government will say. On what matters you are supposed to report? Central government will say. Now, who will take action on that report, sir? Central government only will take action. What action they will take, sir? Whatever they feel appropriate as per relevant laws and regulations, they will take that action. Sir, report is submitted, 4 months is over, but still central government did not take any action. Then what should happen? Then what should happen is the central government shall submit that report of special audit along with the central government's comments to the multi-state cooperative society. If they take action within 4 months, well and good. If the central government is not taking any action within 4 months from the date of receipt of the report, then what central government should do is the special auditor's report along with that central government's comments must be sent to multi-state cooperative society. And the central government shall ask multi-state cooperative society to circulate that copy or extracts of that special auditor's report to each and every member of the society, and also to read it out before the next society's meeting, general meeting. Understood? So if they take steps within 4 months, well and good. If they are not taking it, the central government will send it to society, and it will ask the society to circulate this report to every member and also read out this report before next general meeting. Understood? Now, We are left with two more questions from this chapter. Power of central registrar to order for inquiry under section 78. Power of central register to order for inspection under section 79. See, special audit power has been given for central government. In addition to that, central registrar has been given the power either to order for inspection under section 78, or even they can order for inquiry under section 78, or they have been given power to order for inspection under 79. First, we need to understand difference between inquiry and inspection. Inquiry means calling somebody to your office and asking the question. Inspection means what? Registrar themselves will go to the society's premises and start verification. That is what we call it as inspection. Which powers are given? Both the powers are given. Which thing registrar will do depending on facts and circumstances of each and every case. But there are some formalities which central registrar has to follow before doing this inquiry or inspection. Both the answers will be same. We will try to complete both the answers in one go. So before central registrar can make either inquiry or inspection, someone should make an application to the registrar. Who can make that application? So any creditor, or not less than 1/3 of the members of the board. If there are total 9 board of directors, not less than 1/3, minimum 3 directors should make an application, or not less than 1/5 of the total number of members. If there are total 100 members, 1/5, minimum 20 members of the society. So these are the people who are eligible to make an application to the central register asking to conduct inquiry. Not just inquiry, guys, even for inspection also, the same people are required to make an application to the registrar. Clear? Next. To whom application will be sent? Obviously, central register. If you are expecting central register to conduct inquiry or inspection, to them only you have to send your application also. Now, who will do the inquiry, sir? Both inquiry and inspection, it will be done either by registrar himself will do it, or he can authorize some other person to do the inquiry or inspection. Same point even for inspection also. For cross reference, you can see inspection by whom? Either by registrar himself or any other person authorized by him. And one more thing, before doing that inquiry or inspection, minimum 15 days of notice must be given to the society. Both for inquiry and inspection, before any inquiry or inspection can be ordered, minimum 15 days of notice must be given to society. Then only you can do inquiry or inspection. Now, what will be the powers of the person making inquiry? So, whoever is conducting that inquiry, either registrar or any other person authorized by him, that person will have power to access all the books and documents. He can call any officer of the company to bring any officer of the society to bring the books to his place and ask questions to them. So he will have right of access to the books. And even the person conducting inquiry will be given the power to call for general meeting also. First he will go and request, sir, please call for general meeting. If officers are not listening, the person conducting inquiry himself will have the power to call for general meeting by himself. And even the person conducting inquiry will have the power to issue summons also. Summons means legal notices. He will have the power to issue legal notices like a court order. Summons means what? Giving something similar to court order. Anybody who is in receipt of summons, they must appear before the regulatory authority on so and so date. Otherwise, it will be a punishable offense. So like this, the person whoever is conducting inquiry, he will have 3 powers: right of access to the books, right to call for general meeting, and even he will have the power to issue summons also. Similarly, the person whoever is making inspection, he will also have some powers, like he will also have access to the books and documents, and if he finds any serious irregularities, he can take that books into his custody also, and with the prior approval of the register, he is even having right to call for a meeting. Even when it comes to powers also, 2 powers are common. Both for person conducting inquiry and inspection, 2 powers are common: right to access to books, right to call for general meeting. Person conducting inquiry will have a power to issue summons. Person conducting inspection will have a power to take the books and documents into his custody. Only one power will differ, 2 powers will remain common. Now, once that inquiry and inspection is completed, what will happen? What will happen is the central register, within a period of 3 months from the date of completion of inspection or inquiry. Within what duration? Within 3 months from the completion of inquiry or inspection, that report of inquiry or inspection should be sent to multi-state cooperative society and also to the person or authority at whose instance that inquiry or inspection is needed. So within 3 months from the completion of inquiry or inspection, the central register shall submit that copy of inquiry report or inspection report to the society. Along with that, at whose instance, whoever has made the application asking for inquiry or inspection, to that person also you have to send one copy of that inquiry or inspection report. That's all. These are the provisions of Cooperative Societies Act dealing with audit of normal cooperative society and multi-state cooperative society. So successfully we are done with revision of Cooperative Societies Audit chapter. Clear everyone? Good now. Now we will try to revise one small topic called government audit. So as the name itself says, this chapter is going to give us a brief about how do we do the audit of government oriented entities. So as we all know, the governments in our country are operating at three levels, that is at the central government and also at the state government and local body level. And if you observe, each and every level of government will be having incomes. They make incomes. So does the central government have income? Yes. In what form they will have income? Collection of taxes. Like if you take central government, all the income taxes and CGST component of the GST, these things will go to central government. Similarly, state government also will have their share of income from SGST component of this GST. And apart from that, the local bodies like municipal corporations, etc., they will also have their share of income from local taxation like municipal taxes, water taxes, etc. So like this, at all levels of government, if you observe, they are going to have incomes. At the same time, they will even spend the money. They are going to even spend the money also, whatever income they are having. They will have expenses. They will have their assets. They will have their liabilities. And the governments at all these levels will maintain books of accounts. They will also prepare financial statements. Do you think audit of these books of accounts and financial statements of the government is required? Yes, very much required. Why? Because the levels of government, whatever income they are having and whatever they are spending, that is not the money which they are spending from their own pockets. That is the money which they are spending is public money. The common public like you and me who have contributed this income in the form of taxation, that is what the income which is going to the government, and that is what the government is spending the money. And as we all are aware, the government money, the whatever money the government is spending, that is supposed to be for the benefit of common public like you and me, which generally will not happen. So but objective is what? To make sure that whatever income that has accrued to the government, that should be spent for the public welfare. So like any other entity, the audit of governments is also of utmost importance. And if you ask me, then any other entity, the audit of the government entities are very important. Why? Because that is where the public money is involved. That is where the public money is getting used. That is where the public money is getting collected. So this chapter is going to throw a brief on, we are going to throw some light on briefly relating to the concepts of government audit. We are not going to have an in-depth or a detailed understanding of how to do the government audit. It is just a brief or overview of what actually happens in the government audit related matters. So let us try to understand. Here they will try to say in this chapter how to conduct audit of government expenditure, how to conduct audit of government revenue, how to conduct audit of stores and inventories. And also whenever we say government related accounts and audit related matters, whenever we speak about government related and government related audit and accounts matters, a authority will come into picture who will be referred as C and AG, Comptroller and Auditor General of India. Like that, an authority will be there. This C and AG is going to be the authority who is going to look after accounts and audit related matters of all the governments and government related entities. So in this chapter, even we are going to revise about the provisions regarding that C and AG. What are the duties of C and AG? What are the powers of the C and AG? What is his tenure? What role he will play in the government audit? And what role he will play in the company audit? So all that things we are going to have a quick revision. Clear? So without any delay further, let us proceed with the concepts. First of all, how the term government auditing has been defined. So if you have a look at the definition, government auditing is an objective, it is an unbiased and systematic, professional and independent examination of financial, administrative and other operations of a public entity. So in the government audit, we are not just verifying financial information, we are verifying financial, administrative and even other operations of the entity which are made subsequent to their execution. That means once the government executes all these activities, then we will verify, not before execution. After government has executed their functions, then we will go and verify. And also Just a minute, let me zoom out a bit further. And for the purpose of evaluating and verifying them, we are going to analyze and verify their activities with the objective of presenting a report in which we will tell our comments, we will tell our findings, even we will give recommendations for further improvement of that government entities, and even we will express a professional opinion on that financial information of the government. So what in short we are going to do in the government audit? We are going to examine here also in an objective, systematic, independent manner. We will examine financial, administrative and other operations of a public entity which are made subsequent to their execution, and we will evaluate, we will prepare a report, tell our findings, give our recommendations for improvement. Along with that, even we will express our opinion on that financial information of that government entity. And why we do government audit? Why? Because we have some specific objectives here. We want to make sure that whatever public funds are there, whatever funds the government is collecting from the public, whether each and every rupee is properly getting accounted or not, that we want to find out. Second objective, appraisal of government policies. Whatever policies the government is implementing, we will review whether those government policies are really for the benefit of the people or some middleman is getting benefited out of it. That review of the government policies also we will do. Along with that, even our audit will form basis for corrective actions taken by higher officials. So by doing audit, we will find out weaknesses where the ground level government employees are doing wrong. So by that audit observations, what higher level government authorities will do is they will take appropriate actions. So our audit report is going to form the basis for actions to be taken by the higher officials in the government, and even it will ensure accountability. The employees and staff will become more responsible, more accountable. Why? Because they will have a fear that auditor will come and verify the transactions. So that will make them do their work with more responsibility. So these are the four objectives of why government audit will be conducted. Why it will be conducted, guys? For ensuring proper accounting of public funds, for appraisal of government policies, for taking corrective actions, and also for ensuring accountability among the government employees. And this is what government audit is all about. Now we will try to have a revision of how to verify government expenditure, or what points we will try to verify in the government expenditure, what points we will try to verify regarding government revenues, what points we will try to verify regarding government stores and inventories. So all that things we will try to focus. First one, the most important aspect of government audit is verifying of expenditure made by the government. So whatever expenditure which the government has made, that we need to verify. And that expenditure need to be verified from 5 perspectives. Whatever expenditure that government has made, that expenditure need to be verified, and that expenditure we have to verify from 5 perspectives. So you could see the 5 perspectives here: audit against rules and orders, audit of sanctions, similarly audit against provision of funds, proprietary audit, and performance audit. So like this, whatever expenditure government has incurred, that expenditure an auditor should verify. And that when we are verifying that government expenditure, 5 principles we need to verify. Number 1, audit against rules and orders. The name itself says whatever expenditure which the government has incurred, that expenditure should be in accordance with relevant laws and regulations. No government authority should spend the money beyond the laws and regulations. That is the first thing which auditor should verify. Whatever expenditure which the government is making, whether it is as per financial rules and regulations or not, that we need to check. That's what, even if you could see here, statutory enactments, statutory laws and regulations, whatever has been said, expenditure has been incurred in accordance with laws and regulations. Audit of sanction. Sanction means nothing but approval. Every expenditure made by the government, that should contain some approval from concerned authority. When I say approval, depending upon the level of government, who will approve will change. If the central government is making expenditure, some ministry will approve. If the state government is making expenditure, some MLA will approve. If the local body is making some expenditure, that collector or public officials, public representatives will approve. So like that, whatever it is, whatever level it could be, whatever expenditure which the government is incurring, that should be approved by concerned authority. Checking whether approval is there or not, that we call it as audit of sanctions. Then comes the third item, audit against the provision of funds. We all know government functions by way of budgets. Every year, well in advance, budget will come. So in that budget only, in which area how much amount will be allocated will be decided well in advance. So as an auditor, I need to make sure that whatever expenditure government has incurred, that should be within the budgeted amount. So provision of funds means nothing but budget. So what amount has been allocated for one project, whether the government has incurred the money for that project within that limit only. So checking that budgets, we call it as audit against the provision of funds. Then we have proprietary audit. Once again, as I have told, verification of wastage of the funds. In the case of government audit, not just checking the supporting documents alone will be enough, not just checking the approvals will be enough. You need to check whatever money that government is spending, out of each and every rupee spent, there should be some value addition. Not even a single rupee of the public funds should be wasted. So checking whether there is any wastage of funds, that we call it as proprietary audit. So financial proprietary, that means there should not be any wastage of the funds. That I need to specifically check in the case of government company. Why? Because if the money is wasted, that is not government's money, that is public money which is getting wasted. So I need to check each and every rupee spent by the government is spent without any wastage. Then last aspect of expenditure verification, which is performance audit. Performance audit means nothing but government will take care of big projects and schemes like dam construction, highway construction, all these things will happen. So whatever big projects and schemes are there which are carried out by government, whether they are giving expected benefits, whether they are complying with the targeted objectives, whether those big projects and schemes are run economically, checking that, we call it as performance audit. So like this, whatever expenditure has been incurred by the government, that we will verify from 5 perspective: audit against rules and orders, checking the compliance with financial rules and regulations; audit of sanctions, nothing but checking of approvals; audit against provision of funds, whether expenditure has been incurred within the budgeted amount; proprietary audit, checking there should be no wastage of the funds; performance audit, whether big schemes and projects are getting carried out in order to meet their expected objectives. Understood? Now talking about proprietary audit in detail. Sir, you told proprietary audit means finding out whether there is any wastefulness in the expenditure. Sir, but how to decide whether an expenditure is wasteful or not? How can we decide, sir? Can you give any precise rules? Like I'm giving some 10 conditions. If these 10 conditions are satisfied, no wastefulness. If even one of the condition is violated, there is a wastefulness in the expenditure. Like this, can we define any precise rules? No. We can't decide any precise rules regarding proprietary. We can't say exact set of rules and regulations to decide what is wasteful, what is not wasteful. It all depends on common sense and logic applied by the auditor. It all depends on facts and circumstances of each and every scenario. So we can't give precise rules what is wasteful, what is not wasteful. It depends on common sense and logic, but we can give some general principles, common principles. We can say out of our common sense, we can say some random points which will help us to find out whether expenditure is wasteful or not wasteful. So what are they? Some examples they are saying here. The expenditure should not be prima facie more than the occasion demands. So you should not incur even a single rupee more than what the situation is demanding. Your expenditure should be as per the demands of the situation. You should not, just because you are having excess funds, you should not waste it. Whatever money the situation is demanding, only that money you have to spend it. And every public officer is expected to have same level of carefulness when spending public money, like the way he will have a carefulness when he is spending his money from his own pocket. Every public officer, whoever is spending the government's money, should have same level of carefulness like the way he is spending the money from his own pocket. Such a level of carefulness should be there to avoid the wastage. And also, no authority should give approval for any expenditure from which he is getting benefited either directly or indirectly. For example, if the collector is giving approval for construction of a road in which there are his plots located, so directly or indirectly, he is getting benefited out of it. He is not doing it for the common public. Here also there is a wastage in the funds. And also, public money should not be utilized only for one person or one community. That is also getting wasteful. However, in some cases, in some exceptional scenarios, we can use money for one particular person or one particular community. In what circumstances we can use government money only for one person or one community? When the amount involved is very insignificant, very negligent amount is there, that amount of money you can spend. Similarly, if there is any claim which can be enforced in the court of law, like as a part of road extension, the government has collapsed one person's building. Now, government has to pay compensation. Can the government say now, no, it will be improprietary, it will be wasteful, we cannot spend the money for one person? Can they say it? No. Why? Because if you don't pay him the money, he will approach the court. That claim is enforced. That claim is enforceable in the court of law. Or that expenditure you are spending is a policy, is a part of recognized policy or custom. Like in India, we have some policies to help that tribal people, etc., to provide them some opportunities. If there is any such policy, yes, you can use it. And amounts of allowances should be like a helping hand. They should not become a source of profits for the recipients. A source of income, when if the government is spending money for one particular community, it should be like a helping hand for that community. It should not become source of profits. Like government is giving pension for old age people. See, if they are giving some monthly 2000, 2500, fine. Now some government is having a lot of excess money. Now they decided that every month they will give 20,000 to the old age people. So now, instead of giving benefit, that is acting as a source of profits in that recipients. Government expenditure should not be wasted like that. So like this, whether a fund is wasted or not wasted, that we can decide using this some common principles. Once again, these are not conclusive list, just example sake they have given this. Clear? So keeping all these factors in mind, the auditor should decide whether the expenditure is wasted or it is spent without any wastage. Then performance audit, like performance audit, as I have told you, in the case of performance audit, we will check whatever big projects are carried out, any program, any project like dams construction, highway construction, whatever big projects and schemes are carried out, whether their financial and operational performance is satisfactory. Whatever big projects and schemes which the government has carried out, whether its performance is satisfactory, whether they are giving expected results, whether they are done properly, resources are consumed properly. So checking that, we call it as performance audit. And this performance audit will have three more subtopics under that. Performance audit once again contain three more components. All the three are part of performance audit only. So the three components of the performance audit are, as you could see here, efficiency audit, economy audit, and effectiveness audit. These three are all what? Parts of performance audit only. Now let us try to understand what is efficiency audit, what is economy audit, what is effectiveness audit. Out of these three, first we will start with easier one, which is economy audit. What do you mean by economy? Economical means what? Economical means if you are able to procure something at lowest possible prices, that we call it as economical. Now economy audit means for the purpose of carrying out these big projects and schemes, government need various resources. They require human resources, they require capital resources. So whatever resources they required for the purpose of carrying out this big project or scheme, whether that resources are all procured at reasonable prices. The government should not unnecessarily waste their money on procuring resources. That is, they should not pay higher prices for inferior quality of the material. They should pay reasonable prices and should get best quality of the raw materials. So checking that, we call it as economy audit. Efficiency audit, as we all know, checking whether the project is getting completed within the time limit given. So every project will have some tentative due date. So whether that project is getting completed within that expected time limit or not, and also resources during the phase when the project is going on, whether resources are consumed properly or not without any wastage, checking that, we call it as efficiency audit. Effectiveness audit, which will happen once that entire project has been completed. So government has constructed dam. Now there is an objective with which the dam is constructed. Assume some 50,000 acres of land should get irrigational facilities. Now after the completion of the project, I need to check with whatever objective this project has been started, whether that objectives are met or not. So that is what we call it as effectiveness audit. So economy audit is easier to understand. The difference between efficiency audit and effectiveness audit is, efficiency audit is something which will happen when the project is still going on, whereas effectiveness audit is something which will happen once the entire project is completed, once the entire project is over, checking whether the objectives are met or not, that is effectiveness audit. Whereas as and when the project is still going on, whether it is getting completed within time, whether the resources are consumed properly, checking that is a efficiency audit. So one is carried out during the course of project, other one is carried out after completion of the project. So this is what regarding performance audit. Now next, since we are done with audit of receipts, let us try to understand how to conduct, since we are done with audit of expenses, let us now try to understand how to verify government receipts. So what will be the receipts for the government? As I have told, taxes, direct, indirect. So all these things will be incomes for the government. Now first thing, there should be proper mechanism from the government to make proper assessment and realization. Like so many people will file their returns, but not every return will be taken up for scrutiny. So the government should have proper set of rules and regulations to decide which case should be taken up for scrutiny, to which person notice has to be sent, where to go and conduct the right. So the government should have proper set of rules and regulations for making assessments and realizations. And also they should have strict rules and regulations. See, in India, less than 5% of the individuals pay the taxes. Now, even that 5% are also paying because not because of love towards the country, because there are stringent laws and regulations. So if you expect the citizens of the country to pay their taxes, you should have strict laws and regulations. On the other hand, if you request, if in the Income Tax Act, government is requesting, dear citizen, please pay the taxes. If the government is so soft in the laws and regulation, even that 5% people also will not pay the taxes. So that 5% are also paying because they have fear. They have high income, they have fear, they might get caught. So if the government wants to have proper collection of income, they should make sure that they have strict rules and regulations. Not just strict rules and regulations. Today you need to have internal controls also. Income tax department has also come up with so many internal controls, like TDS mechanism, internal control. And earlier in the olden days, there used to be double refunds. When manual return processing has to happen, there used to be double refunds, forged refunds, etc. used to be there. But now all these things are ruled out. Why? Because today everything is a digital. So in this digital environment also, the government should come up with new internal controls to stop evasion. And just having rules and internal controls alone will not be enough. They should be implemented also. You just write down this rule, this is the rule, this is the internal control. If you write it down, that alone will not be enough. You need to actually implement the same. And finally, periodically, the departments should go through judicial decisions. Case laws they have to go through. In which case laws they have lost. In which case they have lost the money. Is it because of drafting mistake in the section? If yes, try to give an amendment and redraft the section. So like this, periodically judicial decisions like case laws and also has to be reviewed by the department and try to make sure that they have eliminated all the drafting mistakes in the law. So this is what auditor needs to check to ensure whether the government is properly having all the receipts accounted. Then talking about audit of stores and inventories, routine point here. Here we don't do specifically anything new. Whatever we do in other normal audits, the same thing we will do here. Like we will check whether there are proper regulations for purchase of inventory, receipt of inventory, issue of inventory. For everything, some set of rules and regulations should be there. And also, if you find any deficiencies in the quantities of stores, that means if you find any stock has become inferior or damaged, bring it to the notice of the government. Whatever inventory they are buying, check whether it is containing proper approval or not. And whatever prices they have paid for procuring that stock, whether they have paid reasonable prices, acceptable prices they have paid or not. And in case if you find any uneconomical purchases, that means wasteful expenses, if you have found out, bring it to the notice of the management. And also check the accounts, inventory accounts like receipts, issues, balances, check all the inventory accounts. If you find any idle or excess stock, some excess stock is there which is lying there for a long period of time, check whether that excess stock is really existing or just like that government employees are trying to fool you around. And also carefully observe valuation of inventories, check whether the valuation has been done carefully or not, do the physical verification, check the stock as per the records and physical stock both are matching or not, then only check whether valuation has been done clearly. So nothing new or specific here. Whatever we do in other audits, the same thing we do even in the audit of inventories of government also. Now talking about commercial things. Will the government carry out commercial activities also? I'm not talking about politicians. I'm talking about government. Will the government also carry out commercial activities? Commercial activities means what? Carrying out activities for the purpose of profit. So will the government also carry out commercial activities? Yes. And for the purpose of carrying out commercial activities, government might take up three kinds of entities. They might create three structures of entities. So government can carry out commercial activities by incorporating departmental enterprises, or they can create a statutory body, or they can even create government companies. Departmental enterprises, if I have to give example, tourism department, commercial activity, it is making money. Similarly, mines department, it is also making money. So like that, for carrying out commercial activities, they can incorporate separate departments, or they can create statutory body. Statutory body means any entity incorporated under separate statute. LIC, statutory body created under separate law. SBI, statutory body created under separate law. Are these commercial entities? Obviously yes. LIC is the biggest profit making company. Next one, or even the government can create government companies for carrying out commercial activities like Indian Oil Corporation, Bharat Petroleum, all these kinds are examples of government companies. So for carrying out commercial activities, government can create three kinds of entities: departmental enterprises, statutory bodies, and government companies. Now, how to conduct audits? So, when it comes to departmental enterprises, no change here. Like the way you conduct the audit of any other government department, in the same manner you will conduct audit of that particular department which is engaged in the commercial activity. No change at all. So it is to be undertaken in same manner like any other government department. When it comes to statutory body like LIC, we have to do the audit as per the law under which that body has been created. If you are doing audit of LIC, we have to do it as per LIC Act under which LIC is created. If you are doing audit of SBI, it has to be created as per SBI Act under which SBI is created. And how to conduct audit of government company? We have to do it as per the provisions of Companies Act 2013. Clear? Then. So now let us talk about C&AG related matters. As I have told, C&AG is an authority who will involve every time any issue regarding accounts and audit of government comes into picture. Now, who will appoint this C&AG, sir? C&AG is an officer. Who will appoint C&AG? C&AG will be appointed by President of India. And he can be removed only on proven misbehavior, not just allegation. If you are removing the C&AG, that should happen only after proven misbehavior or incapacity. And also, to remove the C&AG, majority of not less than 2/3 of the members of the parliament's voting will be required. He can be removed only if majority of not less than 2/3 members have voted in that favor. And also, he will be given a salary which is equal to the salary of judge of the Supreme Court. That much salary will be even offered to him. Understood? So this is regarding his appointment and all. Now, what are the powers of that C&AG? C&AG will have power to inspect any office of the accounts of union, state government, or any other government department. He can go and verify any account. And also, he can call any government officer to bring the books to his office, and he can ask questions also. He can see here. This point is to require any books, documents. Nothing but this is right of access to books and documents. And not just accessing the books, he can put such questions to any employee, any government officer to fulfill his responsibility. Nothing but, if I have to put it in simple terms, right to inquiry. So number one is inspect any account. Number two, right of access to accounts. Number three, try to get information by doing inquiry. And also, if he feels like some area doesn't require detailed audit, he can dispense with the detailed audit and he can take a decision. I will perform only limited audit in this area. Some government department is there. If he feels that I don't want to do the detailed audit of this department, I will do only limited audit. That decision, that power has also been given to C&AG. So he can dispense with any part of the detailed audit and perform only limited checks in certain departments. So these are the powers of C&AG. Now coming to the duties, there are plenty of duties. Like he has to compile the accounts and submit the accounts. He is required to prepare. He is responsible for preparation of financial statements of the state government and submit it to president of the country. Union government will prepare and submit it to president. State governments will be submitted to governor. Union territory related financial statements will be given to administrator of the union territory. Not just compilation of accounts, he is required to look after audit related matters also. He will look after each and every expenditure happening from Consolidated Fund of India. He will audit and report all the transactions of the union and state government, and even he will audit and report on all trading, manufacturing and balance sheets of governments and government related departments. Not just that, if any authority is substantially financed from government, even that authority's books of accounts also he will verify. He will verify expenses and incomes of government. Not just that, if any entity is substantially financed by government, even that entity's receipts and expenditure also C&AG will verify. Second point says verification of receipts and expenditure of government. Third one is, if any entity is substantially financed by government, even that entity's receipts and expenditure also will be verified by C&AG. Now you will get a doubt, sir, when an entity will be called as substantially financed. So if they are getting a grant of not less than 25 lakh rupees, and also that assistance should be not less than 75% of the total expenditure. If any authority is getting support from government of not less than minimum 25 lakh rupees, and also that grant is covering minimum 75% of the total expenditure, then that entity we call it as substantially financed, and that entity's receipts and expenditure are required to be verified. and for what purposes the government is giving grants and loans, under what conditions they are giving it, that also will be verified by C&AG. He will verify receipts, like we have seen in the previous concept. He will verify the receipts of the government. He will even verify audit of stores and inventories. For that also we have seen separate concept. And even he will look after audit of government companies and statutory corporations also. Clear? So, and one more last question, what role will be played by C&AG in the audit of government companies? Whenever audit of government companies are happening, what role C&AG will play in that audit of government companies? One role we already know, the C&AG is going to make appointment of first auditor and subsequent auditor of a government company. He will not just appoint the auditor, even he will direct the manner in which audit of the government company has to be conducted. And once that statutory audit is completed, the statutory auditor will submit a copy of his audit report to the C&AG. C&AG will appoint statutory auditor of government company, and after completion of audit, the statutory auditor will submit the audit report to C&AG. Now, after receiving the audit report, C&AG will have two more powers. C&AG can even order for supplementary audit of a government company, or C&AG can even order for test audit also. When I say supplementary audit is not altogether separate audit. It is just an extension of the statutory audit. That means if the statutory auditor has completed his statutory audit, in that if some observations are there, C&AG can order for extra extension of that statutory audit, that C&AG can do. So C&AG, after receiving audit report, within 60 days from the date of receipt of statutory auditor's report, they can conduct something called supplementary audit, extension of the statutory audit. And from that supplementary auditor, the C&AG can ask any additional information from that supplementary auditor. And once the supplementary audit has been completed, for that supplementary audit also report will be there. That report will be given to C&AG. C&AG will give its comment on that report. Now that supplementary audit report along with the C&AG comments shall be sent to the company, and company will send every copy of that supplementary audit report to each and every member who is entitled to receive the copies of the financial statements. Understood? So once statutory audit will be over, after that, if the C&AG wants, they can order for supplementary audit. Within how many days they have to order? If they want to order, they have to order it within 60 days. Sometimes C&AG will get a doubt whether the statutory auditor did the work properly or not. Then they can order for test audit. Test audit means checking whether statutory auditor did the work properly or not. Supplementary audit means it is an extension of the statutory auditor. So C&AG has also been given the power to order for test audit. They can even order for test audit also. And how to do the test audit? Those rules are there in section 19A of the C&AG Act. As per that section, test audit has to be conducted, but test audit should be conducted only by C&AG. Whereas supplementary audit can be conducted either by C&AG, or C&AG can appoint another person to do the supplementary audit also. But test audit should always be conducted by whom? C&AG himself. Whereas supplementary audit can be done by C&AG himself, or he can authorize any other person also to do it. Clear? So these are the powers of C&AG. That's why we say in the case of government company, two levels of audit will happen. One is statutory audit conducted by chartered accountant in practice. Other one is by C&AG, either in the form of supplementary audit or test audit. So that's why we say there will be two levels of audit happening in the case of government companies. So this is what a brief about audit of government entities. Understood, everybody? So now we are left with two more chapters pending for revision, which are going to be number one, audit of items of financial statements, and the other one is audit of various entities. So these are the only two chapters which are pending to be revised, and now we will try to do one thorough revision of these two chapters. But before that, let me give you a caution once. See, these two chapters are of such a nature that these are very practical in nature, very much practical. Exclusively practicality will be there in these two chapters. And if you see it on the face, you will not be able to find any concept related questions. Like the way we have covered concepts in all the earlier chapters. In every chapter, there is some sort of concept is there. But these two chapters are such a chapters that which does not have any conceptual discussion. These are all somewhat very practical oriented questions. So that's why we will not be able to do line by line revision of these two chapters. So what I will try to do is I will try to cover the key questions or key concepts from these particular chapters. So don't expect me to revise each and every line. Why? Because if we do that, that is going to be complete explanation of the chapter once again. So that is not worthy. So what we will do from these two chapters also, I will try to give a entire overview of the chapters. Some key questions we will cover in overall basis. We will try to understand it. Clear everybody? So we will first just begin with audit of various entities. Audit of items of financial statements. This we will come back later. First, we will try to revise the key concepts from this particular chapter, audit of various entities. See, as the name itself says, and even the previous two concepts which we have revised. What are the last two concepts which we have revised? One is cooperative societies audit and the other one is government audit. These are the last two chapters which we have revised now. And practically speaking, even these two chapters are also part of audit of various entities only. Even the chapter, even if you have a look at the study material, you will be able to find cooperative societies audit and government audit both in this chapter, audit of various entities only. But for the sake of easy understanding and for the sake of easy flexibility in preparation, so we have divided this content of cooperative societies audit and government audit into two different chapters, and I have given that. But concept, if you have a look at the study material, everything will form part of single chapter. So as the name itself says, this particular chapter, audit of various entities, is going to talk about if we are conducting audit of different kinds of entities, what are the things which we will try to keep in mind. So even after your qualification, when you do audit assignments, you will do different kinds of audits. That could be on the basis of legal form, different kinds of legal forms you will do the audit, or the businesses which are engaged in the clients which are engaged in different businesses also will do the audit. So talking about legal form, we might be appointed as auditor of a sole proprietor. We might be appointed as auditor of a partnership firm. We might be appointed as auditor of LLP. Sometimes we get appointed as auditor of trust. We get appointed as auditor of company. So like that, different kinds of legal forms we might get appointed as an auditor. And when we look from the business perspective, we conduct audit of different kinds of businesses. Like we might conduct audit of educational institutions, we might conduct audit of hospitals, we might conduct audit of hotels, we might conduct audit of clubs, we might be doing audit of cinema halls. So like that, even if you take the legal form or you take businesses, we will be conducting various kinds of entities audit assignment. So now this particular chapter is about whenever you are doing these different kinds of audits, what key things you will try to keep in mind, or what special points we will try to verify in each of this kind of audit assignments. So as I've already mentioned earlier, I'm going to give you a quick overview of the entire chapter, not a line by line revision I'm going to do here. So first we will focus on legal form. Legal form, on the basis of legal form, what things we will try to keep in mind. So starting with sole proprietors audit. So as we know, generally the sole proprietors audit is a non-statutory audit. Unless it is a tax audit required as per Income Tax Act or it is required as per GST Act. If these requirements are not there, basically sole proprietors audit is a non-statutory audit. Since it is a case of non-statutory audit, what is the most important thing here is having an engagement letter. Why? Because in the case of non-statutory audit, there are more chances for misunderstanding. So that's why it is very much advisable for both client and the auditor to be clear about the terms and conditions. So that's why in the case of sole proprietors audit, most important term is engagement letter. You have to get in writing what and all your responsibilities, what and all your duties to avoid conflicts in the future. Now, sir, even though there is no audit requirement, why sole proprietors will get their accounts audited? There could be numerous reasons. Might be they are going for a bank loan. That's why they might ask you for conducting the audit of their financial statements. Or they need some government license for conducting some business. That's why they might approach you and ask you for conducting the audit. And they might require to settle some insurance claims, etc. That might be the reason why they might come and get their accounts audited. So like this, they could have their own set of reasons why the sole traders will come and get their accounts audited. If they come and getting their accounts audited, you have to be specific about engagement letter. Get clear understanding of what you are supposed to do, and whatever sole proprietor expects you to do in the audit, that becomes your scope. There is no governing law here. Whatever sole trader says, that you have to come in that you have to do in the audit and come back. That's it. So this is what regarding sole proprietors audit. Now talking about partnership firms audit. See, even partnership firms audit also, unless there is a requirement as per law or regulation like Income Tax Act or GST Act, partnership firms audit is also a non-statutory audit. Since it is a non-statutory audit, here also the most important thing is engagement letter. And here specifically what I need to do is, if I'm conducting audit of partnership firm, first you need to get the copy of partnership deed, give one basic reading of the partnership deed, and find out various terms and conditions of this partnership firm, like how many number of partners are there, what is their capital contribution ratio, what is their profit sharing ratio, is any partner entitled for remuneration, is any partner entitled for interest on capital. So like that, try to get a copy of the partnership deed and understand all the terms and conditions related with the audit, and even try to find out, is the partnership firm is for any fixed duration, what kind of business they are supposed to do. So all these things I will check. Then I will verify, then I will check whether partnership firm is maintaining books of accounts as required by respective laws and regulations. And also I should verify the active partners should be carrying out business in such a manner that none of the partners' interest is getting affected. As we know, when I say partnership firm, there will be some active partners, there will be some dormant or inactive or sleeping partners also, you can say. So since I say dormant partners, inactive partners, they will not actively participate in the business. That can be taken as advantage by these active partners. So they will try to show the wrong position in the financial statements and try to pay less amount of share to this sleeping partner. So as an auditor, I need to check that partnership firm business is getting carried out without any effect of interest of any of the partners. And when we specifically see what are the advantages of conducting audit of partnership firm, all those advantages which are there for sole trader, they will be there even for advantages of partnership firm. But in addition to that, the main advantage of audit of partnership firm is it will ensure that it is settlement of accounts. It will make the settlement of accounts between the partner very smooth. Like when a new partner is getting admitted, how much capital he has to bring in for introduction into the audit firm. If any partner is retiring from the firm, how much amount should be paid to his share. If the partner has expired, how much amount has to be paid to the legal representatives. So especially in the case of partnership firm, in the settlement of accounts of the partner, the audited financial statements will be very, very helpful. Clear? So this is what regarding audit of a partnership firm. Now talking about another legal form, audit of LLP. So when it comes to audit of LLP, most of the points whatever we have seen for partnership, the same points will become applicable here. Why? Because the only difference between normal partnership firm and LLP is, in case of normal partnership firm, the joint liability will be there. That means unlimited liability will be there. But in the case of partnership firm, limited liability will be there. Apart from that, all the points will remain same. Here also I will check the partnership deed, and here also I will go through various documents, terms and conditions. All these things will remain common. And one more point of difference here, partnership firms are governed by registrar of firms. Whereas when it comes to LLP, here the governing authority will be registrar of companies. For LLPs, who is a regulatory authority? Registrar of companies is going to be the regulating authority. Registrar of companies, which is going to regulate the companies, the same ROC is even going to have control over LLP also. And when it comes to audit related matters will remain the same. But a few extra points will be there which we need to understand. So let me take you through that. Yeah. This one. Sir, is audit of each and every LLP mandatory? Actually, no. Why? Because under LLP Act, some kinds of LLPs are exempted. If an LLP fulfills some conditions, they will be exempted from audit. Let us try to understand what is that condition. So if I read this provision, the accounts of every LLP shall be audited. First, they have passed a general statement that every LLP should undergo audit. But however, subsequently they came up with the exemption. What is that exemption is? Provided that any LLP whose turnover does not exceed in any financial year 40 lakh rupees, or whose contribution in the sense capital contribution, whose capital contribution does not exceed 25 lakh rupees is not required to get its accounts audited. So if an LLP fulfills any one of these two conditions, see here carefully, they are saying or. Both the conditions are not required to be satisfied. If an LLP satisfies even one of the condition also, they become exempted. What are that two conditions? If the turnover does not exceeding 40 lakh rupees, that means if the turnover is less than or equal to 40 lakh rupees, or if the capital contribution is less than or equal to 25 lakh rupees, even if one of the condition is satisfied, then the audit of LLP will be exempted. This one condition we have to keep in mind, important for MCQs, so true or false statements. And one more thing here, as I have told, the regulating authority in case of LLPs will be ROC. Every LLP is required to file some mandatory documents with ROC. Every LLP is required to file two mandatory documents with the ROC. Let us try to have a look what are those documents which are required to be filed with ROC and what are the time limits for filing it. So if we have a look here, every LLP would be required to file an annual return in form number 11 with ROC within 60 days of closure of the financial year. Within 60 days from the closure of the financial year, that is within 60 days from 31st of March, every LLP should file one form number 11. In that form 11, what details will be there? Annual return details will be there. So every LLP should file this annual return in form number 11 within 60 days from the closure of financial year. In addition to that, every LLP is also required to submit another document called Statement of Account and Solvency in form number 8, which shall be filed within a period of 30 days from the end of 6 months from the financial year. So what they are saying, another form number 8. And what is the time limit for that? 30 days from the end of 6 months of the financial year. That means if you take the financial year 21-22, the balance sheet date will be 31st of March 2022. From this within 6 months, that is 30th of September 2022. From this within 30 days. Understood? So form 8 should be filed within 30 days from the end of 6 months of the financial year. You are required to submit this form 8. So every LLP should submit two documents, form number 11 and form number 8 with the ROC. Clear? So this is what specifically key points regarding that LLP. Now coming to trust and NGO. Trust NGO. See, they might give two different questions, but concept wise they are very similar. So if you are conducting audit of a trust or if you are conducting audit of NGO, first we need to understand what is their legal form, how that trust or NGO is created. Generally, the legal forms which they will take up is either they will take up the form of trust as per Indian Trust Act, or either they might be created as a Section 8 company, or even they could be created as a society under Societies Registration Act. Generally, they will take up these three kinds of form. So first it becomes necessary, in case if we are conducting audit of a trust or NGO, first we should know what is the legal form. Why? Because depending on the legal form, we will come to know which laws and regulations the client has to comply with. So first step should be the auditor should understand what is the legal form and try to get an understanding of with what objective the trust was created. What is their vision statement? What is their mission statement? That we need to understand. Second one, we need to understand who are the top level management in the organization. What are their functions? So we need to understand or get the details regarding management. So as I have told, mission and vision statement also we will verify. Apart from that, even we will try to go through their minutes of the meeting. Whatever minutes of the meetings are available, go through all the minutes of the meetings. Now, when it comes to business related matters, first talking about revenues or incomes. Will the trust or NGOs have incomes? Yes. The main income will be donation income. The main income will be what? Donation income. Now, how to verify donation income, sir? Now, even in the donation also two things will be there. General donations will be there and specific donations will be there. When it comes to general donation, it will go to income and receipts and payments or income and expenditure account. When it comes to specific donation, they need to go to capital reserve. Sir, how can I find out, sir, whether the donation is a general donation or specific donation? Donor's letter will be there. What will be there? Donor's letter will be there. Go through that donor's letter. From that you will find out, is the donation given for specific purpose or is the donation given for general purpose. If the donation is given for general purpose, the trust can use it for any of the purposes. But if the donation given is specific donation, the trust should use that donation amount only for the purpose for which it has been given. So this is what will be the major income, donation income. Apart from that, there will be some regular members will be there. From them membership fees will be received. What will be received? Membership fees will be received. Now, how to verify the membership fees? So simple, you will have something called register of members. Get that register of members. For each person, membership fees will be decided. Like for example, if 100 members are there, per year 10,000 rupees is the membership fees. If you multiply it, you will get the value of 10 lakh rupees. So now when you go through that income books of accounts, the total membership fees should have been received as 10 lakh rupees. Nothing but you are cross verifying, recomputation you are doing. So whether membership fees has been completely accounted for or not, like this you can know it. Get the register of members, multiply with per person what is the registry membership fees, you will get the resulting figure. That much amount of income should have been recognized. If you find any arrears, try to understand what is the reason for that arrear. And as a part of that analysis, if you found out that if that amount is irrecoverable, that needs to be written off. Sometimes membership fees will be received well in advance. If it is the case, you have to apportion it over that duration. Don't recognize all at once. And even in the membership fees also, two things will be there. One is entrance fees, other one will be regular membership fees. When it comes to entrance fees, that should be a capital receipt. When it comes to regular membership fees, that will go to our revenue income. Nothing but it will go to income and expenditure. So this is what the donation income, membership income, entrance fees. Apart from that, especially in the case of NGOs, they will have subscription income also. Subscription income means they will publish some magazines, and that magazines will be subscribed by so many people. And that subscription to the magazines will not be free of cost. From that, they will even make subscription income also. Now, how to verify that subscription income? So, two things they will say. One is you once again get registrar of subscribers. In that register of subscribers, you will get to know how many subscribers are there. Per person, what is the subscription fees, find out. Multiply it, you will get how much amount of subscription income should have been received. Reconcile whether the same amount has been recorded in the books also or not. And one more way for checking the subscription income is, you can check how many copies of magazines are published and distributed. If 100 copies of magazines are published and distributed, that means there should have been 100 subscribers. You should have received money from 100 subscribers. So like that, even I can cross verify with number of copies of magazines which are published and distributed. So this is what regarding subscription income. Apart from that, sometimes government also will give grants and assistance. Try to verify that government grants and assistance. Sometimes government will give grant subject to conditions. Check whether the trust or NGO is able to comply with that conditions, so that they need not repay back that grant. That you try to understand. Along with that, sometimes legacies also will be given. Legacies means nothing but wills will be written by the rich people in the name of trust or NGO. In case if any legacies are there, go through that registration documents, etc. And what else will be there? Apart from that, yeah, these are the major incomes. And one more thing, when it comes to trust, sometimes they might have even rental income also. Try to verify that rental income. Sometimes there will be hostels which are run by the trust. They will charge nominal amount of rent from the students, etc. So if such kind of miscellaneous incomes are there, try to even verify that miscellaneous income. And one more thing, sometimes trust will conduct special events for some specific purpose. Like so and so trust will conduct a music concert, and out of that, whatever money has been received, that will be used exclusively for tsunami victims, flood victims, etc. So like that, if the trust is creating any special event or program for the purpose of some relief measures, check that whether income from that special event has been properly recorded. There should not be any hiding of income from that special event. So check whether income from that special event has been properly recognized or not. So these are all the various incomes. Now talking about expenses, the expenses will be whatever incomes which this trust or NGO is receiving, all that income should be used only for non-profit purposes. As I have told, every trust will have some mission or vision statement. Whatever money they are receiving, that should be used exclusively only for achieving their objectives. Clear? So none of the management or none of the employees should have benefited out of it. Apart from that, for running that trust or NGO, you will incur regular expenses, like operating expenses will be there. If you take rental expenses will be there, try to verify with the rental agreement. Salaries will be there, try to verify with the salary agreements with the staff. If there is any plant and machinery, on that depreciation charges will be there, like buildings if etc. These kind of things are there. On that depreciation will be there, try to verify that depreciation income. And if at all they are having any inventory or stock, try to do physical verification of that inventory as on the balance sheet date. So these are some points which you need to keep in mind while conducting audit of trust or NGOs. Now coming to the next question, now we will talk about hospitals. If you are conducting audit of hospitals, what you need to verify? First of all, hospitals will have two kinds of income. One is consultancy charges, OP charges also we say. Other one is admission charges. If any patient is admitted, from them room rental charges, operation charges, all will be there. So first, when it comes to consultancy charges, how it can be verified. If you observe, every hospital will maintain register. If you go to hi-fi hospital, they will have all that record in the computer. If you go to normal small clinic, they will maintain one manual register. So get that register. From that, you will come to know per day how many patients have come, per person what is the fees. So if you multiply number of patients into fees, that much amount of income should have been recorded in the books of accounts. So try to understand that consultancy income has been properly recorded or not by getting the registers, etc. And also try to understand what policy is followed by the hospital when it comes to consultancy. Like some hospitals will have a policy that once you pay consultancy fees, for the coming 20 days, if you come for checkup once again, no need to pay consultancy fees once again. Some hospitals will have a policy that one consultancy fees will be suitable only for 10 days. So like this, try to understand what policy will be followed by your client hospital. Now, when it comes to patient admission charges, there will be register of patients along with the date of admission, date of discharge, everything will be there. So you try to understand how many days a patient was admitted in the hospital and what kind of service he has availed, what kind of treatment he has availed. Why? Because if he is treated in the ICU, separate charge. If it is in a general ward, separate charge. If he is in a normal ward, separate charge. So like that, try to understand how many days a patient has stayed in the hospital, what kind of services he has received, what medicines were used on him. So all that things were added in the bill or not, that as an auditor, I need to check it. So these are the two major kinds of income. One is consultancy fees, other one is admission charges and operation charges. Apart from that, few other incomes if we talk about medicines. Now, when it comes to medical stores in the hospital, there will be two ways of running the medical stores. Number one is medical store run by the hospital management themselves. Other one is outsourcing. If the medical stores are run by the hospital themselves, we need to verify purchases and sales which are made by that hospital. In case if it is outsourced, I need to check whether that proportionate share of income has been received from that person to whom the medical store has been outsourced. Generally the agreements will be either a fixed sum of money or a percentage on the profits. Try to understand whether that income has been received or not. You need to check. Same with pathology also. You need to check even that pathology labs also are getting run by the hospital itself or they are getting outsourced. This also you need to check it once. Now apart from that, if trust based hospital is there, that trust based hospital will even receive donations also, and we have already covered in the previous question how to verify donations. Apart from that, this trust based hospitals will even get government grants also. Try to verify that government grants by verifying the government sanction letter for the grant, checking the entries in the bank statement. So by verifying all that, you try to find out whether government grants have been shown at the proper amounts or not. And if the hospital is a trust based hospital, they will be exempted from income tax refunds. See, this income tax refunds point is applicable even for trust also. So generally hospitals, not the today's corporate hospitals guys, if any trust based hospitals are there, they will be exempted from income tax. So in case if your client hospital is exempted from income tax, but by mistake if someone has already deducted TDS on that hospital, so we need to check that this hospital has filed the income tax return and claimed the refund of TDS deducted on their name. Understood? And apart from that, now if we come to the expenses, the regular expenses will be like staff salaries will be there. We know how to verify it by checking the employee agreements. Rental expenses will be there. Try to verify with that rental agreements. And they will buy various kinds of inventory. What will form part of inventory of hospital? Inventory will form part of inventory will include medicines. It will include operation theater apparatus will include this scissors etc. That will get included. Linen, cotton, these kind of things all will get included in the inventory. Check whether there is proper mechanism for buying all this inventory, and whatever inventory that is lying there as on the balance sheet date, try to do the physical verification of that. Apart from that, fixed assets also will be there. Today the doctor's machinery come with a high cost, so that fixed assets have been properly depreciated or not, I need to check it, and even try to do physical verification of that fixed assets. Understood? So these are the various points which we need to keep in mind while conducting audit of hospitals. Now let us talk about educational institutions. What if I am doing audit of educational institutions like school, college, etc. Now if we talk about various kinds of incomes which educational institution will have, number one, admission fees will be there. Now how to verify admission fees? So that you have to cross verify with admission slips which are signed by the head of the institute. You should get how many admission slips were signed by the head of the institute, and per admission the admission fees will be fixed. So total number of applications per application, what is the admission fees? If you multiply, you will get that resulting figure. That much amount of admission fees should have been received. Now, what is the accounting treatment of the admission fees? Here they have told that if the management has taken a decision, they will treat it as a revenue income, then they can treat it. If no decision has been taken by the management, then generally admission fees will be shown as a capital receipt. Which means, if I have to put it in simple terms, the accounting treatment of admission fees is something which has to be decided by the management of that educational institution. If they decided that they will treat it as revenue, they can treat it as a revenue income, take it to statement of P&L. If no such decision has been taken, then admission fees should be shown as a capital receipt. It should go to corpus. And apart from that, what else will be there? Class fees, admission fees, other one is tuition fees will be there. Now, how to verify tuition fees? So what they will ask you to do is get the class registers. From that, you will find out how many number of students will be there, multiply with per person what is the tuition fees, and verify whether that much amount has been recognized in the books of accounts or not. If any tuition fees is not yet recovered, check whether there is a proper accrual entries have been written or not. If any tuition fees becomes irrecoverable, check whether it has been written off or not. Sometimes some students will pay tuition fees of 2-3 terms well in advance. That should not be recognized all at once. That should be apportioned over the period of time. For whatever duration that tuition fees has been paid, over that duration we need to apportion it. And a few more things. If any student has been given some concession or free studentship, check whether that concession or free studentship has been given only after getting approval from head of the institute. And hostel fees will be there. We need to make sure that every student is paying the hostel fees before they leave the hostel. Apart from that, travel charges will be there, travel fees like bus fees, etc. That you try to verify with number of students who are availing that services. Understood? Apart from that, what other incomes will be there? Once again, here if the school is a trust based school, they also will have grants given by the government, that we need to verify with the grant sanction letter, that we need to verify with the entries in the bank statement. And even sometimes legacies will be there. Some people leave behind legacies in the name of educational institution. Try to verify that legacies also with the help of that will copies, etc. And if the educational institution is a trust based educational institution, they will be exempted from income tax. But if at all any TDS has been deducted in their name, check whether educational institution filed the income tax return and claim the refund of that TDS whatever has been deducted in their name. Understood? And if they have any excess funds, if they have invested somewhere else, check whether on that investment income has been received or not, like dividend income, interest income. And one more thing, guys, this investment income will be there even for hospitals also. This investment income will be there for trust also. This investment income will be there for NGOs also. So write the same investment income point for all the institutions which we have covered. Not just for educational institution, for hospitals also investment income could be there, for trust also investment income could be there, for NGOs also interest income could be there. So try to verify try to write this point of investment income for all these institutions. Now talking about expenses also here once again it will remain the same. So try to verify that rental expenses, staff salaries, etc. And here inventory will be in the form of books, uniforms, food items. So all this will be there in the form of inventory. Try to verify whether there is a proper mechanism for buying and storing this inventory, and try to do physical verification of the stock as on balance sheet date. Apart from that, check whatever fixed assets which the school is having, school or education institution is having, whether depreciation has been charged on all that assets, and if possible try to do physical verification of even that fixed assets also. So these are the points which are needed to be kept in mind while conducting audit of a educational institution. We will talk about few more questions. How to conduct audit of a club. So clubs are generally incorporated. Their legal form will be company limited by guarantee. How they will be incorporated? Generally they will be incorporated as companies limited by guarantee. So all the provisions of the Companies Act will become applicable. Now what will be the incomes of the club? So club will have incomes like membership fees will be there. We have already seen how to verify membership fees, like register of members, you have to get it. Along with that, entrance fees will be there. This also I have told how to verify the entrance fees. You can verify with number of applications received for applying for membership of the club. Along with that, even you can check the minutes of the minutes of the management to check how many approvals were given for new members. So you verify membership fees and entrance fees. Apart from that, apart from membership fees and entrance fees, what some clubs will do is they will charge extra for the customers, for their members, for extra services provided. Like inside the club there will be a restaurant, so membership fees will give you access only inside the club, but whatever food you consume in the restaurant, that restaurant income will be separately billed. Similarly, inside the club, if you are going and enjoying some recreational activities, like for example, you go there and enjoy the billiards table, you go and enjoy there some poker table, or you go and enjoy some indoor games there, for that separate charges will be collected. So in case if your client club is having such a policy, membership fees will just allow the person to enter inside the club, but after entering the club, whatever services that are getting used, for all that extra charge will be there. If such is the policy of your client, now from all these extra services, extra income also will be there. So check whether this income has also been accounted for or not. And one more thing, whatever food that is provided by the club, they should be billed by the custom. They should be billed to that member, not on cost to cost basis. Cost plus some margin should be added, then only they should be billed to that member. So this is one important point. And when it comes to expenses, once again, what will be the expenses? Staff salaries, rental expenses. Along with that, they buy the sports item very frequently. So that sports item also will be their expenses. And all the sports item, food items, everything will even form part of inventory. Try to do physical verification of the stock as on the balance sheet date. And whatever fixed assets are there, check whether depreciation has been properly calculated and do the physical verification of even that fixed assets also. So this is how we need to conduct. These are the main or key points regarding audit of a club. Now talking about cinema hall, how to conduct audit of a cinema hall. So now if we talk about incomes here, the main income will be sale of tickets. So how can you verify the sale of tickets? So very simple. Today the theaters are having a software for booking. So after the completion of each show, the software will generate a report. In that report, it will be clearly mentioned how many tickets are sold, which class tickets are sold, what income should have been received. So from that report, which is generated from the billing, from the booking software, we need to cross verify whether the same amount has been even recorded in the books of accounts or not. And we need to check proper internal controls are there in the theater. Like a entry inside the theater should be allowed only by showing the printed copy of the ticket, or at least today nowadays even you can show that message also. So whatever it is, proper mechanism should be there to allow the person only to enter inside the theater after showing some valid entry ticket. So that kind of internal controls should be kept. And whatever income that is getting generated from the sale of tickets, that should be deposited in the bank at regular intervals. If possible on the same day, if not possible either on the next day, the income from sale of tickets should be deposited with the banks at regular intervals. And apart from that, even you need to have, if there are any free passes given, if any free passes for the theater are given, we need to make sure that that free passes are given after getting approval from the concerned theater management. Only after getting approval, this free passes etc. should be given. Now talking about other incomes, one more major income will be advertisement income. So they before you go and watch the movie, there will be advertisements played. On that also advertisement income they will make. We need to check that advertisement income with the advertisement agreements entered with that vendor. So according to that agreement which the theater has entered with that concerned person, whether that advertisement income has been recognized or not, we need to check it. Then we will have canteen income. When it comes to canteen income, here also two modes of operation. One is outsourcing, other one is run by the theater itself. If the canteen is getting run by the theater management themselves, we need to verify all the purchases and sales made by that theater. If it is getting outsourced, then we need to check whether the share of income has been properly received or not. And one more thing, when it comes to sale of tickets, we can even cross verify with taxes collected, GST, entertainment tax. If these kind of taxes are there, from that also we can do the reverse calculation and find out whether sale of tickets income has been properly accounted for or not. Like if 2% is the GST and GST amount is 20,000, you can, from this you can do the reverse calculation and find out how much amount should have been received from the sale of tickets. So like this you can cross verify even with GST income. And whatever booking software which the theaters are using, they should use such a software that the tickets which are sold in online, they should not be sold once again at the theater, they should be blocked in the software. So such a kind of robust booking software they have to make use of it. So these are all various incomes. Now talking about expenses, the major expenses will be movie hire charges. With the distributors, you have to take the movie on rent. So that movie hire charges we need to verify with the agreement. Apart from that, electricity charges will be their next biggest charges. Try to verify electricity expenses. Staff salaries, that you need to verify whether staff salaries are properly paid or not. And one more thing is depreciation. See, the thing here is, in the depreciation, we use this furniture and projectors, etc. And the rate at which we are charging depreciation, that rate will be generally higher than the rate which we charge for other businesses. Like a projector will be there in the office, a projector will be there in the movie theater also. But for same asset, we don't charge equal amount of depreciation. In the case of theater, we charge the depreciation at the higher rate. Why? Because wear and tear will be much higher. So check that on the assets of the theater, where depreciation is charged at a higher rate than when compared with the other businesses. So these will be the major expenses which we need to verify. So this is how we need to conduct audit of cinema halls. We will try to end our revision of this chapter with one more last question: how to conduct audit of hotels, boarding and lodging hotels. Number one, room collections will be there, room sale collections. So we need to verify whether the amount collected from renting out the rooms has been properly accounted or not. How you can cross verify, sir? You can cross verify with the guest register. So there will be a guest register. With that guest register, you need to cross verify how many, whether all this income from letting out the rooms has been properly recorded or not. And pilferage is the main problem in the case of hotel. Pilferage means petty theft. Small thefts could happen in the hotel. That is the major problem. So that's why there should be proper internal control system. Like whatever inventory they are having. Generally, what will form part of inventory of hotels? So hotels will have inventories like this, toilet essentials like soaps, etc. They will have some food items also. If they are having their own restaurant, they will have their food items also as a part of inventory. Apart from that, this linen will be there. Towels, curtains, these kind of things will be there. So all this will form part of inventory. All this inventory should be kept in safe custody. They should not be given out to anybody. They should be kept in safe custody. Key should be retained by the manager. And there should be some controls, like if a person before letting out the person, before letting the room to the person, nowadays if you observe hotels, advance billing they will do. That means you have to pay money well in advance, not at the time when you are leaving. Why? Because sometimes what could happen is a guest will come and stay in the hotel and without any notice he will leave. So it will be a loss for the company. So that's why today hotels have come up with internal controls that before they let out the room well in advance, they will collect that room rental charges well in advance. So these kind of internal controls should be there. See, apart from the room selling income, that means letting out of the rooms, they will even have other incomes like banquet hall incomes. They will have banquet halls. They will be let out for functions, seminars, or auditoriums, etc. So from that income also will be there. Try to verify that income from banquet halls also. And apart from that, what other incomes will be there? So apart from that, when we talk about other incomes, so I don't find any specific restaurant. If the hotel is running their own restaurant, from that they will even have sale of food income also. Try to verify that restaurant income also. And when it comes to expenses, major things which we need to verify here is painting, decoration, repairs and maintenance. These will be very frequent expenses in the case of hotel. We should try to make sure that none of these painting, repairs and maintenance expenses have been capitalized. Why? Because they are very common in the case of hotel. So these will be the main expenses: painting, decoration charges, etc. Electricity expenses also will be there. And apart from that, there will be agreement with the travel agents. So travel agents will get you some booking, but today there are no physical travel agents. We have this online aggregator platforms like Make My Trip, Oyo, all these kinds of things are there. So with them, we will have revenue sharing agreement. Try to check that travel agency agreement and verify whether their commission has been paid properly or not. And talking about other expenses, talking about inventory specifically, as I've already told you, all these things will be there in inventory. Check whether try to attend the physical verification whenever the management is doing it. So these are the points which we need to keep in mind while conducting audit of hotels. So with this, we have covered all the key questions, all the key concepts regarding how to conduct audit of various entities. Clear, everybody? So we can't go any deeper. Why? Because this much is only this much itself is, if you observe carefully, there is no concept here, but still I tried to give overview of the entire chapter. Hope this revision would have helped you. So now we are left with only one more chapter's revision. What is that one more chapter's revision? Audit of items of financial statements. So in this chapter also, I will touch all the key concepts, not even all the key concepts. I will give you one overall view of this chapter, how you need to prepare. That instructions I will give you. With that, we will come to an end. Okay. Now let us talk about how to conduct audit of items of the financial statements. See, in the chapter which we have completed, audit of various entities, we have seen, depending on nature of the entity, what specific things we will try to keep in mind. Now this particular chapter, depending on item of financial statement, what audit procedures you will perform, how you will verify. Like, this chapter will contain some questions like, if you are conducting audit of some entity, how you will verify sales, how you will verify purchases, how you will verify other income, how you will verify employee benefit expenses, how you are going to verify all other expenses, and similarly, how the auditor is going to verify fixed assets, how the auditor will verify intangible assets, how the auditor is going to verify provisions, how the auditor is going to verify contingent liabilities, how do you verify borrowings, trade receivables, trade payables, cash and cash equivalents. So like this, there will be hell a lot of questions which will be talking about how do you conduct audit of specific items of the financial statements. And as I have already mentioned earlier, this particular chapter is also such a chapter which requires a lot of your common sense here. And one more thing, I would always suggest the students to read the last two chapters, audit of items of financial statements and audit of various entities. Both these chapters should be prepared for at the end, almost close to the examination. And if I have to be very frank, what I will say is these two should be the last two chapters which you should be preparing. These two chapters should be the last two chapters which you should be preparing. And one more thing, when I say you have to prepare for these two chapters, audit of items of financial statements and audit of various entities, I am not expecting any student to mug up the content here. Never ever mug up the content of this last two chapters. Just to give one novel reading once, try to interpret the things, try to conceptualize or visualize the things, and even when you sit in the exam also, assume yourself being an auditor, step into the shoes of an auditor. If I am doing example, in the exam they have asked a question, how do you verify fixed assets? So now you have to step into the shoes of the auditor and you have to think, if I am an auditor really, what things I will try to verify regarding clients' fixed assets. So a lot of visualization will be required here, guys. Don't waste your time and energy on mugging up the content of this last two chapters. So very, very important suggestion from my side. Never ever mug up. At the same time, don't even leave the chapters completely. See, if you leave the chapters completely, what will happen is in the examination, common sense is the first thing which will stop working. See, now if I ask you, how do you verify purchases? You can easily say me 10 points. But if I ask you when you are writing the examination, you might not recollect the points. Why? Because you will be under extreme pressure of the exam. So that's why you should not be exclusively leaving these two chapters altogether. At the same time, you should not be spending hours and hours of time in mugging up the content. Both are two extremes which are actually bad. So what approach you should follow is try to read the points once and try to visualize the things, try to imagine the things. If you have read one point, try to imagine that. Try to read this chapter close to the examination. And as I have told, these two must be the chapters which you are preparing at the last. You have to end your preparation with these two chapters. And one more suggestion from my side, when you go for the examination, assume afternoon 2 o'clock exam will start. So you will prepare till 12 o'clock or 11 o'clock. You should be closing your revision before the exam with these two chapters once again. You should be closing your revision also by looking at these two chapters. Just take some half an hour of time for each chapter. Just give a quick glance of all the questions, then go for the exam. Clear? Why I am saying this is the last two chapters very important. Why? Because they carry a very good weightage in the examination. 14 marks or sometimes 12 to 14 marks they might carry in the examination. So that's why don't leave it. At the same time, don't waste your time unnecessarily on mugging up the contents of this chapter, but instead, please give a novel reading. Try to visualize the things. Try to visualize your things. Use the common sense in the examination and try to write some relevant points. Clear? So if I read for example sake a few questions, like some 3-4 questions, I will try to revise quickly. So first thing, how do you verify sales? And obviously, since it is a P&L item, there will be various assertions like occurrence assertion you have to verify, completeness assertion you have to verify, measurement assertion you have to verify, cutoff assertion we have to verify. So in case if you are conducting audit of a sales of the entity, first thing we need to understand about the client's sales process. What do you mean by understanding about the client's sale process? What you will specifically try to understand? I will try to understand what products the company is selling. What is the major revenue generating product? During the current year, any new products were introduced. During the current year, any existing products were discontinued. And what are the general terms and conditions of the sales, like credit sale, cash sale? If credit sale, what is the average credit period? Is there any discount policy like trade discount, cash discount? So try to first understand about the sales in a brief manner. Once we are done with understanding of all the sales, now we will perform in-depth audit procedures. So let us have a look at now the detailed audit procedures, what I will perform after I get an understanding of the sales. So all these things I will try to understand like I have stated here. Once I understand the things, now I will start performing detailed audit procedures. So what could be examples of detailed audit procedure? Like if you see it here, I should check that a sale invoice should be recorded only once. There should be proper internal controls to make sure that an invoice is not getting recorded more than once. And also I should check all the sales invoices should be in a sequence. They should all follow one particular order. None of the things should be missed out. In between, no invoice number should be missing. And check few invoices with the sales journal. Take a sample of sale invoices and check whether those invoices are visible in the sales ledger. And even try to get confirmation from few customers. Try to check whether there are any fictitious sales or fictitious customers, like fake entries are there. And even find out whether any shipments were done without the consent of the customer. See, you should not make a sale just like you are feeling you are feeling like making a sale. A sale should happen only when the customer is asking for you. So that like that, we need to check whatever sales that are made, they are made only after getting a written order from the customer. And one essential condition of AS9 for recognizing revenue, there should not be any uncertainty regarding its ultimate collection. We can even perform some analytical procedures like calculating the ratio of sales returns to sales, calculate the ratio for current year, calculate the ratio for previous year, try to do the comparison, and if you find any huge deviation, report them. Investigate them, and even try to verify whether sales returns are genuine or not with original sale invoice copy, challan, credit note, and even reversal of GST in the GST returns. With all that, you try to cross verify. Why? Because sometimes clients will try to overstate their sales return to underreport their revenue. So even we need to obtain evidence whether sales returns are genuine or not. Similarly, we should perform cutoff procedures. Cutoff procedures means making sure that only current year revenue was recorded in current year's books of accounts. None of the future year's revenue has been recorded in the current year. None of the past year's revenue has been recorded in the current year. So proper cutoff procedures we need to perform. See, this problem will be there in the sales because sometimes date of invoice and date of dispatch of the stock will differ. So there actually trouble comes, like date of invoice is 30th of March and the dispatch of the stock happened on 2nd of April. Here it becomes very necessary for us to understand when the risk and reward got transferred. If the risk and reward got transferred on 30th of March only, sale will form part of this financial year. In case if the risk and reward got transferred on 2nd of April, the sale entry should form part of next year. So we need to specifically pay attention when the risk and reward is getting transferred. And also one important point here, we need to pay attention whether there are any huge sale returns immediately after the balance sheet date. Whether there are any huge sales returns immediately after the balance sheet date. Why? Because sometimes clients will try to play cheap tricks. So what they will do is just to inflate their sales without the customer's order, they will dispatch. Now on last 2 days they will dispatch, on 30, 31 they will dispatch. Now when they reach the customer, that will be some 2nd or 3rd April. When they reach the customer, what customer will do? Since he did not order, he will send it back. Now when they reach the company's premises once again, it might be 4th of April or 5th of April. Now they will record sale written in the next year, but sale would have already been recorded on 30th of March or 31st of March. So like this, sometimes management will try to play cheap tricks in order to increase their revenue. So check whether there are any huge sale returns immediately after the balance sheet date. And not just that, even try to verify GST returns, etc., to check whether the turnover as per GST returns and also turnover as per the books of accounts both are matching or not. Now talking about measurement, that is making sure that whatever revenue that has been recorded, whether it is shown at correct amount or not. Here what I need to specifically verify is, first I need to do examination in depth. I need to take a few sale entries, trace the entries from beginning to ending of the transaction. And in case if there are any foreign sales, export sales are there, check that exchange gain or loss has been accounted as per AS 11. And in order to know whatever revenue recognition mechanism which my client is following, whether it is appropriate or not, to know it, first I need to understand what kind of operations my client is doing. And even if there are any sales with the related parties, that I need to verify whether they are happening at arm's length price and they contain all the approvals required as per Companies Act. So these are the few things which I need to verify regarding sales. See, as I have told, just I will, for sake of example, I will explain some 2-3 questions. Don't expect me to revise all the questions. Why? Because revising all the questions will be like explaining the entire chapter once again. Okay, so this is what regarding how to verify sales. And talking about purchases, as we all know, purchase will be just other side of the coin for the sales. So same points will be there more or less. Now I will try to explain employee benefit expenses. So how as an auditor you will try to verify employee benefit expenses. So like you could see, first I need to understand what is the client's hiring process, what is the appraisal process, what is the retirement process. That means what procedures they follow for recruiting the staff, at what intervals they do appraisal, nothing but they will give increments, etc. No, that appraisal process we need to understand. Along with that, even we need to understand what is their retirement process also. And we need to check whether internal controls in the area of employee benefit expenses are working effectively or not. Generally, what kind of controls will be there when it comes to salaries? Proper maintenance of accounting record should be there. You should have an employee master. Employee master means a database of all your employees you should maintain. And you should check that whenever monthly salary payments are happening, for that there is proper approval mechanism or not. And whatever benefits which have to go to them, whatever deductions that should happen from their salaries, whether all that deductions and accrual of benefits is happening or not. Next, detailed audit procedure. First, I need to understand what process the client is following for capturing attendance. See, in IT companies, generally, if you observe, the security software, whatever they use, like if an employee has to enter inside the company, they have to show the identity card. That security software, along with giving access, it will even capture attendance data also. So different clients will follow different approaches for capturing attendance. You understand what approach your client is following for capturing the attendance of employees. Then try to get a list of all the employees and get a monthly movement slip. That means month on month, how many new employees have joined, how many employees have left, how many are replacement, how many are fresh recruits. Try to get monthly movement slip from management. Similarly, whoever new hires are there in the current year, take a sample and check that for the new hires of the sample, from the sample of new hires, whether salary has been paid for the first and subsequent months as per the agreements which has been entered with them. Similarly, whoever employees have resigned during the year, from that also take a sample and check whether full and final settlement has been made to them or not. And get the salary registers for all the 12 months, and whatever their employee benefits are there, like bonus, gratuity, leave encashment, they might be post-retirement benefits. You might be paying that to the employee at the time of leaving, but still you have to accrue it from the day one itself. So check whether all these employee benefits are accrued or not. And whatever PF and ESI component you are deducting from employees, check whether it has been deposited with regulatory authorities. How you will come to know whether company deposited PF and ESI with regulatory authorities? Ask from them challans. Next, even wherever suitable, wherever relationship exists, try to perform analytical procedures also. So these are the few things which you need to understand, which you need to verify when it comes to employee benefit expenses. Apart from that, one more thing, one more important question. All other expenses, they have given some common points. So now, whatever may be the expense, there are some general points which we verify for every kind of expense. Whatever may be the kind of expense, there will be some general or common points which we will check for every expenses. What are that common points? A few common points will be, first we will check whether expenditure belongs to current period only or not, whether there is a proper classification made between revenue and capital expenditure, whether all that expenses are having supporting documents or not, and whether whether expense has been recorded under correct account head, whether expenditure was authorized or not, approved or not, and also whatever expenditure that is recorded in the books, they should be related to business, they should not be a personal expenditure of employees. So these are some common or general points which we try to verify for every kind of expenditure. So once we verify all these common points, now depending upon expense you are verifying, there will be some special points also. Like when you take rental expense, what special points will be there? With what you will verify rental expense? By verifying rental agreements. And we need to check that rent should have been recorded for all the 12 months on accrual basis. And if there is any escalation clause in the rental agreement, generally in the agreement there will be escalation clause. If during the 6 months we will increase rent by 10%, etc. So read the agreement, find out whether there is any escalation clause, and check whether the rent has been increased as per the escalation clause. And even we need to check that agreement should be in the name of the company. That alone will not be enough. That property should be used even for business purposes. Rental agreement should have been in the name of company, and along with that, that premises should have been used for business purposes. Then only that rental expense will take its place in statement of P&L. Apart from that, power and fuel expenses, when it comes to power and fuel expenses, how you will specially verify it? We will check the electricity bills, and also we will see power and fuel expenses is recorded for all the 12 months, and also get month-wise summary of power units consumed. So if you know how many units of the power are consumed, if you multiply with per unit rate, you can recalculate how much amount of electricity expenses should have come in the books of accounts. So try to do that reverse calculations also. And apart from that, when it comes to insurance policies, how we can verify insurance policies? How we can verify insurance expense? By checking insurance policies, and even check whether expense has been properly classified between prepaid expense and also on the basis of number of days. Why? Because sometimes insurance policies will run for more than 1 year. That all premium we can't record in only 1 year. We need to record that insurance premium expense over that policy tenure. So check that insurance policy proper insurance expenses has been properly adjusted between prepaid and normal expenses. And legal and professional expenses, this we will try to get a month wise summary and consultant wise summary for every month. For every consultant, how much amount has been paid, we'll get a summary. And even if there is any retainership agreement, try to get the copy of that retainership agreement and check whether that retainership fees has been paid in accordance with that retainership agreement. And if there is any non-recurring expense, say retainership fees is a recurring expense, so that we will verify with agreement. If there is any non-recurring expense like case fighting charges, that we need to verify with common points like invoices, bills, etc. And you have to be very cautious while verifying legal expenses. Why? Because they will give you information regarding litigations and claims which you are not able to get it by performing procedures under SA 501. SA 501 is also giving some guidance regarding how to obtain audit evidence regarding litigations and claims. Sometimes even if you miss out some information by performing procedures under SA 501, that information also you can get it if you remain cautious while verifying legal and professional expenses from the statement of P&L. Apart from that, some other miscellaneous expenses will be there. Travel, repair and maintenance, printing and stationery, all these other expenses will be there. These are very simple. From these miscellaneous expenses, just take a sample, try to verify for the common points, and if you find any kind of relationship exists, try to perform analytical procedures. That's all. So that's all guys. For examples like this I have told, but one important question I will say, and which I'm having a gut feeling they will ask in the examination, which is some disclosure requirements are there, which are very, very important. Just a minute. Some disclosure requirements will be there. Okay, so I think I would not have updated here. I will show you directly from ICA website only. I think they are following a pattern actually. Very frequently they are asking question from this disclosure requirements. So that's why I want to specifically revise that. Yes. So this is what I was referring to. there were some extra disclosure requirements which are added in the financials, which are added in Schedule 3. That means going forward, companies are required to give some extra disclosure requirements regarding certain items. I'm not talking about auditors disclosure requirements. Schedule 3 has given some extra disclosure requirements to the companies while preparing financial statements. So some points I have identified here, they have given it in the study material itself. These are actually amendments, so high chance of getting tested in the examination. And in fact, they have tested it also in the recent times. In one exam, they have tested disclosure requirements regarding CSR expenditure. In the very recent exam, they have asked the disclosure requirements regarding cryptos. What are the disclosure requirements which you are required to give regarding crypto or virtual currency? If you would have attended my last marathon, this is specifically I have highlighted. This is what something I have specifically told. If from these, any of the 6 points, 1 point will be definitely tested. And in fact, that was tested in the examination. Okay. So, but let us give a quick glance. What is the thing that we need to verify here? So these are disclosure requirements, guys. Who has to disclose? Management has to disclose. Where they will disclose? In the notes to accounts of the financial statements. So what are that matters and what disclosures are required to be given? First one, regarding CSR expenditure, the management should give some disclosures in the financial statements. What disclosures they should give? So they should show in the notes to accounts. Every company should show in the notes to accounts regarding CSR expenditure, how much amount is required to be spent, what is the total amount which they have to spend during the year on CSR expenditure, and how much amount you have actually spent. First point, how much you are required to spend. Second point, how much you have actually spent. And if there is any shortfall, even the management should disclose how much shortfall is there. And what is the total of previous year's shortfall? In the last year, if there is a shortfall, show that shortfall also. And what is the reason for shortfall? Why you did not spend the entire money? Why there is a shortfall? You need to disclose the reasons. And along with that, whatever money you have already spent, in what nature of CSR activities you have spent, for what CSR activities you have spent, that also management should give disclosure. And as a part of that CSR expenditure, is there any related party transaction? See, some big companies, what they will do is, like if you take Infosys company, they need to spend CSR money, but they will not directly spend it. Infosys has created a trust. Now all this CSR money will be given to the trust. Now the trust will handle how to use that money. So this is a related party transaction. Infosys is transferring the CSR contribution to a related party, which is a trust created by Infosys once again. So find the company has to report in their notes to account whether in this CSR expenditure any amount has been given to related parties, and also whether a provision has been made with respect to liability incurred by entering into a contractual obligation. That means, have you entered into any contract for meeting CSR expenditure, and whether for that any provision has been created and what movements have happened in that provision. Like a company wants to build a school for backward people, the students in the backward area. So what they have done is they have entered into a contract with one builder for 3 crore rupees. So now you have created a provision. So you are required to pay some 1 crore amount of outstanding money. Provision is created. Provision is there in the books, but that provision is related to CSR expenditure. And even you should show during the year what movements have happened to that provision. How much extra provision was created, how much was repaid, what is the closing balance. All this information is required to be reported by whom? Company. Where they are required to report? In the financial statements. Clear? So this is what the disclosure requirements regarding CSR expenditure in the notes to accounts. And second point is regarding rounding off. As we all know, companies will round off their financial statements now. To what figures they have to round it off? See, if the total income of the company is less than 100 crore rupees, then financial statements should be rounded off to either 100, thousands, lakhs, millions or decimals thereof. If the total income of the company is less than 100 crore, they can round off the financial statements to either hundreds, thousands, lakhs or millions. In case if the total income is more than 100 crores, then you can round it off to lakhs, millions, crores also. When you can round it off to crores? When the total income is more than 100 crores. If the total income is less than 100 crores, then you can round it off only till millions. You can't round it off in crores. Whereas if the total income is more than 100 crores, you can round it off to lakhs, millions or crores. Here you can't round it off to thousands and hundreds. Here you have to start it from lakhs. So like this, depending on this, you have to round it off. Important for MCQs and true or false statements. Similarly, if the company has been involved in any Binami property related cases, company should give some disclosure in the notes to accounts regarding Binami cases. What disclosures they have to give? What are the details of such property? What is that property which is under litigation? Details of the property, and what is the year of acquisition? What is the amount of that property? Who are the beneficiaries? If you are the Benami, then who are the beneficiaries? If property is in the books, the reference to that item in the balance sheet. Even you should give reference in where this item is, where this asset is shown in the balance sheet. Reference also should be given. If property is not in the books, then the fact shall be stated. In case if your client is a Binami, they are holding some assets as a Binami, but they have not shown it anywhere in the balance sheet, then the company should disclose a fact that we did not show this asset anywhere in the books. Along with that, where there are any cases pending against the company for holding Binami properties, even where they are pending, before which authority they are pending, that details are also required to be disclosed. So these are the information which company should disclose in the notes to accounts regarding related party transactions. Similarly, if your client company is having any relationship with the struck-off companies means those companies whose names are removed from the register of companies. In case if your client company had any transaction with that struck-off companies, then the company needs to give some disclosure. Then your client company needs to give some disclosure. What they need to give disclosure? What is the name of the struck-off company with whom you had transactions? What kind of transactions you had? Is it investment? Have you made investment in that struck-off companies? Are you having receivables from that struck-off companies? Are you having payables from that struck-off companies? Are you having shares of that struck-off companies or any other outstanding balance? If yes, nature of amount of each kind of transaction also you have to report. If you have investment in that struck-off companies, you have to tell how much amount of investments is there. And even relationship with the struck-off company, if any, to be disclosed. If at all, if the struck-off company is your subsidiary, associate, or etc., even that relationship also should be quoted. Very simple, guys. If your client is having any relationship with struck-off companies, they need to give all these disclosures in their notes to accounts. Apart from that, one more last point. Two more points. What ratios company has to disclose in the notes to accounts? They need to calculate some ratios and disclose it. The list of ratios has been given. Guys, there is no other option. You have to mug up. These 6 points, please don't ignore. In the study material itself, at the end of the chapter, you'll be able to find it. Never ever leave it. Please make sure that you are mugging up all the 6 points. That's all. There is no other choice. Disclosure requirements, very, very important. So what ratios are to be disclosed by the company? Current ratio they have to calculate and disclose. Debt equity ratio, debt service coverage ratio, return on equity ratio, inventory turnover ratio. Mug up, guys. Just name of the ratios are given. You have to mug up and reproduce it in case if they ask in the examination. And also, in case if your client is having any cryptocurrency or virtual currency transaction. This was a very recent examination question. So I don't expect that they will ask it in the near time, in the very near attempt. But still, I will explain. So if your client is having any transactions in the cryptocurrencies or virtual currencies, then your client should give some disclosure in the notes to accounts regarding that cryptocurrency transactions. What disclosure? So whether the company has traded or invested in cryptocurrency or virtual currency during the financial year. If yes, the client shall disclose profit or loss on transactions involving that cryptocurrency or virtual currency. On that cryptocurrency transactions, how much profit or loss made, that has to be disclosed. Amount of currency held as on the reporting date, as on the balance sheet date, how much amount of cryptocurrencies your client is holding, that balance also should be reported, balance of that cryptocurrency. And also deposits or advances from any person for the purpose of trading or investing in cryptocurrencies or virtual currencies. That means, has your client company gave deposit to another company for dealing in cryptocurrencies, or did your client company receive any advances from another company for dealing in cryptocurrencies? So instead of you doing directly crypto transactions, are you doing it through a mediator, or you are acting as a mediator for doing cryptocurrency transaction? If yes, those details are also required to be disclosed by the company in their notes to accounts of the financial statements. So very important, guys. No other option. Mug up all this content. They might test you in the examination. Clear? So this is what the things which I thought of covering in the marathon. So almost all, we had 20 hours of marathon session. 20 hours we have covered. 20 hours we have spent on this marathon. Including part 1. Part 1 I have already uploaded. Part 1 is there for 12 hours, and this part 2 of the marathon is somewhere around 8 hours. So totally we have spent 20 hours of time. So definitely it will help you for last minute revision. And after you complete each and every chapter, you need not listen all this marathon in one sitting. That you can do it at the time of close to the examination. How you can also use this marathon is, once you complete each chapter's preparation, you can come to this marathon You can come to this video. I will add the timestamps for each chapter. I will add the timestamps. Once you prepare for respective chapter, you can come to that respective timestamp and read and go through only the marathon of that particular chapter. In that way also you can utilize it. So a lot of effort has been put, as I have already mentioned. With a lot of effort, I have brought this marathon before you. Hope this marathon would have helped you a lot. And in case if you believe that this marathon was somewhat beneficial for you, please do like and share this with others, and also pass on the message with other friends who are preparing for CA Inter. Thank you so much, guys. And in fact, you have given responses to my earlier videos. This responses has given me even more energy. Your likes, comments has given me more energy to provide even more content for the benefit of the students. So by the end of the day, my motivating factor is you. So you are my motivating factor. You are giving me all the energy and excitement to bring before you all this useful content. Thank you. Keep on supporting like this. And as I mentioned earlier, please don't forget to like and share this with others. And even subscribe to my channel. Going forward in the future also, you will see even more exciting and interesting content from subject perspective, and also from practical things happening in the world. You all will come to know about it. So please do consider subscribing to this channel. Thank you so much, guys. Thanks for your patience listening, and all the very best for your examination. I wish and I hope and I do expect that you guys will rock the exam. Thank you so much.